Chinese economy, especially those retail sales and factory output numbers that we got last week?
Yes, I suppose, one sort of positive out of those sort of still quite dismal numbers is that it did indicate that, there is some return to some normalcy in activity in China. Of course, China was the first country that, went under those restrictive lockdowns. It is going to be of some support. It's going to be minimising some of those sort of supply disruptions that we'd already been expecting due to the intermediate goods China produces. But we need to remember that now, of course, that the rest of the world is under significant lockdown, the US and Eurozone. So you've got 50% of the economy now under some lockdown, and that's going to weigh both on Chinese demand, and even going forward, consumer demand is not going to return to any of the strength that we've seen anytime soon in China. So that we'll still see some significant weakness on the export front for Asia.
And one economy very dependent on what happens in China, South Korea, of course, and the consensus is that first quarter GDP is likely to drop by the most since the 1990s Asian financial crisis. Will this prompt the BOK to do more? Because they seem pretty reluctant so far.
Yeah, well, I mean, they did do quite a lot of easing in March. I mean, they had a 50 basis point cut. They also effectively implemented QE, and that's probably, in our view, despite our expectations of significant contraction in growth, that's probably easing some of the pressure on the Bank of Korea. We're still looking for a 25 basis point cut, but 0.5%. I think they're going to be going beyond that. They're likely to be a bit more reluctant.
Where does the Bank of Japan go from here as we look ahead to inflation numbers? Because, there's very little expectation that the economic outlook is going to pick up at all. And we've seen the Bank of Japan really stretched already, even before this, to the limits of their, policy creativity.
Yes, I mean, we're looking for, Japan to, shrink by 4.8%. So, I mean, that's significant. I mean, inflation's still fairly mild, given particularly that we need to remember that they had a consumption tax hike last year. So consumption's still mild. We're not expecting any significant action going forward with the Bank of Japan. They've already, back in March said that they will be, buying more government bonds and stepping up purchases of ETFs and the like. But they haven't actually raised their purchase targets. So again, this is probably going to be more targeted, and we're not looking for anything such as further interest rate cuts, given that they're already the base rate's already at negative.
Right, Sharon Fenner, Oxford Economics senior Asia economist. Now, the Cleveland Fed president says the U.S. central bank is too focused on limiting damage to financial markets and the economy to be concerned that its actions will encourage excessive risk-taking by investors. Loretta Mester told us that while the Fed is moving into unprecedented territory, it's trying to help companies impacted by the virus through no fault of their own.
So we're in a real unprecedented, incredibly deep shock to the economy. And I think it behooves us at the Fed to really use our tools as best we can to get us through this pandemic shutdown period, mitigating the negative impact on the economy so that the recovery can be as best as it can be when we get to that point. Yes, we are moving into unprecedented territory, but remember, we're trying to then lend to firms that, through no fault of their own, were impacted by the virus. And so there are, we are going into, for example, corporate debt programs, which we haven't done before. And we are going to include some fallen angels,
Order canceled.
Right, that, had an investment grade rating before the virus hit. So you're right that we are doing things that we hadn't done before. But at this point, I don't think we can be that concerned about those kind of moral hazards. I really think we have to really look at this is a hugely impactful and negatively impactful shock. And we have to do all we can to make sure that we're not doing permanent damage to the underlying fundamentals of the economy so that when the time comes and activity can pick up, we can get a decent recovery out of this.
A lot of what you just said will make sense to a lot of people. Where people struggle though, Loretta, and maybe you can help us, buying BB credits that were BBB before this might make sense to tons of people. They're huge employers. Buying high yield ETFs that have CCC credit in them, exposed to a very shaky energy sector that weren't on firm footing before this, doesn't make sense. Why the decision to buy junk ETFs?
Yeah. So part of what we're doing and all the things that we're doing are twofold. One is, right, we're trying to make sure that the markets stay functioning. So some of the efforts that the Fed has done, right, are really geared at market functioning, and some of them are geared to make sure that, right, we mitigate the negative effects on households and businesses by making sure that we have credit flowing to those businesses. So I look at the ETF part of that as a market functioning issue. And we're continuing to look for gaps to make sure that our markets are functioning. And I would say that some of the efforts that we've taken already have improved functioning in the market. So there's two things going on. One is making sure that, and this is the Fed's responsibility, right, is to make sure that we have markets that are well functioning so that credit can flow, right, and do what it can to help shore up the economy to prepare it for the recovery. So, you know, we can disagree on kind of what the right way to do that is, but part of what we're doing is to try to make sure that we have functioning financial markets, precisely because those are an essential ingredient for the economy, for that any other policies that we do can flow through. So there's a transmission to the households and businesses that need those funding.
I know that at this point the Fed is all in, doing everything it can to try to support the economy. When we get to that third quarter maybe reopening and it's time to stimulate the economy, is there more you think you need to do or can do, and what would that be?
So I think we're going to have to see how what it looks like when we get there. I don't think we're up against any kind of constraint on what we can do. As you've seen, I think we acted appropriately, rapidly, in an unprecedented, rapidly way, really because of the recognition of how deep this shock was, and engineered because of the investment we're making in public health, right? So when we get to that point, we're going to look at our tools, do what we can, again, to support some of the programs that the federal government is doing, in terms of like the PPP, the Paycheck Protection Program, et cetera, and then be prepared to use our tools as appropriate to make sure, one, markets function, and two, that we're supporting the economy as we always do, so that we can get back to a normal, sustainable growth with full employment and price stability. And so that's what our goal is going to be. That's what our goals always are. And we have tools to do that. Yeah. We have forward guidance. We have our interest rate tools that we're doing right now at zero. And we're going to move those things around as appropriate to make sure that the economy can recover and get back to a sustainable growth path.
And that was the Cleveland Fed President Loretta Mester there, speaking exclusively to Bloomberg Television. Well, coming up next on Daybreak Asia, we'll have more on the eco outlook for the week with Goldman Sachs Chief Asia Economist Andrew Tilton will be joining us. Also, Oxford Economics Louis Kaus will be with us a little later on Bloomberg Markets. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Let's now get a quick check of the latest business flash headlines. Wynn Resorts is calling for parts of the Nevada economy to reopen next month, with a relaunch of the Las Vegas Strip to follow. CEO Matt Maddox says that any reopening may have to stop if there's a spike in virus cases, but the casino industry needs to step forward before it's too late. Wynn says it would impose reduced occupancy measures as well as physical distancing and temperature checks on all visitors. The aviation unit of Bank of China is to buy 22 Boeing planes from United Airlines and lease them back as the coronavirus heaps more costs on carriers. BOC Aviation will take 6 Dreamliners and 16 737-9 MAX jets as the airline seeks to reduce regular outgoings as the pandemic cripples demand for flights. The deal is expected to close before the end of the year, but no financial details have been disclosed. Mobile carriers in Japan are delaying the launch of new iPhones until May 11th as the coronavirus drags on consumer demand. NTT Docomo and SoftBank say the decision is driven by the government's nationwide state of emergency, with people being ordered to cut personal contact in a bid to curtail the spread of the virus. The state of emergency is currently expected to remain in place until May 6th.
Sherry, let's take a look at our markets trading in this part of the world. We do have upside when it comes to Kiwi stocks up high for a 5th straight session. Overall, Asian markets pretty mixed, and this is really going to be part of the story why as we continue to see downward pressure on oil. That WTI May contract just hovering at around $18 a barrel there. In terms of emerging markets, it would be interesting to see how the crude story weighs on that, given that we are seeing the MSCI Emerging Market Index just on the cusp of entering bull territory. Well, coming up next, Hong Kong's arrest of pro-democracy activists is sparking an outcry from the US and threatens to antagonize protesters more. We'll be speaking with the former Democratic Party chairperson, Emily Lau, with us. Plus, we'll have a number of major interviews later on Bloomberg TV, including Philips CEO, SocGen's chairman, IAG CEO, and the White House economic advisor, Larry Kudlow, will be along with us. Don't miss those conversations. This is Bloomberg.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. President Trump has performed a dramatic U-turn on the coronavirus, saying China may have deliberately released the infection. Trump's now including the threat of punitive action if investigations prove the virus was unleashed by choice. Only weeks ago, the president was praising his Chinese counterpart for the way the outbreak had been handled.
The question was asked, would you be angry at China? Well, the answer might very well be a very resounding yes, but it depends. Was it a mistake that got out of control, or was it done deliberately? Okay, there's a big difference between those two. In either event, they should have let us go in.
Indonesia is tightening virus restrictions, extending curbs on millions of people in the main island of Java as infection numbers rise there. The new regulations will affect about 9 million more people as the virus continues to spread. Indonesia has recorded the biggest daily increase in cases since numbers were first reported, and the government has widened restrictions to cities surrounding Jakarta. Meanwhile, new aviation data from EU regulator Eurocontrol show the dramatic fall-off in passenger traffic across the bloc. The graphic shows how lockdowns and the subsequent collapse in demand have slashed flights in Western Europe amid the coronavirus pandemic. Eurocontrol says the bloc's leading airports are now handling as much as 90% fewer flights compared to 1 year ago. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
The weekend arrest of pro-democracy leaders in Hong Kong is drawing sharp criticism from the U.S. and others. This after Beijing's representative office in the city asserted its right to intervene in local affairs. Joining us now is former Hong Kong Democratic Party chairperson Emily Lau. Emily, great to have you with us. First of all, just give us your reaction to the weekend's developments.
Well, it is, of course, very shocking and very disturbing. And as you rightly said, the Chinese government is also insisting that they can interfere in the internal affairs of Hong Kong, which, of course, will spell the end of this policy of one country, two systems. And that's something that they agree with the British when they signed the joint declaration in 1984. And we're supposed to have separate existence from 97 for 50 years until 2047. But it seems all that is now at stake, and the Hong Kong people are very worried. And of course, the business community in Hong Kong, which includes people from all over the world, should also be concerned, because if we are suddenly going to be reduced to just another Chinese city, all our freedoms, the personal safety, and the rule of law that we've enjoyed for so many years will disappear.
Has the virus outbreak in China and Hong Kong changed the dynamic between Hong Kong and the mainland? Given that Hong Kong really is suffering from this economic slump, will it give a chance for Beijing to reassert itself?
I think so. I think Beijing is thinking that because not just China and Hong Kong, but the whole world, including the U.S. and many Western countries and others, are fighting this virus pandemic, and so they will have no time to look at Hong Kong. And some people think that Beijing thinks this is a golden opportunity to assert their total control over Hong Kong. But I can tell you, the Hong Kong people are not going to wear it. We are not going to allow our freedoms, our rule of law, our personal safety to be taken away from us so rudely.
Emily, does it worry you in the sense that we're seeing Beijing on the defensive now, right? It's experiencing, pretty widespread condemnation about its handling. Some say the cover-up and the subsequent, inaccurate reporting of the virus numbers as well. So it's really, in some ways, kind of come under threat when it comes to its position on the global stage. Does that worry you in the sense that it could create a more aggressive Beijing in terms of asserting its authority in places like Hong Kong?
Well, of course it could, but if it decides to do that, it would be very wrong. I think China should show the international community that it can act as a responsible member, can be more transparent, more accountable, and follow the code of behavior of responsible nations. So it can go anyway. But if China wants to act in a barbaric way, I hope the international community will not allow them.
Emily, domestically, what more can the Lam administration, if you will, the SAR government do to alleviate the woes of the economy, which have not just been brought upon because of the pandemic-related shutdown, but also, of course, 6-7 months of protests and civil unrest prior to that? What other policies would you like to see economically and socially to benefit Hong Kong right now?
Well, I want to see the Carrie Lam administration listen to the views of many Hong Kong people and engage the opposition in a dialogue rather than to act just as a servant of Beijing, because that's what she's doing now. And I think we want the virus, the thing, to be tackled and then to reopen for business. There's no problem with that. And the people in Hong Kong are very, they follow the government restrictions and they stay at home, and that's why we do not have that many confirmed cases. But once the virus is over, I can assure you, the protesters will come out again if the government does not listen to us and does not engage in dialogue with the masses.
If the tensions continue between the two sides, U.S. lawmakers are already calling on President Trump to review Hong Kong's special trading status. What happens if the special privileges are revoked?
Of course, that would be devastating. And some business people say if that happens, then for Hong Kong, the game is over. And we don't want to see that happening. So that's why it's very important for the government here in Hong Kong and in Beijing not to act in violation of human rights. Otherwise, the U.S. administration may invoke the Magnitsky Act to ban these perpetrators of human rights violations from entering the U.S. and freeze their properties and assets in the U.S. I think some of them are very scared about it. And so in order for that not to happen, they have to listen to the people and not to violate their human rights like they did yesterday or 2 days ago, arresting 15 pro-democracy activists.
Emily, what would you say to criticism that might come upon these pro-democracy activists and gatherings, that this is the time really to show unity so that Hong Kong, along with the rest of the world, can see to the other side of this global pandemic?
Well, actually, you're right. I think many Hong Kong people, including those from the pro-democracy movement, think that the top priority in Hong Kong now is to fight this virus, this pandemic. And suddenly, lo and behold, the government mounted this, big arrest. One day, arrested 15 very prominent pro-democracy activists. So they are not doing it. It's not us. Many Hong Kong people say, they stay at home, they don't gather in big groups. Even now, I don't think people should turn out and gather in big groups and get infected by the virus and be arrested. So we have that priority, but the government doesn't care. Okay, forget about fighting the pandemic. They just want out to cause trouble and arrest all these, activists.
Emily, always a pleasure having you with us. The former Hong Kong Democratic Party Chair, Emily Lau, there on the line with us. And we will have more on the outlook for Hong Kong with the Chamber of Commerce's Peter Churchhouse will be with us a little bit later on Daybreak Asia. Well, coming up next, we'll be discussing the outlook for commodities. Probus Security CIO Jonathan Barrett will be with us. This is Bloomberg.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's how we won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
Order filled. Order filled.
New Zealand stocks trading higher at the moment, but futures to the downside. Sophie Kamarudin in Hong Kong has the latest on the market. So,
yeah, this Monday looking like a cautious start to the week. Sherry, pulling up the board, we're seeing little action in currency markets with the dollar just catching a slight bid. And we do have S&P E-minis under pressure, and Nikkei futures in Singapore opening lower. And check out Kiwi yields lower this morning, but the loss of about 4 basis points looking capped after that stronger than forecast inflation data that we got for the first quarter from New Zealand. And so this ahead of a week that brings us more global data that will flesh out the virus impact, plus the reporting season that is kicking off in earnest in Asia this Monday. China Mobile, Infosys, and Samsung Biologics are among the highlights. And flipping the board in Japan, more than 2,000 companies are reporting through May, and we're going to be watching to see if more hold back on profit guidance, which could weigh on this recent stock recovery that has pushed the Nikkei into bull market territory. And Japan's sluggish corporate bond market, that is signaling caution, with about 85% of new issuance this month coming from defensive sectors. A far cry then to last fiscal year amid worries of recession in Japan along with defaults. Now, quickly checking on oil, switching out the board, we are seeing crude extending declines after WTI lost 20% last week amid increasing concerns over storage capacity. Now, check out WTI front month contract, that is slipping below $18 this morning, below 17 bucks. In fact, falling the most since November 2001, ahead of the April 21st rollover, with a June contract trading just above $24 for New York crude there, Heidi.
All right, we'll stick with commodity markets, bracing for this deluge of corporate information this week. Earnings season, of course, hitting top gear here in Australia. We'll be seeing production data from some of the country's biggest players, including BHP and Santos. Let's get more on what we're expecting. We are joined by Purpose Security CIO John Barrett. John, let me actually backtrack and start with your views on oil. This is, we are looking at that May contract potentially dropping to 17 bucks a barrel. Clearly, the OPEC Plus deal hasn't done very much at all. They've left the door open to doing more, but is it questionable how much the supply side can actually do without an improvement in the demand outlook?
Heidi, good morning. Absolutely. I think when you look at it, OPEC Plus and OPEC Plus in the US has certainly tried to control the market or rebalance the market and see prices higher. But when you're looking at that demand destruction by about 30%, and you're looking for OPEC Plus to control 20%, clearly there's a 10% differential, and I think that's what's actually being factored into the price at the moment. So if anything there, I certainly feel that prices still remain around this lower end, but yes, you definitely need to see some form of confidence come back into the market in order to see prices stabilise and move higher.
What are your expectations for earnings season? Because in a way, so many companies, outside of metals and mining have withdrawn or, withheld, delayed guidance, if you will. In a way, looking backwards, is it as relevant as trying to see if we can look through to the other side of this crisis?
Absolutely. I mean, and I think this is where we're seeing with a lot of the production reports, or we will see. If you look at the recent Rio's report, it came in terms of its iron ore. When it looked at terms of its production or total exports, they were still relatively robust, off a little bit, but they didn't fall off a cliff. When you look at the imports, say, for instance, from China of iron ore, they were only off a little bit. They weren't off a cliff. I see that there's still that sensible demand for the commodities regardless. And what we're looking at, I guess, is more of a U-shaped recovery for economies, but a V-shaped recovery in confidence, and that in the help will provide that picture for sustainable prices in a lot of these commodities, which in some of these metals prices, that's what we have seen.
That's very interesting. So you are making the difference between demand and actual confidence. So what are we seeing in the physical world in China so far when it comes to demand? Are we seeing that pick up with factories now starting to reopen?
Yes, and yes, we are. And the word that I hear from a lot of the colleagues who actually do that import-export game there is that China is open for business. Whether it's from the domestic demand side or whether it's a supply side, we're seeing that the central authorities in China really will sort of help to kickstart and support that economy because they have to. When you do look at some of the numbers, yes, some of the economic numbers have been quite horrific, but at the end of the day, when you look at steel production, that's still reasonable given the circumstances that we have been in and are going through. So at the end of the day, I feel that China has this ability to be able to say, we're going to continue to support this domestic economy. Let's continue to buy. When we look at the imports, say, of iron ore, as I mentioned, they're only off a little bit over the March quarter. So at the end of the day, that's be reflected back in demand for our commodities from Australia, and hence in those production reports that we're expecting to see, particularly out of South 32 and BHP.
What about outside of China? Because Rio Tinto just last week was saying that the demand outlook was uncertain for most raw materials outside of China. So if you have that weighing on prices, how will those two dynamics balance themselves out?
Well, I guess that's one of the questions. How quickly can we recover when we're in this throw of confidence, trying to get back to the economy's getting back to work? And to me, that is that key. And that's why I mentioned this V-shaped recovery in confidence, because when you go to the grassroots of the purchasing manager, he will look forward and he will actually say, well, how confident am I that the economy will pick up? And when that confidence starts to occur, then they start to price that, and those forward contracts move from that backwardation or stable into contango, because we can see that there is an end in sight. So when I look at it, that looking in the future, when we see that confidence, when we see the economies, when we see those curves flatten, then we can all look quite optimistic that those prices will reflect the same. Because remember, a lot of these prices are not priced on cash contracts, but forward contracts.
John, out of the mining and metals names in Australia, who's best positioned to benefit for that rebound in China? Because you've got to expect that at least partially Chinese policymakers will go back to that old playbook of increasing investment to try and get back on track.
Look, I mean, I think when you look at the stability of just most of our miners, when you look at the stability of BHP and Rio, and there are a lot of notes that people are concerned about it, but if you look forward in terms of the pricing for where these commodities are, and we get the rebound with all the resources that the taxpayer and the governments are throwing in, then you could see that situation where you do get a little bit more of that demand side feeling through, and that should see. So when I look at the mining sector, it's still got to be the majors at these levels, the BHPs, the Rios. They're stable investments, and they're short up their balance sheets, so they still remain quite positive. And given the Aussie where it is at these levels, exports are still there, so these companies will reap the benefits. So going forward, I think there's a great opportunity to buy some of our blue chip mining stocks.
John Barrett, CIO of Probis Securities, thank you very much for joining us. We'll have more on the outlook for the commodities markets. ING Bank Head of Commodities Strategy, Warren Patterson, joins us later. This is Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
We have breaking news out of Japan. We are getting the latest trade numbers. We are getting now the trade balance falling into deficit, with the adjusted number coming in at a deficit of 190 billion yen for the month of March, reversing a surplus in the month before. This as the exports plunged, exports down 11.7% for the month of March, a bigger contraction than anticipated, and also the first double-digit contraction in the 15 months that we've seen exports fall. Now, imports also down 5%. It's a smaller decline for imports than was expected, but it's still a 10th consecutive month of import contractions. This, of course, we continue to see this easing in the pickup of imports as supply chains in China went back to business, but exports still under a lot of pressure on weak demand from the US and Europe. So you're seeing import numbers beating estimates, still a contraction, but better than expected. Exports worse than expected, double-digit contraction of 11.7% for the month of March year on year, taking the trade balance into deficit again for the first time since January. Again, exports dropping for a 16th consecutive session. Let's bring in Asia Cross Assets editor Chris Anstey. So Chris, how does this play into the severity of Japan's GDP contraction?
Well, it's certainly not a good sign for the momentum of trade going into the start of the second quarter. Goldman Sachs a few weeks ago had penciled in a 25% contraction in Japan's GDP in the second quarter, and these kinds of numbers would feed right into that sort of worst case scenario. One thing that we should probably note is that, that import figure being a little bit less of a decline than forecast, perhaps could also reflect that although Japan has seen a pickup in coronavirus cases, there really hasn't been the kind of wholesale economic lockdown in this country that we've seen in many countries in Europe and in many states in the United States. So that's perhaps a sign that, domestic demand in the second quarter may not be that horrendous. We'll have to look at retail sales next week in terms of how they came in for March and what sort of momentum they had going into the second quarter. But it is notable that, just looking at stores across Tokyo over the weekend, many people are out and about, many people are still spending. So that's perhaps one silver lining. But certainly the export picture, worst exports since mid-2016, and we're not going to see any sign of a turnaround there for some time.
Yeah, given that we do see Europe and the US shutdowns affected in terms of that external demand picture, does that mean we're probably not going to see a rebound until the third quarter?
It's hard to see a rebound, in Japan's future, perhaps for some time. One of the notable features of the Abe administration's stimulus package is actually a more than $2 billion initiative to bring production back onshore to Japan. So it may be, in part, a recognition from policymakers that the export picture, the trade picture, is not going to improve for some time to come, and the important step now is to boost domestic production for domestic consumption.
All right, Chris. Chris Anstey there, our Asia cross-assets editor with us in Tokyo with a look at just that export-import demand picture for Japan. Let's get you a quick check of the latest business/headlines this hour. The son of the founder of the top Singapore oil trader, Hin Leong, says the company hid about $800 million in losses in futures trading, suggesting a much bigger hole in the company's finances than first thought. Hin Leong filed for court protection from creditors on Friday following the dramatic drop in oil prices. The collapse potentially means huge losses for banks which lent Hin Leong money. Australian miner South32 says it's expanding its current share buyback program as it reported production for the fourth quarter. It's also lowering its capex guidance for the 2020 financial year to $500 million, including cutting its greenfields exploration target by up to $20 million.
Right, and here's how markets are trading at the moment. It's a bit of a mixed picture as we continue to see Kiwi stocks gaining ground, but pressure on U.S. futures as well as ASX and Nikkei futures. Kospi futures, though, on the rise. Plenty more ahead on Daybreak Asia. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Good evening from Bloomberg's global headquarters in New York. I'm Sherrian. And I'm Heidi Stroud-Watts in Sydney. Asia's major markets have just opened for trade. Welcome to Daybreak Asia. Our top stories this hour. Oil extends its slide in Asia, trading at near a two-decade low as the latest output curbs are seen as doing little for the global glut. The virus continues to drag on demand.
Global infections keep rising, although there are signs of easing in the West. President Trump echoes a U-turn on China, asking if the infection was deliberately released. And new questions about top Singaporean oil trader Hing Lung. There may be a much bigger hole in the company's finances than first thought.
Japan, South Korea, and Australia coming online. Let's turn to Sophie Kamarudin for a check of the market. Soph.
Sherry, checking in on Tokyo first. We are seeing losses for the Nikkei by more than 1% this morning. This after the benchmark entered a technical bull market last week. We are seeing the yen under pressure as we have trade data to digest this morning that showed exports in Japan fell more than expected, marking a 16th straight year-on-year drop. And JGB traders, they're waiting on debt supply details as the government considers a universal cash handout. So we may see JGBs track treasuries lower. Now let's switch out the board to check in on the open in Seoul. The Kospi off by about 0.4%, while the Korean won just trading steady at around 12.18 against the greenback. This as we're seeing bullish momentum for the dollar won, with repatriation pressures looming large this month, along with soft eco data from trade on Tuesday to first quarter GDP on Thursday. And while the South Korean government drafts guidelines for a return to a new normal, we are waiting on a job support package to be released this week, which comes after relief was announced Sunday for the Korean financial sector. Now let's check in on the open in Sydney. We are seeing stocks open a little change. This after the ASX 200 capped a fourth weekly gain on Friday, while the Aussie dollar is halting a two-day advance, while bonds are trading just about steady. And we're keeping an eye on resource players in Sydney. This after Resolute and South 32 provided production updates, and NAB also in view after signaling a hit to first half earnings of about $724 million, which does not include any estimates for higher loan loss provisions. And quickly checking in on U.S. futures, switching out the board, we are seeing S&P E-minis under pressure this morning, while the dollar is edging higher, and oil extending losses with WTI for May delivery trading at a steep discount to later dated contracts, indicative of these storage concerns. And lastly, let's flip the board for a snapshot of the Asian dollar bond market. Last week, we saw spreads tighten the most in about a decade as credit may be looking more attractive.
Sophie, thank you. Let's turn to some breaking news on the Bloomberg right now. We are hearing from China Development Bank Financial Leasing that they will be terminating their purchase and delivery of 29 737 MAX Boeing jets. CDB Leasing saying that Boeing will offer certain economic concessions, that 737 MAX 10 on order will be converted to 737 MAX 8s. Now, the delivery of further 20 737 MAXs will be deferred, leaving a total of 70 737 MAX on order. Again, some more details on CDB Leasing terminating purchase and delivery of 29 737 MAX Boeing jets. Right, let's get a little bit more analysis of the markets. We're now joined by Societe Generale Head of Asia Equity Strategy, Frank Benzimra. Frank, great to have you with us. We are seeing investors turning more sanguine towards emerging markets. Where do you see opportunities right now?
Yes, so what we are seeing is that the valuation of the emerging equity is becoming more favorable. So it doesn't mean that that the things are okay, but I think from a market point of view, from an asset allocation point of view, getting more exposure to Asia growth. Whether it is in base metals, whether it is on onshore China, whether it is on some specific sectors such as 5G, is something that we are currently recommending. Also, I would say that in Asia, what is important, and actually not only in Asia but also for global market, is a company with a strong balance sheet. And here it is quite interesting to consider Japan and the Japan dividend in a context where we are seeing in both Europe, US, Australia, everywhere in developed market, more suspension of dividend and share buyback.
We continue to see some numbers out of China that, although they don't look great, they are showing signs of stabilization starting to take hold. Will those be reflected in Chinese earnings?
Well, what we can see for earnings globally is going to be an outright contraction between 20 to 25% in Europe, in US, in Japan, and in China so far the consensus has been quite resilient, and I think on a relative term what we are going to see this year in China and probably in 2021 is earnings to be more resilient. So it doesn't mean the kind of growth that the consensus is expecting at the moment, which is around the low 10%, so it's going to be probably lower, but I think it would be plausible to have this year growth in earnings on the onshore market.
How quickly do you expect the Chinese rebound, and how, I guess, robust do you expect the rebound to be? And if so, and we continue to see a relative stability in the yuan, as well as Chinese risk assets overall, do you see that as lending more support to the rebound in emerging market assets, particularly here in Asia?
I think all the assets which are going to be linked to China investment, which are going to be linked to China infrastructure spending, are going to benefit. And when it comes to Asia, there is probably some divide between the north and the south, and we've been South Asia ASEAN market to be very sensitive to China tourism, to be very sensitive to China consumption, to be sensitive to the commodity demand, and these are the ones that have been suffered first and which, in my opinion, are going to continue to underperform. When we look at the growth in China, there is certainly some shock on global demand and some shock on the consumption, but at the same time we are seeing some ambitious infrastructure spending, and this is probably where the investment opportunity are going to lie, primarily in China, and then on other part of Asia, and I think the northern part of Asia are going to be the main beneficiary.
Do valuations on tech still make it an attractive prospect, particularly as you, along with others, say will continue to outperform after weathering the most recent sell-off pretty well?
Well, you have, when it comes to tech, it's a very broad sector. The technology hardware sector, the semiconductor sector, Taiwan tech, Korean tech, at the end of last year had reached a pretty high level of valuation, was discounting already some strong growth of 5G being expected to deploy, and then we had some major correction, which is today making the valuation more affordable for a certain number of names. So, of course, we know that the semiconductor market is going to slow down this year. There is definitely an impact of the COVID-19, but how much slowdown and what kind of recovery we can see, that's going to be some story for the second half of the year, and I think it could be one of the good story on the Asian market.
And Frank, you mentioned earlier Japanese dividends. We are getting CPI numbers out of Japan later this week. How big of a risk does that economy and the markets face when it comes to potential deflationary shocks?
I think the potential for deflationary shock is not only in Japan, it is everywhere, because what we are seeing in the first quarter of the year is first and foremost a global demand shock. So the demand is impacted, and the demand is going to be impacted everywhere, including in Japan. So the risk of deflation coming is one of the risks that we are highlighting in our investment scenario, including Japan. Now, having said that, when it comes to equity investing, when it comes to income investing, there are some places which appear to be safer than others. One of the legacy in Japan of 20 years of deflation has been that the company have been hoarding cash. And this has been especially the case since 2014. And as a result, we are seeing now the company in Japan which have one of the highest level of cash compared to market cap or compared to assets than any other market in the world. And it doesn't mean that the market is going to do very well, but it means that the ability to pay some dividend is going to be higher than what we can see in other countries and in other markets.
Frank, thank you so much for joining us. Frank Ben-Zimra there from Societe Generale with us. Let's take a look at some of the movers in this early part of the trading session here in Australia. We are seeing the broad ASX 200 off by just about 0.5% at the moment. One of the biggest decliners in the session today is Caltex, off by almost 7.5% at this point. This, as we saw the Canadian company Couche-Tard dropping its Caltex Australia bid on, again, fallout from the pandemic and the virus and all of the economic uncertainty caused by COVID-19, walking away from that proposed $8.8 billion Australian dollar proposal to buy the oil refiner and retailer Caltex. And of course, we do still have the plunge in oil prices weighing on there as well. We're also watching South 32 was out with guidance as well as production today. But really the major headline saying that it's going to try and cut controllable costs across its business that has been affected by the COVID-19 response, lowering its guidance for a number of operations and abandoning them for others. And finally, we're watching NAB or NAB, the National Australia Bank operations, saying that it will take a 1.14 billion Australian dollar charge against first half earnings. This is the second of Australia's big lenders to warn their shareholders of tough times ahead. Well, lots more to come. We're taking a look at Hong Kong, how the city is faring better than other places when it comes to dealing with the virus pandemic, and in other areas, it is faring far worse. So we'll be talking to the Hong Kong General Chamber of Commerce Economic Policy Committee member Peter Churchhouse will be with us. And coming up next, Deutsche Bank's Linan Liu with us to discuss China's loan prime rate and the country's economic outlook. This is Bloomberg.
You're watching Daybreak Asia. I'm Karina Mitchell with the First Word headlines. President Trump has performed a dramatic U-turn on the coronavirus, saying China may have deliberately released the infection. The president is now raising the threat of punitive action if investigations prove the virus was unleashed by choice. Only 2 months ago, the president was praising his Chinese counterpart for the way the outbreak had been handled.
The question was asked, would you be angry at China? Well, the answer might very well be a very resounding yes, but it depends. Was it a mistake that got out of control, or was it done deliberately? Okay, there's a big difference between those two. In either event, they should have let us go in.
In India, virus cases have surged with 1,400 new infections, taking the total above 16,000 as the nationwide lockdown enters a fourth week. Confirmed cases have been rising as India steps up testing, with known infections up 78% in just the last week. However, doctors say the true number is far higher, with only 370,000 of India's 1.3 billion people tested so far. Meanwhile, Western Europe is reporting a decline in pandemic cases, with the fewest confirmed deaths in several weeks. Coronavirus fatalities in Spain rose by 410 to just over 20,000, the smallest one-day climb since March 22nd, while Italy reported its fewest deaths in a week, and France said deaths rose at the slowest pace since the end of last month. Data from Germany and the UK also show an improvement. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Heidi.
Karina, well, the PBOC will also announce its latest setting for the loan prime rate, with investors widely expecting a cut. Joining us now from Hong Kong is Deutsche Bank Greater China Rates and FX strategist Linan Liu with us. Linan, great to have you. The messaging has been pretty steady and strong from the PBOC and from state media, so no surprises if we do get that lowering today?
Thank you. Yes, I agree. Following the 20 basis point cut in one-year rate of China's medium-term facility to 2.95% last week, we expect the April loan prime fixing rates to fall. Specifically, we call for one-year loan prime fixing rate to fall by 20 basis points to 3.85% and five-year loan prime fixing rate to fall by 10 to 15 basis points to 4.60 to 4.65% range. Indeed, in terms of monetary policy, the central bank has been Go ahead.
No, sorry, continue.
Yes, indeed, on monetary policy, China has been relaxing monetary policy conditions. For example, China has cut reserve requirement ratio 3 times so far this year, in April, March, and April. In January, March, and April, with cumulative liquidity injection of 1.75 trillion renminbi. China has also cut the open market interest rate and one-year MLF rate by 30 basis points year to date. Also cut the interest on excess reserves by 37 basis points to 0.35%. We do see room for monetary policy to be relaxed further for the rest of this year. Specifically, we expect further liquidity provision by reserve requirement ratio cuts or through PBOC's various liquidity facilities. We also see room for another 20 basis point cut in one-year MLF rate for the remainder of this year. It's also possible for a potential 25 basis point cut in one-year deposit rate if inflation renormalizes below 3% later this year.
So the rollback of containment measures has already happened in China. By our estimates, the economy is almost back to full pelt. Big question mark over the strength of the Chinese consumer as a result of all this. But I am wondering, we know that the government's shifted into demand stimulus mode, and Chinese policymakers, probably more than others around the world, have more ammunition in their toolbox and more flexibility in what they can do to throw at the economy to get it back on track. But does all of that matter when external demand is likely to remain weak? Is that going to be really the critical missing puzzle piece here?
Indeed, that's a very good question. We also are worried about how sustainable the growth recovery is going to be for especially Q2, given the virus condition in the rest of the world. But Q1 growth, if you look at the sequential growth, in March, there has been very strong rebound in industrial production as well as investment activities. However, consumption and service sector remained quite weak. So we are still projecting second quarter GDP growth to remain in negative growth contraction after the 6.8% GDP growth contraction in Q1. But at 2.5% in Q2. But we expect in the second half of this year, right, Q3 and Q4, growth to rebound to positive at 2.5% to 3.5%. And China's full year 2020 real GDP growth will be at 0.5% contraction.
Lina, what does that mean for the Chinese yuan? Because it's really remained rather resilient. Just quickly, if you can.
We are expecting renminbi exchange rate to range between 680 to 710 in the near term. It's very clear that given global growth uncertainty and asset pricing volatilities, renminbi exchange rate likely to be quite volatile in 2020. But I think there are a couple of factors which continue to be very supportive. Number one, we know the dollar strength in the past couple of weeks has been primarily attributable to dollar liquidity stress, and recently dollar liquidity has improved thanks to the Fed's liquidity supporting tools. And right, secondly, if you look at the China-U.S. interest rate differential, both short-term and long-term interest rate differential has remained quite wide at 180 to 190 basis points. So that's very supportive to the exchange rate as well. Lastly, with China opening up financial market and continue to attract capital inflows, that's also supportive to currency. So we expect the dollar renminbi to end the year at 680.
Lina Liu, thank you very much. Deutsche Bank Greater China rates and FX strategist. Plenty more to come on Daybreak Asia. This is Bloomberg. Talks between the UK and Europe resume later Monday via video conference as they try to reach a post-Brexit trade deal in the shadow of the coronavirus pandemic. EU leaders will also host their own virtual summit later this week. Let's get more with our senior international editor, Jody Schneider. Jody, so let's start with the EU leaders meeting. What are we expecting?
Yeah, so this is going to be a virtual summit, as they're calling it, on Thursday. And one of the main topics will be how to aid economies that have obviously been very hurt, in some cases almost devastated by the virus. And one of that we are already hearing that there's going to be some clashes, likely clashes. The Italian Prime Minister Conte is expected to renew his call for joint euro area bonds to aid economies like his. And there's some countries, obviously, that don't want to go this route. The preferred route for Germany is not this. They don't want to see this, and obviously they have a lot of sway. So that'll be one of the big topics that we expect. Another is what happens as some of these countries try to ease their lockdowns, and what does that mean for other countries that are continuing lockdowns, and what about borders? So these are all going to be the kinds of things that we can expect in that summit discussion.
Yeah, what we've seen is really kind of, talk about lifting restrictions take on a life of their own. What's been the UK official response?
Yeah, so in the UK, there have been reports in the past few days that a lockdown could be lifted in several weeks. And officials, including Michael Gove, who's obviously been helping lead the government while Prime Minister Boris Johnson recovers from the virus, he said absolutely not, that this is not true. And he told the BBC that this is not true. They can't have a date for when this will occur. Obviously, this is the kind of conversations going on around the world, including the U.S. But in the UK, they really came to this late. The number of cases are still going up. And they're also having a problem with protective equipment for hospital workers. So this has really been an issue there, and he's trying very hard, and other government ministers are trying very hard to really quell this discussion of opening up, that they just don't see that yet.
Our senior international editor Jody Schneider with the latest on the UK and the EU, and we will have a number of major interviews later today, including the CEO of Philips, Societe Generale's chairman, IHG's CEO, and of course Larry Kudlow, the White House economic advisor, will be with us. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
A mixed picture in early trading across Asia. Let's turn to Sophie for more. Soph.
Taking a look at the major indices across the region, we are seeing the Nikkei 225 lose ground by as much as 1.2% earlier. This after the benchmark entered a bull market last week. Now paring its rise then from a March low to about 19%. We are seeing the Kospi, though, reverse the earlier loss, now adding a third of 1%, set to extend Friday's gain. But we're seeing that stock rally in Sydney under jeopardy after the major Aussie lender NAB flagged a hit to earnings. And we are seeing Caltex among the worst performers this morning in Australia. This after the Couche-Tard deal has been dropped. That was a $5.6 billion bid that has been dropped from Administration Couche-Tard. And let's check in on what's going on with Treasuries, looking steady this morning while the dollar just edging higher. The risk barometer, the Aussie yen cross under pressure, losing momentum then after failing to push through last month's breakdown point. And gold falling for a second straight day. Hedge fund managers, though, have boosted bullish bets on gold to a 3-week high amid this concern we're seeing around the coronavirus. Now, let's switch out the board real quick to check in on oil prices this morning. WTI crude for May delivery now off by more than 8%, trading at the lowest level since November 2001. So we're seeing this front month contract trading at a steep discount to later dated contracts, Heidi.
All right, let's get more on the coronavirus pandemic. This is global virus cases near 2.4 million. The World Health Organization says social distancing restrictions imposed to curb the virus, must be eased in phases and don't spell the end of the pandemic. Bloomberg Markets anchor Yvonne Mann joins us now with the latest. Yvonne, let's take a look at the countries in Asia that are starting to relax some social distancing measures. What sort of impact are we seeing there?
Yeah, and South Korea in particular is one of those prime examples, Heidi. They actually saw the fewest number of new cases since the start of the surge, only 8 in the 24-hour period, and that's the lowest since this outbreak began in the country, where it all started in that religious sect in Daegu in late February, when we saw 1,000 infections a day. Well, the government says at this point they will keep most of those social distancing measures in place until the 5th of May. They will, though, start to ease some restrictions, like church services, for example. And the government also now thinking about reopening schools soon. They are still quite cautious, though, that there is this fear of now these asymptomatic cases that could continue to spread in the country. But getting the daily numbers to single digits is certainly a milestone, given the country didn't have a lockdown or ban travel. The country has largely been credited for its aggressive testing. It really has become a good model for the rest of the world, too.
Yvonne, but we're still seeing some hotspots in the region, right? Particularly in India and most recently Singapore.
Yeah, India has been an interesting one. They recorded its biggest daily increase in virus cases, adding 1,400 new infections to now more than 16,000 cases in the country. And this as a nationwide lockdown enters a 4th week. We've seen these virus cases surging nearly 80% from a week ago as the country now expands testing. But you talk to the infectious disease experts out there that say the numbers are likely to be much higher because testing is still not very much accessible to the public. Out of the 1.3 billion citizens in India, only about 300,000 or so are being tested so far. That's 0.03% that's been tested in India right now. The Prime Minister Narendra Modi extended that lockdown until the May 3rd, but has allowed makers of IT hardware, farmers, and rural industries to resume operations starting today. You mentioned Singapore. They recorded another 596 new cases on Sunday, most of which have been workers living in those foreign worker dorms, which really has been a rising trend there in the city-state. And Indonesia as well, extending even stricter social distancing rules in the main island of Java. That's going to be impacting 9 million people, and the number of infections now totaling more than 6,200 in the country itself. Back to you guys.
Yvonne Mann, our Bloomberg Markets co-anchor there. Let's get you the latest coronavirus cases out of China. Breaking right now, China reporting 12 additional coronavirus cases on April 19. Of course, we know that we have more than 2 million cases globally, deaths exceeding 164,000. Now, China saying that 8 out of 12 new cases have been imported. 8 out of 12 new cases in China being imported on April We'll talk to the company that's created a new virus test kit that may help plug the hole in testing around the world. We'll be joined by Lucence's CEO and founder in about 2 hours. Coming up next, we'll talk to the Hong Kong General Chamber of Commerce. Peter Churchhouse will be discussing how the virus outbreak and the political tensions with China are affecting the economy there. This is Bloomberg.
This is Daybreak Asia. I'm Karina Mitchell with the first word headlines. Indonesia is tightening virus restrictions, extending curbs on millions of people in the main island of Java as infection numbers rise. The new regulations will affect about 9 million more people as the virus continues to spread. Indonesia has recorded the biggest daily increase in cases since numbers were first reported, and the government has widened restrictions to cities surrounding Jakarta. Meanwhile, Iran is calling on the International Monetary Fund to resist American pressure and approve financing to help alleviate the coronavirus impact. Tehran asked the IMF on March 6 for $5 billion to shore up an economy already battered by U.S. sanctions and falling oil prices. Washington has said it will block the application, but the IMF's regional director says the request is proceeding. And new aviation data from EU regulator Eurocontrol show the dramatic fall-off in passenger traffic across the bloc. The graphic shows how lockdowns and the subsequent collapse in demand have slashed flights in Western Europe amid the coronavirus pandemic. Eurocontrol says the bloc's leading airports are now handling as much as 90% fewer flights compared to 1 year ago. Global news 24 hours a day on air and on Quick Take by Bloomberg. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
China is again taking steps to rein in the democracy movement in Hong Kong, drawing sharp criticism from the U.S. and others. Joining us now is Peter Churchhouse, Hong Kong General Chamber of Commerce Economic Policy Committee member and Portwood Capital MD. Peter, thank you very much for joining us today. So we are not even out of the woods in terms of handling the coronavirus outbreak in Hong Kong. Already we're seeing these tensions flare up again between Hong Kong and Beijing. How much more pain will this bring to the city's economy?
Well, the Hong Kong economy in some respects is very lucky compared to many other economies around the world. The government has a very, very big pile of reserves which it can Hello?
Right, Peter, I'm sorry, we're getting some interference, but please don't mind what you're hearing in your ear. Just focus on my question, the pain for the Hong Kong economy, if you could, please.
Yes, indeed. In some ways, Hong Kong is luckier than many other countries insofar as it has a deep pile of reserves that can be applied to the economy. The government has virtually no debt. The companies in Hong Kong are not highly leveraged. And households in Hong Kong also do not carry a lot of debt in terms of credit cards, hire purchase, and so on. And the banks are in pretty good shape. So in that respect, Hong Kong's pretty lucky going into all of this. So I think Hong Kong can expect what I would call a profit and loss account problem more than a balance sheet problem. Whereas I think in a lot of countries it's going to be a severe systemic balance sheet problem. Hong Kong is probably not going to be in that position, but we'll definitely see a big pullback in earnings and profitability across the board in Hong Kong generally.
So Peter, tell us a little bit what we can expect for normal Hong Kong citizens. We are expecting Hong Kong jobless numbers out today, and we're expecting a 6 month of increase. How bad could it get for households?
Well, put it this way, the official numbers for unemployment in Hong Kong have risen from about 2.8% to about 3.7%. Still very low, but we all suspect that those figures do not actually give us the true picture, because we've got something like 10% of the workforce in Hong Kong, or 10% of the population, works in what you might call the gig economy, in casual employment, self-employed, and so on. And those people, I don't think, get picked up in the unemployment numbers. So I think the unemployment figures are probably somewhat worse than the official numbers would suggest. And I can think that those official numbers are going to go from 3.5% right now to something around 5 or 6% over the course of the next couple of months. So I think we can expect to see it get worse before it gets better.
Peter, you've talked about sort of the positive points, or the parts where Hong Kong is handling things better than others, the handling of the virus, the amount of debt on balance sheets for most companies, for example. But I'm wondering, is the bigger problem for Hong Kong really that longer term existential question as to what happens after this? We have the pro-democracy versus establishment issue still very much, as we saw over the weekend with the arrest, still very much the key issue there.
Well, I think certainly the social unrest last year, in the second half of the year, took a big toll on the economy. We've seen for 13 months now, retail sales have been declining consistently for 13 months. And in February, they were down 44%. We're also seeing a very significant drop-off in tourism, which is a big part of the local economy. Visitor arrivals are down more than 95% as we speak right now. So that's playing a big role. So this collapse in visitors and tourism from across the border and from around the world is going to have a continued impact on, particularly on the hotel industry, food and beverage, and on the retail sector very clearly. And that's playing through into declines in office prices, office rents, retail rents, and so on. New business registrations are down about 20%. So you're seeing medium-term problems that have been around for about a year have now been exacerbated by the coronavirus.
Does that tension with the mainland also, in a way, minimize the amount of upside benefit that Hong Kong is likely to get from a China recovery?
Well, if you think about the Hong Kong economy as a warrant on the China economy, if you look at it that way, because the Hong Kong economy is highly dependent on trade, on capital flows, and highly dependent on the China economy, everybody's expecting that the China economy will rebound in the second half of this year. And I think the consensus figures are that the economy will grow by 1 to 2% on a year-on-year basis for 2020. Most of the rest of the world is going to be negative. So in that respect, Hong Kong will benefit from any recovery we see in China, albeit a very fragile and weak recovery. So Hong Kong, in a way, is well positioned to benefit from that expected recovery in China. So I think in some respects, Hong Kong can see itself as fortunate in that regard.
U.S. lawmakers now calling on the president to review Hong Kong's special trading status. Are you concerned about this?
Not particularly. I don't really think it's going to be a big issue. Hong Kong is going to continue to be a trading hub for China. It's going to continue to be the financial center where China companies raise capital in the international markets and so on. So I think those functions will continue, and they exist outside of politics in a way. Hong Kong still exists and will continue to exist as a capital-raising center for China, where many companies raise capital both in the equity markets and the debt markets through Hong Kong, and it's still the biggest source of foreign capital for China is still through Hong Kong to a very large extent.
But for how long? We have seen Beijing's efforts to continue to open up the financial markets in China. Will Hong Kong's importance in the financial markets just continue to decrease, especially after the coronavirus outbreak and, of course, the ongoing political tensions?
Yeah, that's correct. You're certainly seeing Shanghai is trying to open up its debt and equity markets. But the big issue that I think will limit the way in which that can happen in China is that China still has extensive capital controls. And that I think will inhibit the way in which China's own capital markets will evolve. Certainly in the domestic market, we're going to see a big expansion of local debt markets and local trading within the existing framework within China. For example, most of the stock market in China is dominated by retail investors. The institutional investment scene is very young and very new. That is going to grow substantially in China, and also we're going to see that institutional investment flows, I think, head offshore as well. And so I think places like Singapore, Hong Kong, London, New York will benefit from that those increasing international flows.
Peter, in a place where the wealth and poverty gap is already extreme at the best of times, how much concern is there when it comes to the welfare safety net as we see unemployment become such an issue?
That is a very big issue in Hong Kong, as you point out. It's fair to say that the wealth gap in Hong Kong is one of the highest in the world. The Gini coefficient, as it's measured, is one of the worst in the world. And so yes, that is a very important factor. There is not a well-developed social safety net in terms of unemployment, but on the housing front, something like 50% of the total population lives in government-subsidized housing of one form or another. So in some respects, there is some kind of social net, but when it comes to unemployment, education, and that kind of thing, Hong Kong is much less well equipped than many other developed societies, for example, around the Pacific Rim and the UK, Europe, and the US.
Is Hong Kong in real danger of losing its position as being, the gateway to Asia, the premier financial and commercial center of Asia, or has it already lost that, given what we've seen in the last 7 and 8 months?
Well, there's always that risk. I mean, for example, Singapore has been developing its own financial services center very, very strongly and very, very well. Over recent years, they have developed certain aspects of the financial services industry which perhaps Hong Kong has lagged behind in. For example, in financial technology and the establishment of real estate investment trusts and various instruments like that. Singapore has moved ahead from other cities in the region. However, Hong Kong still is the second or third biggest source of capital raising as a stock market in the world, and that oscillates backwards and forwards between London, New York, and Hong Kong. That role has not really diminished fundamentally over the last couple of years. Some years, some months, it might be London, some might be New York, but basically Hong Kong is ranked up there in the top 3 or 4 in the world. It's also the 3rd or 4th biggest stock market in the world. So I think it's still up there, but you're absolutely correct. There's always competitive forces operating somewhere that can undermine and take business elsewhere. So Hong Kong does have to watch out for its back on these fronts.
Peter, always a pleasure to have you with us. Peter Churchhouse, Hong Kong General Chamber of Commerce Economic Policy Committee member and Portwood Capital MD with us there. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers, you can get it at Daybigo on your terminals. It's also right there on the mobile in the Bloomberg Anywhere app. You can customize those settings so you just get the news on the industries and the assets that you care about. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
And we have breaking news at the moment on the Bloomberg. The U.S. Treasury Department is temporarily postponing certain tariff payments for 90 days. This coming as a proposal was pushed by some businesses to delay payment of certain tariffs by 3 months. But the order doesn't apply to Chinese goods or duties on metals. The U.S. action doesn't apply to anti-dumping, countervailing duties. Also, they don't apply to Section 201, 232, and 301 trade remedies. In other words, those would be the tariffs that President Trump imposed as a result of enforcement actions such as on Chinese goods or steel and aluminum from around the world. Still, as businesses pushed for delaying payment, the U.S. Treasury temporarily postponing certain tariff payments for 90 days.
Well, the son of the founder of top Singapore oil trader Hin Leong says the company hid about $800 million in losses in futures trading, suggesting that a much bigger hole is in the company's finances than first thought. Let's get straight to Bloomberg's Haslinda Amin for the details. Haslinda, curiouser and curiouser, what's the latest that we know here?
Well, Heidi, this all shows how quickly the situation is spiraling amid this oil rout, the challenge companies are having in reaching some sort of agreement with so many lenders. From what we know, of course, when we talk about Hin Leong, it is one of the largest suppliers of ship fuel in Asia, and people familiar say that it filed for protection on Friday. They say it owes more than 20 bankers about $3.8 billion. And the thing is, Heidi, it's not just Hin Leong itself in trouble. Its affiliate, Ocean Tankers, also filed for protection. And from our reporting, we know that HSBC is among the lenders. HSBC had talked with Hin Leong just last week about shoring up its finances. Some of the banks, were told, pulled out their credit lines on concern Hin Leong won't be able to pay its debt. And according to people familiar as well, other banks with exposure include DBS, OCBC, UOB, Standard Chartered, Deutsche Bank. Heidi, it's a developing story, not looking pretty.
What does this mean for Singapore then?
Well, it's not great news. It's rocking the oil market in Singapore. Sherry, you may know this is one of the most important oil markets in the world. It's also a shipping hub. And over the last 3 years, Singapore has seen the collapse of two other big names in the industry. You know the Noble Group, Agri-Trade. Noble imploded, racked up millions in losses. The thing is, it's not just the oil business, also the banks. NPLs will be an issue. Bankers increasingly reluctant to give commodity traders in Asia the credit line they need to survive. They're concerned about the risk of a catastrophic default. And unless the companies have deep pockets, they run the risk of being frozen out of the market. Bankers demanding pretty crippling terms. This is Singapore. The thing is, Singapore's not the only one of concern. You have to look at London, Geneva. They should be watched as well for the fallout.
Haslinda Amin, thank you, joining us from Singapore. Let's now get a quick check of the latest business flash headlines. Canada's Administration Couche-Tard is walking away from a $5.6 billion deal to buy Caltex Australia because of the economic uncertainty caused by the coronavirus. Talks on the deal began late last year, with an initial offer being lifted by $130 million. Couche-Tard says it plans to re-engage once there is clarity in the market and says it still sees Caltex as a good strategic fit. Australian miner South32 says it's suspending its current share buyback program as it reported production for the fourth quarter. It's also lowering its capex guidance for the 2020 financial year to $500 million, including cutting its greenfield exploration target by up to $20 million. South32 reported lower production of coal, silver, and lead last quarter, while zinc and nickel output increased.
Sherry, let's take a quick look at our markets are trading at the moment. Pretty mixed up when it comes to the state of Asian markets. We've got Japanese markets seeing downside of about 0.6%. In Australia, we're off our session lows, but still off by about 0.1%. That's it for Daybreak Asia. Our markets coverage continues.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
Shanghai and Singapore. Welcome to Bloomberg Markets China Open. I'm Selena Wang.
I'm Rashad Salamat. We're counting you down to the start of the trading day right here in Hong Kong and on the Chinese mainland. Let's have a look at our top stories. President Trump turning on China, overtly questioning if the coronavirus was deliberately released. Just 2 months ago, the president was praising his counterpart in Beijing.
Oil extends its slide in Asia, trading at near 2-decade lows, with the OPEC Plus output curve seen as doing little for the global glut. The virus continues to drag on demand.
And a new battleground between the United States and China. Washington protesting against the arrest of pro-democracy activists in Hong Kong.
We got China's economic data on Friday showing the first contraction in decades and showing just how long this haul is going to be for recovery. And just hours after that announcement, Chinese leaders pledged more stimulus. And in just a half hour's time, we are expecting to see a fall in that LPR. Rish.
Yeah, looking for a 20 basis point fall on that loan prime rate. Just have a look at what's going on with the markets at the moment. Just seeing the open in Taiwan, seeing what's going on also as far as the Singapore market goes. Singapore now the worst affected Southeast Asian nation with regards to the virus. The SDI, they're moving up upside there for 1/10%. Also seeing some gains in Taiwan, which has just come on stream as well. That's up by about 36 points. Looking at what perhaps is put out a little bit of consternation, maybe add a bit of sogginess to the markets. And that's the futures on the S&P. Just a moment flat. To a little bit lower. And again, talking about flat, but a little bit higher, we're looking at the Chinese futures. Elsewhere, oil at the lowest levels that we've seen since 2001. That's making itself felt, certainly. And certainly making itself felt not necessarily with regards to the Malaysia KLCI, which has just come on board, just about 0.5% higher. The ringgit just a tad weaker, and looking at the Australian market, which is depressed by 0.25% there as well. Aussie dollar, they're trading on at 63.4 US cents. Really at the moment, we've got Asian stocks just generally mixed. We've got investors looking towards a busy week again. Corporate earnings very much in focus. We've got also signs perhaps of optimism with regards to the spread of the coronavirus too. Fewer daily deaths reported in Italy, Spain and the UK. So that's currently where we are with it. Selena.
President Trump has suggested that China may have deliberately caused the coronavirus pandemic, saying there would be consequences if the country is found to be knowingly responsible. China hit back, accusing Washington of trying to shirk responsibility over its own failures. Bloomberg Markets co-anchor Tom McKenzie joins us now. So, Tom, another ratcheting up of tensions between the two countries over the handling of the coronavirus. What does this mean?
Yeah, this is right. So we heard from President Trump on Saturday, as you say, outlining what he says would be consequences if China is said to be, and as we quote, knowingly responsible for this pandemic. And of course it is, as Rish was saying, a U-turn for the U.S. president, who as recently as February was praising China's handling of the coronavirus. Now he says the administration is investigating China's role, while Deborah Birx, who's a member of Trump's coronavirus task force, said on Sunday that the first country exposed to a pandemic has a, quote, moral obligation to be transparent in its response. But it does tie into, as you say, that broader effort by the Republican Party to blame China for a disease that's killed almost 40,000 Americans and has left Trump facing criticism at home, of course, over his handling of the virus.
Tom, tell me something. What's you just alluded to the reaction from Beijing. What are they actually saying here?
Well, there was an editorial in the state-backed Global Times tabloid accused the Trump administration of trying to shift the blame over what it characterizes as a botched U.S. response to the virus. The editorial described the U.S. response as being that of a, quote, primitive society. It described the administration's handling of the disease as miserable. It accuses Trump and his team of trying to win re-election by, quote, stepping on China. And it is a reminder that rather than bringing the U.S. and China closer, this disease is just exacerbating those existing tensions and mistrust between the US and China. We also heard, by the way, from China's Foreign Minister Wang Yi, who spoke to the head of the World Health Organization. He reiterated China's support for that UN agency, said that the attacks on it were baseless, and promised that China would step up its support for that agency.
And Tom, what is China doing to better understand the spread of this disease? There were some reports of increase in testing.
Yes, so there's been an increase in testing. I mean, there's particular concern around secondary waves of this virus, particularly around the China-Russia border as Chinese citizens return to the country. That's one part of it, and there's increased testing on anyone, of course, who wants to travel to Beijing as well. The capital very much trying to be protected by policymakers here. But China's also starting a serological survey. That involves researchers taking blood samples from thousands of people to see if they generated antibodies to fight the virus. That would, of course, be a sign that they've been infected. Now, those results should allow scientists to get a clearer picture just of the magnitude of the disease's spread in the broader population here. It may also give them some information on just how the virus is transmitted among people, including less affected groups like children. Now, of course, it comes as China pushes back against that criticism from the US and the US intelligence agencies, their reports suggesting that China concealed the extent of the virus. China has pushed back on that, but clearly there is concern, not just in the US, but broadly about China's numbers. And so this is part of trying to address that, as well as trying to get a better grip of how far this has spread. They have, of course, China in the past revised their data a number of times. The latest was last week when they added another 1,200 deaths to their official count. So it is part of that effort, as well as trying to get a clearer picture, as we've said, of just how far this disease has spread here.
Good stuff, Tom McKenzie there for us, a Bloomberg Markets co-anchor in Beijing. Let's move on to news which is just breaking a short while ago. United States announcing a 3-month moratorium on duties on certain goods. With that story and the rest of the First Word news, here's Karina Mitchell in New York.
Thanks, Rich. The Trump administration is temporarily halting certain tariff payments, although not the high-profile duties targeting China. The decision doesn't apply to anti-dumping or countervailing measures of the Section 201, 232, or 301 tariffs. That means action against Beijing on steel and aluminum imports and against Airbus all remain in place. The relaxation on tariffs will last for 90 days. Meanwhile, virus cases in India have surged with 1,400 new infections, taking the total above 16,000 as the nationwide lockdown enters a 4th week. Confirmed cases have been rising as India steps up testing, with known infections up 78% in the last week. However, doctors say the true number is far higher, with only 370,000 of India's 1.3 billion people tested so far. And Indonesia is tightening virus restrictions, extending curbs on millions of people in the main island of Java as infection numbers rise there. The new regulations will affect about 9 million more people as the virus continues to spread. Indonesia has recorded the biggest daily increase in cases since numbers were first reported, and the government has widened restrictions to cities surrounding Jakarta. Western Europe is reporting a decline in pandemic cases, meanwhile, with the fewest confirmed deaths in several weeks. Coronavirus fatalities in Spain rose by 410 to just over 20,000, the smallest one-day climb since March 22nd, while Italy reported its fewest deaths in a week, and France said deaths rose at the slowest pace since the end of last month. Data from Germany and the UK also show an improvement. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
All right, let's quickly just check on one of the big stories today. It is the oil price heading in one direction, it would seem, in one direction only, and that's in a southerly one. There you go. We have at the moment oil trading $14.72. That's WTI crude futures for May. Looking just only at oil extending that slide at one stage below $17 the barrel. We have at the moment the world rapidly running out of places to store crude, and that's even after output cuts have proved insufficient to cope with the demand side of things, which is really seeing a big plunge. That's currently where we are with it. Oil in New York falling below $15 a barrel, and that's the first time we've actually seen that since 1999. That is currently where we are with that. This is a story we're monitoring, and Selena, indeed, is one we've got our eyes firmly on.
Yeah, first time since 1999 and still ahead on Bloomberg China Market Open once in a lifetime. Goldman Sachs sees China's full-year GDP growth at 3%. We'll hear from the chief Asia-Pacific economist, Andrew Tilton, on the impact of the virus outbreak. And we'll also dig into China's LPR with CICC Managing Director and Senior Economist Eva Yi. This is Bloomberg. You're watching Bloomberg Markets China Open. We're just a few minutes away from the open of trade in the Chinese mainland and Hong Kong. And right now we are joined by Andrew Tilton. We'll be discussing how oil in New York is falling below $15 a barrel for the first time since 1999. Oil extending its slides in these unprecedented moves, going downwards in one direction. So let's get more from Goldman Sachs Chief Asia Economist Andrew Tilton. Andrew, we were just talking about right before the show began that this might be good news for Asia. So why is that, and what does it mean for the rest of the world?
Well, it's certainly been a huge global spillover from the coronavirus shock, the drop in oil prices that we've seen. The good news is that at least for Asia, almost all the region are net oil importers. So this is actually a partial offset to the income shock coming from the coronavirus. So that, I think, in and of itself is good news. It certainly won't be enough to offset the disruption in economic activity that we're going to see in late Q1 and early Q2, but it's a net positive for almost every country in the region outside of Malaysia, which is obviously a net oil exporter.
And in terms of how far down these moves are going to go, I mean, what are your expectations here?
Our commodity strategists do see short-term downside simply because of the lack of storage capacity on the oil front. Ultimately, that'll result in reductions in production, which will rebalance the market. And so they actually see the possibility of upside to their forecasts in 2021. But at least for the next few months, we're going to be dealing with, we think, very, very low oil prices. And I think, of all the countries in the region, it's probably China and India that are going to benefit the most from this. Both of these countries have inflation that's higher than they'd like at the moment. And so the drop in oil and fuel prices helps to alleviate those pressures.
Andrew, doesn't it fundamentally just go to how big the demand fall-off has been? Essentially, that dovetails into probably how you look at the global economy, and indeed, what, as an economist, see is perhaps something you've never seen before.
Yes, I think it's a measure of just how abrupt the economic shock is that we're seeing. It's unprecedented, really, in our lifetime. This kind of physical disruption to economic activity brought about by social distancing and other measures. So, in fact, with respect to the oil market specifically, producers don't want to shut in wells and do things that'll cost them in the longer term. Everyone is hoping that someone else will cut supply and cut production so they don't have to. But our views are that ultimately we're going to need to see meaningful cuts simply because of the scale of the demand shock. And while we do think that the global economy can pick up in the second half of the year, we still have to get through what's going to be a very difficult second quarter on the demand side first.
And an inventory drawdown as well, which will probably mean that oil prices will remain depressed. That's one way of looking at it. But people are talking about the post-COVID world and how things have changed. How do you see that? I'm not just saying about oil, but are certain industries just not going to come back and new ones grow when you didn't expect them?
I think one of the most interesting ramifications is going to be, as you said, what the industry structure looks like. Unfortunately, this shock has been very deep. It's very disruptive, particularly for a lot of SMEs, service sector-oriented economies, businesses that simply don't have revenues at the moment. If we see a reduction in the number of businesses, closures, bankruptcies, we could ultimately end up with a situation where we have more industry concentration, a higher profit share, essentially a shift from labor where unemployment is going higher and wage pressures will probably be to the downside, to capital where you could have a greater industry concentration in the future. I think the oil market is a bit of a microcosm of that. You're talking about potential for significant reductions in supply. In the short term, there's a lot of downside pressure on prices, but as you look into 2021, if that supply has been taken out and demand comes back, you could actually have upside pressure on prices. So while that is probably an extreme version of what we would see elsewhere, I think there's the possibility to see that kind of dynamic in some other sectors of the economy to some extent over the next couple of years.
Andrew, taking a brief moment to look at the yuan fix coming in at 7.0657 against the US dollar. That's slightly stronger than expected after multiple days of weaker than expected fixes. Offshore yuan currently trading weaker at that at 7.0823. So Andrew, we got that GDP data from China and that March activity data on Friday. Does that data in any way change your outlook for China's recovery for the rest of the year as well as the rest of the world's?
Not too much. I think clearly we knew the first quarter in China was very, very weak. It turned out to be minus 6.8% year over year. That puts the official growth target reported to be around 6% out of reach. And I think the question now for policymakers is whether they cut that or scrap that target altogether. But I think the more encouraging thing in the reports Friday was that some of the March data look meaningfully better than February or the January-February combined data that were reported. In particular, the industrial production numbers are down only about 1% year over year. I think that directionally is consistent with what we've seen in some of the high-frequency daily and weekly data, which show the industrial sector improving relatively faster than the services part of the economy. So we think those supply-side disruptions are being resolved. The issue for China and for the industrial sector globally in Q2 is going to be the demand economy slowing down really sharply. So I think the message for the read across for other countries is you can perhaps initially come back relatively strongly as some virus control measures are lifted, particularly in the industrial sector where social distancing probably isn't as much of a challenge. But normalizing the services sector may take somewhat longer as fears about a resurgence in the virus linger.
Andrew, do you think Chinese authorities should be doing more to address that demand side, looking at the loan prime rate out in just over 10 minutes from now, looking at a 20 basis point cut there? Do you think they need to be doing more in terms of reducing the actual proper headline interest rate, benchmark rate, I should say?
Well, we think we do need to see more stimulus. I think the authorities took the tack of first focusing on controlling the virus. After all, the best stimulus is controlling the virus. If people aren't worried about that anymore, they can go back to something approximating their typical behavior. So that's the first order of business. In terms of more traditional macro stimulus, the authorities focus first on providing liquidity and starting to bring down rates. As you pointed out, some interest rates have come down more than others. Repo rates have come down quite a lot, so well under 2%. But lending rates to the real economy have moved less. And I think some of the tone of the Politburo meeting last Friday suggests that there might be some more room for movement there, and we would expect to see reserve requirements and probably lending rates come down a bit more in coming months, particularly now that inflation's starting to come lower. But we really think fiscal policy will be doing a lot of the heavy lifting going forward.
Order submitted. Order submitted.
Thank you so much. Thanks again to Goldman Sachs Chief Asia Economist Andrew Tilton. Quick look at oil, because it is the big story at the moment. Fell below $15 a barrel. We've just recovered, slightly above that at the moment, looking at the WTI contract here. Fears about how badly demand is being affected, looking at an inventory glut here as well, and near-term prices for WTI West Texas Intermediate. Of course, that being the American benchmark. Then huge discounts to later dated contracts. There are concerns about what happens with storage. And for one thing, where oil is often, WTI is priced, is in Cushing in Oklahoma. There are fears that that storage hub is going to fill to capacity. That's one of the reasons why we're seeing this huge disconnect from what is happening with Brent futures, which at the moment are in London trading on the futures, $27.77. So in marked contrast to what's happening elsewhere. So there we have it. Let's tell you that we've got a lot more on the way. We're going to be looking at, of course, the mainland markets as they open up for business, looking at the currency markets as well. But oil is the big story. This is Bloomberg. Right, we're just minutes away from the start of the trading day right here in Hong Kong and, of course, mainland China. Let's have a look at what we are watching for. David Inglis is in Hong Kong. David, it's about oil, isn't it? And we've also got this fallout from the Singapore oil trader Hin Leung. Tell us about this, if you can just wrap it all up.
Yeah, well, the story on the oil trader in Singapore, Hin Leung, has been around for about 4 weeks. It slowly unraveled, and of course on Friday what it did was it filed for protection against creditors as well. Now, what it does point is the overall oil story as well, and the exposure, particularly of Singaporean banks and the banking system there. We've seen that in previous earnings reports, a little bit lower across some of the names there, like DBS, for example, although in this specific case, it is HSBC that said, according to our sources, said to have the biggest exposure to that specific company. I think it's $600 million. But yes, this is one to watch moving forward as well, because this plays into the oil story. It plays into the economic story as well, especially since this is a private company. It obviously becomes a banking story as well with that type of exposure, Rich and Zelina.
And David, we've got about 300 companies reporting on the MSCI Asia this week. Anything that you're watching in particular on the earnings front?
Dividends, I think that's going to, or cash management, let's put it that way, will be the main thrust of what I'll be tracking as well, and how they manage their cash. You know, who do they prioritize? You talked about creditors earlier, right? Is it investors? Is it operating expenses? Are they going to bring down fixed costs? That sort of thing as well. Now, in terms of the forecast here, forecasts for Asia have been down 10% year to date, 7% on MSCI China, about 22-23% on emerging markets. So not all earnings are created equal, so to speak here. The pace, though, of downgrade in Asia has eased, and it's clearly, at this point, it's still consumer discretionary shares and energy sector on a sector basis that have seen the biggest cuts in forecasts.
David, we haven't got much time. Loan prime rate out very, very soon.
Yeah, fall of 20 basis points is what Bloomberg Economics is expecting inside a couple of minutes.
Yep, absolutely. Thank you so much. David Ingles there for us right here in Hong Kong. Just looking for that as well, just looking at what is at the moment turning out to be a fairly mixed trading day. The big story, of course, concerning what's happening with the oil price. To tell you what we have now is WTI trading on the New York futures, $15.87 the barrel. Looking at that, that's, of course, really making itself felt with probably the oil stocks when they start off trading on mainland Chinese markets and right here in Hong Kong as well. So a look at what's happening in Hong Kong. That is Hong Kong. This is Bloomberg. The market open is next.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications.
Order canceled. Order submitted. Order filled. Order submitted. Order submitted. Order submitted.
This is Bloomberg Markets China Open. We are heading for the start of the trading day in Hong Kong and indeed in mainland China as well. It's all amongst a backdrop of oil prices being at lows not seen for 21 years. We've also got the US coming out and saying that they may well have a moratorium for 90 days on certain tariffs. On top of that, and just a few seconds away, is the loan prime rate, which is going to be set by Chinese authorities. Selena.
That's right, Rich. We're expected to see a 20 basis point drop as China tries to stimulate its economy after that very poor GDP data we saw on Friday, the lowest in decades. But we didn't really see markets react too much to that data on Friday, since markets were largely pricing that in. And in fact, on Friday, we saw all of China's major indexes actually hold on to those gains. As we look at the open today, we are seeing green across the screen, except for the CSI 300 down almost 2.4%. This is also after on Friday we saw China actually revise its official death count up almost 40% to 4,632. And now we take a look at that loan prime rate. The loan prime rate at 3.85%. That is tracking with what we expected, a 20 basis point drop from 4.05% from before. In terms of the 5-year loan prime rate, also tracking with estimates, a 10 basis point drop to 4.65%. This is all after China actually unexpectedly held the LPR steady in March. We're not seeing too much of a reaction yet in terms of the market. CSI 300 still down, now more than 2.4%, so increasing those losses. Now switching boards here, taking a look at the yuan. We saw the yuan fix come in actually stronger than expected after several consecutive days of weaker than expected fixes. We are now seeing that trading range, pretty range bound, right now at 7.0845, weakening ever so slightly. Now switching boards here, taking a look at that 10-year yield. We did see several straight days of declines, and we saw the yield slightly pick up, but the yield has also mostly remained range bound without significant movements for more than a week so far. Chinese authorities have been relatively restrained in that stimulus, giving traders pretty few incentives to either buy or sell. Rish.
Right, yeah, absolutely. Let's quickly look at what's happening with further afield, and Hong Kong's market just came on stream as well. Slightly to the upside at the moment. In fact, we've given up the gains that we did see, and as you were just mentioning there, Selena, the loan prime rate being cut by 20 basis points on the 1 year and 10 basis points on the 5 year here too. Asian stocks, generally speaking, are mixed. There we go. The Nikkei just taking back some of the gains that we saw on Friday. Hang Seng turning negative, and we've got a big drop there on the CSI 300, 2.5%, as Selena was alluding to. Let's just switch and have a look at some of the movement on the commodities markets, and certainly what we have at the moment is this massive fall in WTI crude, $15.90 a barrel. You heard that right. We're also seeing a huge spread here too with Brent. I think it's the biggest spread that we've seen since 2014 with regards to that. But don't forget that a lot of the forward contracts which switch in a couple of days are much higher price than that New York crude price at the moment, $15.86. We've got others which are much higher than that. That's where we are. Let's get reaction to what's going on and bring in CICC senior economist Eva Yi. Now, tell me, let's first of all get your reaction to, not the oil, we'll come to oil in a second, but the loan prime rate cut by 10 basis points on the 5 year and 20 basis points on the 1 year. Pretty much expected here. Does it move the dial for you as an economist?
I mean, to be honest, this is, it's been foretold by the 20 bips reverse repo rate cut, and then again the 20 bips MRF rate cut earlier in the month. So there's no surprise for the 1 year rate. The 5 year rate was something I was watching more closely at this time because it shows whether the government is more or less willing to, loosen demand side policy for property versus, the demand side policy for the rest of the economy. It looks like they're still less willing or more reluctant to loosen property-related policies than that for the rest of the, demand side policies. That's what I'm seeing, from this type of a rate cut. But overall speaking, I think LPR, although an integral part of the monetary policy tool, and in China's so-called hybrid system of monetary policy conduct, price mechanism doesn't work as effectively or directly as the direct quantity control on loan issuance or money supply, which the PBOC can do through increasing relending or cutting RRR, and these have been down much more in terms of boosting TSF growth than
order
LPR
filled.
has.
Order submitted. Order submitted.
Eva, what
order filled? Order submitted.
Something that
order
you said
submitted.
The response this time has been very lukewarm compared to what we saw in 2008 and 2009 and the massive stimulus that many people actually credited for saving the world economic system at that stage. It's much, much more frugal this time around. Is China unable to afford it or unwilling to pay for it?
I think it's really just a short-term versus long-term kind of a balance. The response, first of all, I think the optics of this time in terms of the relief, economic relief, pandemic relief package, they're making it much less, out there than it was in 2008 because of all the, after effects we were suffering from the large quantity of money and credit supply in 2008 and, some of the not so profitable infrastructure investment and so on, and the burden it had on the banking system. And this time, overseas economy reacted much faster, especially the U.S. in terms of loosening. So in terms of overall global loosening effort, I see it pretty much on par in 2008. It's just that the leader in this loosening, it appears to be the U.S. more than in China. But in China's sense, although they're less vocal about an outright loosening, but the relief effort in terms of relending to SMEs, cutting fees, exemption for tax, and so on has been quite effective in the first quarter, and the damage to the economy, be it from the pandemic directly or how much it was cushioned by the savings rate. Therefore, there's less imminent bankruptcy fear in China. Those factors also contributed to a more lukewarm kind of policy response compared in the West, where savings was very thin. They had to do something very quickly and in a large scale.
Eva, you said those stimulus efforts were pretty effective in the first quarter, but how effective is that ammunition going to be moving forward, considering this continued weakness in terms of global growth and China's major trading partners?
Yeah. I think during the loss of demand and supply during the lockdown in China, as well as in many of the countries in the rest of the world, it's hard to combat or make up for it with policy stimulus at the time. But ever since mid-February, China has been pushing for production resumption on a centralized level and on a provincial level quite effectively. China's production resumption rate, as we track, grew from 30% to 90% in just a month and a half, which we expect should outperform that of the rest of the world, should it come in the third quarter. But from second quarter onwards, after we had a simultaneous recovery in both export and domestic demand sectors, from second quarter onwards, we should see continued support for domestic demand policy, especially urbanization-related FAI and consumption. While export demand might see even an even bigger hit than we did in the first quarter. They should diverge quite substantially. But from a domestic demand point of view, because a lot of the policies are still waiting to come out after the MPC, including the special treasury, expansion of fiscal budget deficit, local government bond quota expansion, and so on. And we're coming into the peak season of infrastructure investment as well. So we should see these leading the charge in domestic demand recovery. And consumption should lag a little bit, but it shouldn't be absent in the ongoing recovery as well.
That's right. According to our Bloomberg estimates, work resumption rates are almost back to normal, more than 90% now. And compared to China, how do you see the rest of the world ramping up production, recovering in terms of the timeline and how deep that lag is going to be?
So if you're looking at the evolution of the pandemic, I think U.S., in terms of the outbreak, U.S. and Europe are about 1 to 2 months behind versus China. But in terms of the peak of daily additional confirmed cases, they're about 2 to 3 months lagging that of China, meaning, since the containment measure, the time lag between the implementation of the containment measure to the peak of the pandemic in terms of daily additional cases is taking longer because of course, the more realistic assumption of, different government actions and different public reactions to it. And in terms of production consumption, if it starts in the third quarter, we expect it to take about twice longer as it did in China as well, mostly because after such a big shock to corporate cash flow in their very vulnerable state, in that sense, there is a distinct second mover disadvantage to production resumption. It's, if it's the supply chain or the service industry, nobody wants to, be full on back to production before demand or their upstream and downstream comes back. In that sense, China was able to organize SOEs and local government to resume production right after Chinese New Year, which jump-started the process. In the rest of the world, we expect it to be a more staggered process that lasts 2 to 3 months.
Eva, thank you very much indeed for that. Eva Yi there from CICC. Just going to move along and get you up to speed with these criticisms and accusations coming out of the White House directed at Beijing. That and the rest of the First Word news coming from Karina Mitchell in New York now.
Hey, Rich, yeah, President Trump has performed a dramatic U-turn on the coronavirus, saying China may have deliberately released the infection. Trump's now including the threat of punitive action if investigations prove the virus was unleashed by choice. Only weeks ago, the president was praising his Chinese counterpart for the way the outbreak had been handled.
The question was asked, would you be angry at China? Well, the answer might very well be a very resounding yes, but it depends. Was it a mistake that got out of control, or was it done deliberately? Okay, there's a big difference between those two. In either event, they should have let us go in.
China says testing of people showing no symptoms of the coronavirus infection reveal only a tiny fraction are actually suffering. The samples were taken in Wuhan, the city where the virus was originally reported, and where fears of a second wave of infection have been rising. More than 250,000 tests were taken this month, and less than 0.1% are said to have been positive. Meanwhile, Iran is calling on the International Monetary Fund to resist American pressure and approve financing to help alleviate the coronavirus impact. Tehran asked the IMF on March 6 for $5 billion to shore up an economy already battered by U.S. sanctions and falling oil prices. Washington has said it will block the application, but the IMF's regional director says the request is proceeding. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Thank you so much, Karina. And we have plenty more ahead, checking on those unprecedented slides in the oil market. This is Bloomberg.
Order canceled. Order canceled. Order canceled.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure.
Order
23
submitted.
traded
Order
commodities are
submitted.
represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Order filled. Order submitted. Order submitted.
We're back. This is Bloomberg Markets trying to open, looking at what's going on with the oil price extending its slide, falling to the lowest in more than 2 decades. Concerns about the world rapidly running out to store crude, one of those. We've got OPEC plus output cuts, perhaps inefficient to cope with what's going on with this demand side of the equation. And it's a demand story which is just showing how people are not buying oil and people are not buying petrol, and that means the demand has fallen off a cliff. Let's get to Fat Profits resource analyst David Lennox. David, we could also talk about some of these later dated contracts being actually not reflecting quite the price fall that we've seen at the moment.
Order
the current
filled.
main contract
Order
expiring
submitted. Order
tomorrow.
submitted.
Tell us about your view of the oil complex.
Oh, look, there's no doubt about it that the world is very concerned about the demand side of the equation. We are seeing in the vicinity of something like between perhaps 25 to 30 million barrels of destruction of demand given the COVID-19 pandemic. And the unfortunate fact is that we're at this stage not able to see any indication as to when that demand destruction may start to improve, primarily because we probably haven't quite hit the peak of the pandemic globally. So while that is still in play, the oil market is going to struggle. Yes, we have seen an adjustment being made to the supply side with OPEC and its allies suggesting that they will make cuts. But of course, at this point in time, we actually haven't seen those cuts come in. So the market's sort of stuck in limbo. Demand has been very weak, and we're still awaiting some real supply reaction to that demand.
And David, that Brent WTI spread is now at a 2015 high. How far do you expect that divergence to go?
Look, that's really quite difficult to suggest. That it's probably at its widest part now. We do think that when you have a look at the two oil types, as in Brent and WTI, yes, we are seeing that pressure on the Brent oil. We were for a couple of years actually seeing the reverse. WTI was well under pressure primarily because US production in that region was rising and quite significantly. We are now starting to see the reverse. It appears as though WTI supply has in fact plateaued somewhat, and yet we're seeing extra Brent coming onto the market because of what's happened with OPEC. So we would think that that spread's now somewhere near its peak, primarily because we can't see WTI or the supply of WTI increasing any further. But there is a possibility that we may see extra Brent on the markets if we don't see those cuts by OPEC complied with.
David, is it really at the moment a terrible strategic error on the part of the Saudis that their plans and their strategies just essentially gone awry?
I guess the rhetoric out of the market is that perhaps they were looking to try and shut down the US shale industry. It's been a bit of a bugbear for them over the last couple of years, with that production, as I said, rising up to about 13 million barrels inside the US. That now makes the US the biggest single producing country. So one would suggest that, yes, they won't ever be able to shut down the US shale industry. What we saw for the last couple of years up until very early this year was that the OPEC and the US tended to be cooperative with each other, and we saw a much more stable market. Certainly we didn't see oil prices down sub $20, which is where we're seeing them now, given that cooperation is completely broken down.
And David, buyers in Texas are now offering as little as $2 a barrel for some oil streams. Are we going to get to that point where American producers may actually soon have to pay customers to take crude off of their hands?
Order submitted. Order submitted.
Look, that will just depend on, as I said, just how long this global pandemic stays inside the US economy, especially. There is talk that perhaps we will start to see some of the states opening up. If that's the case, then there may be somewhat of a pent-up demand, and we will see quite a surge. But at the moment, it really all got to do with just how much they can store and where they can store it. If storage does start to become a real problem while demand remains soft, then primarily we could see the industry completely shut down. And yes, they might actually start paying you to actually take the oil away from the garage rather than the other way around.
David, have you ever heard of a US president actually asking for higher oil prices?
Look, it's a two-edged sword for the US president. Firstly, there's a significant presence in terms of the impact on the state economies and the US economy of the actual industry itself, the number of people that it employs. So from that point of view, internally, the impact of the industry would be significant if it's shut down. And then, of course, yes, if US used to be a importer of oil, so that would primarily have meant that it would have liked to have seen the oil price cheaper. Now, in fact, it's actually an exporter. So it would actually like to see the oil prices at a significantly higher level so that it can generate more revenues.
Order cancelled. Order cancelled. Order submitted. Order
Thanks very
submitted.
much for that. David Lennox there of Fat Profits. Just to tell you what we've got coming up with Hong Kong's Beijing-backed government arresting prominent pro-democracy activists. It's all prompted an outcry coming from Washington. We've got details on that story and more. This is Bloomberg.
Order submitted. Order submitted. Order submitted.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's how we won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
And we're back. The weekend arrest of pro-democracy leaders in Hong Kong drawing sharp criticism from the United States. This after Beijing's representative office in the city asserted its right to intervene in local affairs. Prominent pro-democracy advocate Emily Lau telling Bloomberg Hong Kong could see a resumption of street unrest. Let's get to our chief North Asia correspondent, Stephen Engel. Steve, now you've been covering the protests right from the get-go. This has got quite a lot of significance.
Yeah, potentially it reopens the front line in the feud, of course, that we've seen over the last year between China and the United States on the trade front, and then more recently, of course, on the coronavirus. But Hong Kong being on those front lines, and it escalates, of course, the stakes for Hong Kong at a time when the whole world is fighting the coronavirus. What we saw over the weekend on Saturday were 15 prominent pro-democracy activists, including a current legislator and several current legislators being arrested.
Order
Jimmy
canceled.
Lai, for one, the
Order
Apple
canceled.
Daily founder.
Order
Martin
canceled.
Lee, he founded the Hong Kong Democratic Party. Legislator Long Yu Chung, as well as Long Kwok Hung, he's also known as Long Hair. Also Albert Ho, a former legislator, and of course a pan-democratic activist. The police say they're being held on suspicion of organizing and participating in unauthorized assemblies last year. But as you mentioned, Emily Lau is the former chairperson of the Democratic Party of Hong Kong. She was on Bloomberg Television this morning. She thinks that Beijing perhaps sees this as a golden opportunity, her words, to assert their total control over Hong Kong at a time when the rest of the world and Western countries in the United States are fighting the virus.
And Steve, Hong Kong's latest unemployment figures are due later today. What exactly are we expecting?
Well, it's not looking good, of course. The joblessness rate rose to a near-decade high in February, the previous month, at 3.7%. And the survey for March is for 4%. Of course, Hong Kong has been hit by a triple whammy over the last 3 years, or the last year, I should say, the trade war, the protests, and now the coronavirus, not unlike the rest of the world, of course. It's still not in the territory of the post-SARS environment in 2003 when we saw unemployment surge as high as 8.5%. But again, the Chief Secretary, Matthew Chung, as well as the Financial Secretary, Paul Chan, wrote on their blog post this weekend that the situation for the labor market looks pretty grim. And Chung actually said the labor market will continue to face huge pressure in the short term.
Thank you so much, Steve Engel, our Chief North Asia correspondent, for that update. Taking a quick look at some headlines here. So the Shanghai Stock Exchange, they're looking into the CSI 300 Health Index pricing. So for some context here, in early trading, we saw that index down about 17% when not a single stock in the index was down by over 2%. So we got some information from the media relations employee over the phone, but we will be bringing you more updates throughout the hours on any more information we can hear on what may be a technical glitch. Rish.
Yeah, Sedina, and just to tell everybody what we've got coming up in the next few hours right here on Bloomberg Markets, taking a look at what's going on with the commodity side of things, with oil very much one of our top stories. We've got a look at that side of things. You look at the economy. We're going to have a look at the advancements that are taking place with regards to the testing for the coronavirus here as well. Just a brief update on WTI crude, down 15%.
Order submitted. Order submitted.
53 cents the barrel.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
Order canceled. Order canceled. Order canceled. Order submitted. Order submitted. Order submitted.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. It's almost 10 a.m. in
Order
Singapore and Hong
filled.
Kong. I'm Haslinda Amin. Welcome to Bloomberg Markets Asia.
I'm Rashad Salamat. Having a look at our top stories. President Trump turning on China, overtly questioning if the coronavirus was deliberately released. Beijing hits back, saying it's a miserable U.S. attempt to shirk responsibility.
Order filled. Order filled.
Oil extends a slide in Asia at 2-decade lows, with the OPEC Plus output curbs seen doing little for the global glut. U.S. futures lost a fifth of the value.
Order
last
cancelled.
week.
Order cancelled.
And new questions about top Singapore oil trader Hin Leung. There may be a much bigger hole in the company's finances than first thought, all amid claims of a cover-up.
Order submitted. Order submitted.
Rich, let's take a look at Asian markets, broadly lower today. Let's call it trepidation. As we look ahead to more earnings this week amid a crash in oil prices, the lowest in about 20 years. The CSI 300 index currently slumping by about 2.7%, falling the most since the end of March. It's trading below its 10-day moving average, by the way. Chinese banks lowered the benchmark rate for new loans following a series of policy easing measures, which we saw by the PBOC to cushion the economic impact of the coronavirus outbreak. China's one-year prime rate was cut by 20 basis points. Its five-year prime rate cut by 10 BPS. The Nikkei 225 pulling
Order
back there
canceled.
after that rally
Order
we saw
canceled.
last week. Fast
Order
retailing
canceled.
among blue chip stocks, which are down. Virus infections in Tokyo reached a daily record on Friday. The Hang Seng breaking the trend, tipping just in positive territory, though, of its highs for the day. The STI, we're keeping a watch on banks right now. DBS among laggards. DBS said to be among more than 20 lenders owed by Hin Leung, which filed for protection. People familiar say it owes the banks almost $4 billion. Flipping the page, the Bloomberg Dollar Index up by 0.2%. It does look investors are looking for haven plays. We have New York crude currently down by 13%, 15.87, and gold lower as well by 0.3%, 16.93. Rish.
Right, yeah, but we've got also President Trump upping the ante, suggesting China may have deliberately caused the coronavirus pandemic, saying that there would be consequences if the country is found to be, quote, knowingly responsible. Beijing hitting back, accusing Washington of trying to shirk responsibilities over its own failures. We've got Bloomberg Markets co-anchor Tom McKenzie in Beijing. Tom, another move to ratchet up tensions between the two nations over the handling of this pathogen.
Absolutely, and it's quite a remarkable U-turn for the U.S. president, who as recently as February was praising China's handling of the crisis, the coronavirus crisis, in quite emphatic terms, you'll remember. Now Trump, as you said, seeming to suggest that the Chinese may have deliberately released this coronavirus, saying that if they were knowingly responsible, they would face consequences, which he didn't detail. But we also heard from others in his administration over the weekend, including Vice President Mike Pence, but also the Deborah Birx, a member of the Trump administration's coronavirus task force. And she said on Sunday that China has a, quote, moral obligation to be transparent in its response. And it does tie into this broader effort, particularly by the Republican Party, to blame China for a disease that, of course, has killed almost 40,000 Americans now and has left President Trump facing criticism over his handling of the virus.
Tit for tat yet again, Tom. How has China reacted?
Well, we've had an editorial in the state-backed Global Times newspaper. It accused the Trump administration of trying to shift the blame over what it characterizes as a botched U.S. response to the coronavirus. The editorial describes the U.S. administration's handling of this disease as, quote, miserable, and it accuses Trump and his team of trying to win re-election in November by, quote unquote, stepping on China. And again, it is a reminder that these festering tensions that, of course, have been there now for a number of years between the U.S. and China are only being made worse by the lack of trust, the lack of transparency between both sides when it comes to this disease, who's responsible, and the steps that have been taken by both sides to try and control this virus, and now those tensions seem to be moving ever higher. We did also hear from China's Foreign Minister Wang Yi. He spoke to the head of the World Health Organization. He reiterated his support for the WHO, and he said that the U.S. attacks on that organization were essentially baseless. He also promised that China would step up its support for that UN agency.
Tom, what about China doing much more testing, trying to understand the spread of this disease there too? And ultimately, isn't that a case of stable door horses bolting?
Well, it's trying to get a better grip on just how far this virus has spread here, and of course it's very concerned about secondary waves, and we've seen that in terms of the China-Russia border, where there have been a number of cases of Chinese citizens returning from Russia who have been found to be having the disease, infected with the disease. And they have been ramping up tests as well of people returning to the Chinese capital, which they want to protect as much as possible ahead of the National People's Congress parliamentary session. But also they are testing people as part of this serological survey, and that involves researchers taking blood samples from thousands, possibly tens of thousands of people, to see if they have generated those antibodies to fight the virus. And again, this is trying to build out that picture of how far it's spread and the transmission as well. Those results could allow scientists here to get a clearer picture of the magnitude of the disease. And it could give them some information about how the virus is transmitting between certain people, particularly less affected groups like children. So it is part of that effort here in China to build out that picture, as of course they remain concerned about additional outbreaks. By the way, China, of course, has pushed back on those U.S. reports, particularly intelligence reports, that it concealed the extent of the virus. But we do know that, of course, it has changed its numbers. It's updated its virus data a number of times. And the latest time was last week, of course, when they added more than 1,200 deaths to their official account.
Bloomberg Markets co-anchor Tom McKenzie in Beijing. For now, let's get the first word headlines with Karina Mitchell in New York. Karina.
The Trump administration is temporarily halting certain tariff payments, although not the high-profile duties targeting China. The decision doesn't apply to anti-dumping or countervailing measures of the Section 201, 232, or 301 tariffs.
Order canceled.
That means action against
canceled.
Beijing on
Order
steel and
canceled.
aluminum imports and against Airbus all remain in place. The relaxation on tariffs will last for 90 days. Meanwhile, virus cases in India have surged with 1,400 new infections, taking the total above 16,000 as a nationwide lockdown enters a fourth week. Confirmed cases have been rising as India steps up testing, with known infections up 78% in just the last week. However, doctors say the true number is far higher, with only 370,000 of India's 1.3 billion people tested so far. Indonesia is tightening virus restrictions, extending curbs on millions of people in the main island of Java as infection numbers rise. The new regulations will affect about 9 million more people as the virus continues to spread. Indonesia has recorded the biggest daily increase in cases since numbers were first reported, and the government has widened restrictions to cities surrounding Jakarta. Meanwhile, Western Europe is reporting a decline in pandemic cases, with the fewest confirmed deaths in several weeks. Coronavirus fatalities in Spain rose by 410 to just over 20,000. That's the smallest one-day climb since March 22nd, while Italy reported its fewest deaths in a week, and France said deaths rose at the slowest pace since the end of last month. Data from Germany and the UK also show an improvement. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Rish.
Thanks, Karina. Still to come right here on Bloomberg Markets. We've got Pendle Group Portfolio Manager Amy Shea Patrick joining us to discuss markets and foreign exchange strategy. That's on the way next. Later this hour, we're going to be hearing about a new coronavirus test kit coming from the genomics company Lucent. Do stay tuned for our interview with the founder and chief executive there, Tan Min Han. That's later this hour. This is Bloomberg.
Order canceled. Order canceled. Order submitted. Order submitted. Order submitted. Order submitted. Order submitted. Order filled. 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 Order submitted. Order submitted.
Asian stocks retreating, investors looking toward a busy week for corporate earnings, all amid signs of an easing in the global coronavirus spread. Let's go to Sydney and bring in Amy Shea-Patrick, Portfolio Manager from Pendle Group. Amy, thank you for joining us. Give us a broad brushstrokes views of what's going on with the markets. I mean, with oil where it is at the moment, we've got, again, a bit of weakness, generally speaking, for equities in this part of the world. What gives?
Well, that's a pretty big question, Rish. Yeah, as you summed it up, the worst is not over yet. And in terms of the way that it's playing out through the markets, obviously March was a pretty significant month in terms of drawdowns everywhere. But I think as the dust begins to settle and the market looks forward a little bit now, we're thinking about what does the shape of the recovery eventually look like, and what that means for various different asset classes across the world. Now, from our considerations, as you know, I spend quite a lot of my time looking at China, and China has given us a bit of a blueprint in some ways for being the first into the COVID crisis,
Order
but also
filled. Order
possibly
filled.
the first out of the COVID crisis. But even with the China data, as you saw last week, it's very clear that just because lockdowns start to get
Order
lifted
submitted.
and business
Order
starts
submitted.
to resume, it's not abundantly clear that all the pent-up demand is ready to be unleashed onto that economy, and probably means that looking
Order
forward for
filled.
the rest of the world, and even for regions like Australia, where, you know, I have to put it to the government in terms of doing a pretty good job in terms of getting the numbers of the virus under control the way that it has done. It doesn't necessarily mean that the V-shaped recovery at the other end that was widely talked about when all of this began
Order
a few
filled.
weeks back
Order filled.
is all that certain, and that we can look forward to such a sharp recovery. In my mind, it looks more like a U rather than a V.
It could be a fat U, according to one guest we had last week. But Amy, we've seen stimulus come out. We saw the LPR cut on the 1 year by 20 basis points. The stimulus that China certainly has employed this time is in very marked contrast to the kitchen sinking, as it were, in 2008
Order
and
submitted.
2009.
Order submitted. Order submitted.
Absolutely, and there's so many reasons for that this time, right? Because since 2008 and 9, China, you know, the stimulus that they delivered in 08 and 09 was large enough that it basically prevented Australia from feeling the worst of the GFC. I mean, in some parts of Australia, we barely felt it at all. Since then, China's had to do several rounds of stimulus. You know, it had to provide stimulus when it got caught up in the Euro sovereign crisis. It had to stimulate the economy yet again in 2015 in response to the oil crash and in response to the tightening that it imposed on its own economy and the devaluation experiment that it tried back then. This time, it's simply got a lot less ammunition. You know, there's also a lot less in terms of building that China now needs to do. A lot of that stimulus that was unleashed in prior rounds was on the housing sector, But now that same housing undersupply has, quite frankly, reversed. In some of the largest cities in China, vacancy rates are in the mid-20s to 30%. There isn't a shortage of housing at a national level anymore. And then more importantly, all that infrastructure that was unleashed in those prior rounds of Chinese stimulus have been, mostly put to good use, but there's just a limit to how much high-speed railway that country needs and how many more, freeways and toll roads that country needs as well. So there just isn't that same scope this time anymore as well. And on that point about housing, this weekend we saw a Politburo meeting happen where it was emphasized that the need to put some support under the Chinese economy, it needs to remain. But that fiscal element is very, very much uncertain at this point. What is certain is, as you say, today we've seen some rate cuts. But again, note that the rate cuts emphasize more the liquidity element, i.e. the one-year LPR being cut by 20 basis points, but trying to keep that bulk of credit stimulus away from the property sector. So the 5-year LPR being reduced only by 10 basis points, and not wanting the household sector to go crazy again, investing in yet another property bubble.
Amy, you talked about how China provides a blueprint. What does it mean for EM assets?
Order
Some
canceled.
say EMs will
Order
be the first
canceled.
to recover.
Order canceled.
Others say that EMs will be the next shoe to fall.
That's a really good question. It really does depend a lot on the health infrastructure that exists in a lot of these EMs.
Order submitted.
And obviously, as you
Order
know, even
submitted.
in
Order
the
submitted.
developed markets, it's not been uniform, the experience either. But it also, the way that we, look at EM through the macro lens, it also speaks to the amount of firepower that's available, the amount of fiscal room, both at the sovereign level, but also, for those looking more deeply into EM corporate space, the amount of state support that is available to various quasi-sovereigns and also private corporates that exist across emerging markets as well. So I would say that, EM is, certain parts of EM in Latin America seems, definitely one of the more troubled and more exposed places. The EM experience is likely to be very uneven.
And looking at EM bonds, they seem to be trading at distressed levels.
Order
Anything
filled.
that's looking attractive.
Order submitted. Order submitted. Order filled. Order
in EM
submitted.
bond space,
Order submitted.
the only one that I would really point out is, again, it goes back to China. So, the shape of the recovery we've already discussed. China is doing a certain amount of stimulus to avoid it from getting from a bad situation to an even worse situation. But nevertheless, the shape of the recovery is likely to be a U, maybe even a fat U, as Rish mentioned earlier. And to that end, when you look at Chinese rates, where they are compared to where most of the developed world's interest rates are, which are pretty much glued to the floor. And then even when you look across the emerging market space, where a lot of the more developed end of EM have their rates pretty much glued to the floor as well, China certainly does stand out as being one of the more attractive markets in terms of the rates and the carry that offers. And
order canceled.
Looking
Order
further
canceled.
ahead and
Order
also at
submitted.
the big picture
Order
here,
filled.
coming out of
Order
any
submitted.
crisis,
Order
what you've
submitted.
seen, definitely coming out of the GFC, but also out of the Euro sovereign crisis, is a risk aversion that shows itself in terms of higher savings rates. And this is adding to the savings glut that the world is already dealing with. And those savings need to find some kind of carry or some kind of yield, some sort of return opportunity. But that risk appetite isn't going to go looking into the depths of, say, junk bonds immediately. And it's not going to go rushing after more equity beta immediately either. It's more likely that those savings are looking for good quality but modest income streams. And I think, looking not only at the Chinese bond market, but certainly, any bond market where the curve steepness still offers some level of carry, or where absolute yields married with the fundamentals and the risks that are presented offer some value, you're probably going to see, decent inflows into those kinds of markets as the dust settles.
Amy, always a pleasure. Thank you very much indeed. Amy Patrick there from Pendle Group. Right, we've got to take a break, but coming up, we're looking at the Singapore oil trader that's said to have hidden $800 million of losses. We're going to assess the extent of the potential damage and ask whether there's more in the pipeline, as it were. This is Bloomberg.
Welcome back. Singapore oil trader Hin Leong could be the latest casualty in the historic collapse in energy prices. Sources tell us the son of its founder claims the company has hidden about $800 million in losses on futures trading, suggesting a much bigger hole in the firm's finances than first thought. Bloomberg's managing editor for Asia Energy and Commodities, Alex Vietnowski, has the story for us. Alex, what does this mean for banks that provide Hin Leong with billions in loans?
Morning. Well, yes, it's a sudden, huge potential loss, and a hole has emerged. We understand in Hin Leong's financing, which is very troubling for the banks that are said to owe as much as $4 billion owed as much as $4 billion by Hin Leong. As well as that $800 million loss that was apparently hidden from Hin Leong's financial statements. The son of the owner has also said the company sold some of the millions of barrels of oil that it had used as collateral to secure loans from those banks. So that potentially means huge losses for the banks which provided the trader with those loans. Using the oil as collateral. It simply isn't there, that guarantee.
Okay, but tell me a little bit about the man himself. What did he actually do precisely, Alex?
Well, I should add that this is according to people familiar with the matter and based on what the son has said. But apparently according to the son, OK Lim told the finance department not to report these losses in the financial statements. So they weren't there, and the financial statements showed a much more healthy financial position, according to the people, than was actually the case. And so banks were willing to lend on that basis, and now the chickens are coming home to roost.
Alex, what does it mean for Singapore, which is an oil trading hub?
Well, for Singapore, obviously, it's rocking the oil community here. This is really unprecedented in the physical oil market. Hin Leong's huge, an established participant. Its affiliate Ocean Tankers is the third biggest supplier of ship fuel in Singapore. So there could be huge repercussions for counterparties with exposure to the company. And then, of course, there's the banks. As I say, we understand they're owed about $4 billion by Hin Leong, and they're going to be fighting now to get back as much of that as possible.
Alex Kwiatkowski, managing editor for Asia Energy and Commodities there from Singapore. Now, here's the latest business flash headlines. Boeing has suffered a new blow because of its grounded 737 MAX. China Development Bank has reached an agreement to terminate an order for the plane. A statement to the Hong Kong Stock Exchange says CDB Financial Leasing is ending plans to take 29 of the troubled jets as the coronavirus strangles travel demand and the plane remains unable to fly. CDB still has 70 MAX jets on order, which are yet to be delivered. Canada's alimentation Couche-Tard is walking away from a $5.6 billion deal to buy Caltex Australia because of the economic uncertainty caused by the coronavirus. Talks on a deal began late last year with an initial offer being lifted by $130 million. Couche-Tard says it plans to re-engage once there is clarity in the market and says it still sees Caltex as a good strategic fit. And National Australia Bank has taken a hit of just over $1 billion Aussie dollars in first-half earnings. The Melbourne-based lender is blaming a combination of rising customer compensation payouts, software accounting changes, and a reduction in the value of its life insurance arm. The amount doesn't include an estimation in the rise of bad debt due to the coronavirus. NAB is Australia's biggest lender to SMEs. Rish.
Okay, let's have a look at what's going on now market-wise at a day where we're seeing declines really across the board. Some of those declines being reversed, however, seeing some positivity here in Hong Kong. Also, some positivity for Shanghai with the composite index there up 0.2%. Looking at what's really grabbing people's attention, it's the fourth column, of course, there from the left, and that is WTI crude. Look at that, $15.54 a barrel. So it's not as bad as it looks, actually, because of contract differences, etc., meaning that the further dated or longer dated contracts, futures contracts, are indeed priced much higher than that. You can see the spread between Brent crude, which is on $27.80, and WTI there, the biggest that we've seen since 2014. But anyway, WTI crude at one stage hitting the lowest point, as my colleague David Ingles says, this century. There we go. This is Bloomberg.
Order canceled. Order canceled. Order submitted. Order submitted.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week. I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This
Order
is
filled.
Bloomberg
Order
Wall
submitted.
Street Week.
Order submitted. Order filled. Order submitted. Order submitted.
It is 10:29 a.m. in Hong Kong and Shanghai, 10:29 p.m. in New York. I'm Karina Mitchell with the first word headlines. President Trump has performed a dramatic U-turn on the coronavirus, saying China may have deliberately released the infection. Trump's now including the threat of punitive action if investigations prove the virus was unleashed by choice. Only weeks ago, the president was praising his Chinese counterpart for the way the outbreak had been handled.
The question was asked, would you be angry at China? Well, the answer might very well be a very resounding yes, but it depends. Was it a mistake that got out of control, or was it done deliberately?
Order filled.
Okay,
Order
there's a big difference
filled.
between those two. In either event, they should have let us go in.
China says testing of people showing no symptoms of the virus infection reveal only a tiny fraction are actually suffering. The samples were taken in Wuhan, the city where the virus was originally reported, and where fears of a second wave of infection have been rising. More than 250,000 tests were taken this month, and less than 0.1% are said to have been positive. Meanwhile, Iran is calling on the International Monetary Fund to resist American pressure and approve financing to help alleviate the virus impact. Tehran asked the IMF on March 6 for $5 billion to shore up an economy already battered by U.S. sanctions and falling oil prices. Washington has said it will block the application, but the IMF's regional director says the request is proceeding. And new aviation data from EU regulator Eurocontrol show the dramatic fall-off in passenger traffic across the bloc. The graphic shows how lockdowns and the subsequent collapse in demand have slashed flights in Western Europe amid the coronavirus pandemic. Eurocontrol says the bloc's leading airports are now handling as much as 90% fewer flights compared to 1 year ago. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Has Linda?
Karina, let's take a look at where Asian markets are right now. Broadly lower. There's trepidation. There's some concern about the earnings we'll be getting throughout the week. It is a big week for earnings. The virus, of course, impacting businesses and the economy. We have the CSI 300 index currently up by about 0.1%, reversing earlier losses. Of course, we had China coming out saying that it's lowering the benchmark rate for new loans following a series of policy easing measures by the PBOC. We have China's one-year prime rate being cut by 20 basis points. Its five-year prime rate cut by about 10. The Nikkei 225 down by 0.9%, pulling back after that rally that sent the Nikkei 225 to a bull market, fast retailing among the blue chips, which are currently down. Virus infections in Tokyo reaching a record. Abe expanding that state of emergency. A lot of impact on the economy going forward. The Hang Seng also bucking the trend, up by about 0.3% right now, 24,447. Flip the page, take a look at where we are in terms of commodities. Oil
Order
front
submitted.
and
Order
center.
submitted.
New York crude
Order
at
submitted.
1548, down a whopping 15% right now. Of course, we have oil under pressure, set for its weakest month on record. Demand, as we've been saying, is dwindling. Storage space running out. Oil explorers shutting 13% of U.S. drilling fleet just last week as projects are getting canceled. We have India Nifty futures currently down by 0.3%. We're counting down to the open. Of course, banks in focus after HDFC posted a profit amid virus concerns. Bank stocks surged almost 7% on Friday, but on the year still down about 70%. Now, Singapore's COVID-19 cases have risen sixfold since the start of the month due to outbreaks in crowded migrant worker dormitories. The city-state now has the most cases in Southeast Asia. Our next guest leads Singapore-based genomics company Lucent, which has developed a new kit that allows virus samples to be transported to the lab at room temperature. Joining us is Lucent's founder, CEO, and medical director, Min Han Tan. Dr. Tan, good to have you with us. Give us a sense of what this is about. How does it ensure greater accuracy in testing?
Hi, good morning, and thank you for the introduction. The goal of better testing is based on the principle that a great test is nothing without a good sample. And no matter how great the lab and how great the test is, sampling is really key at the front line to make sure that the quality allows for good quality and positive testing. The goal of the kit allows for accessible and widespread collection for mass testing in the clinic, at the home, and even at airports. The idea is that a supervised saliva collection could possibly outperform current gold standards of swabbing, and this is really crucial to allowing a broader, more accessible testing so that better surveillance and can be achieved.
Dr. Tan, what do you make of how Singapore has handled efforts in trying to contain the spread of this virus, and how perhaps the kind of testing that you found, how helpful would that be for Singapore?
I think definitely Singapore has a wonderful response to the issue, and I think certainly broad and accessible testing is a key to that. I think the critical thing to consider here is that really there are going to be vulnerable people everywhere in the region, and I think the idea is that a good and accessible sampling coupled with a much broader testing is going to be key across the region and even the world.
Coronavirus. Tell me, with all of these different tests, we've got different levels of efficacy. Can you tell me what the biggest challenge is when it does come to testing?
I think there are several bottlenecks in terms of testing. There is first the frontline bottleneck in terms of sample collection. There is the issue of cold chain transport for chilled sample, and finally there is the lab testing capacities. And I think these are all well known across the world, and I think this is something which is being scaled up everywhere. There is a lot of attention on this.
So saliva testing seems to be the way forward for now, and is that your view too?
Saliva testing is definitely something which is being evaluated by many of the large organizations out there, such as WHO and FDA. I think there are early adopters in terms of the cities such as Hong Kong, where supervised saliva collection is very much widely practiced. And I think this is where many governments and regulators are looking very, very closely at this.
Dr. Tan, how much is testing an obstacle to containing the COVID-19?
I think testing is really a key element to identifying the extent as well of the current outbreak. It allows for assessment of who would be best quarantined. It would allow for assessment of the scale and scope. And I think it's really going to be a key to allowing us to understand how the outbreak is going to be contained and controlled.
What do you make of the healthcare infrastructure to respond to the COVID-19?
Order filled. Order submitted. Order submitted.
The healthcare infrastructure, I speak primarily based on my knowledge of testing infrastructure. It's something which there is a lot of attention being paid to now, and that's going to continue. The integration of the testing infrastructure with our current hospital infrastructure, the clinic infrastructure, the even communication such as airports, that's going to be the big questions for the next few months.
Indeed, and it's also for the next few months, it's going to be a battle between vaccines and actually treatment here as well. And which is the best way forward? That's the point, to probably stop people getting it at all.
Order
is
canceled.
the ideal
Order
situation,
submitted.
is it not?
Order filled. Order submitted. Order
I think
submitted.
there are many unpredictable elements of the future. I think, and what the company really is focused on is helping the vulnerable in many ways, and these would be the patients who are being seen for testing. And I think the vulnerable elderly, that's a very important area as well, because we recognize that the elderly are most prone to infections. We are working closely with the Shanghai Telemedicine Network as the largest integrated senior care company in China to help the elderly receive a more appropriate, more suitable testing. I think at the same time, we are delivering our services and collaborating with IHH Healthcare, which is Asia's largest private healthcare network.
Dr. Tan, before we let you go, you're a cancer screening and DNA testing company, and you raised $20 million in November in Series A funding led by IHH. Any other plans to raise funds as you expand?
I think that's always a consideration, but perhaps not the most urgent one right now. I think really right now our goal is to make sure communities have access to the best possible testing and surveillance. And, this is a somber time, but I think we are uniquely positioned to help.
Dr. Tan, thank you very much indeed for that. That's the Lucent's founding CEO and medical director, Min Han Tan. Quick look at these headlines that's coming out of China at the moment concerning what they're going to be doing about new infrastructure. They're going to be unveiling guidance on this as well. Actually saying they're planning more measures in the fiscal, financial and investment areas here as well to really at the moment take on the consumption, which has dropped off a cliff as far as the Chinese economy goes. And they're planning more measures as far as consumption goes. And as far as employment goes, this is according to the NDRC here, the government body there, coming out and saying that. And the Ministry of Finance there in China saying it's going to be selling another 1 trillion yuan of bonds, of special bonds, and they're going to be doing that in the near term. All in order, of course, to shore up that economy, as we saw those figures on Friday showing that it had contracted by 6.8%, slightly worse than actually anticipated. Now, going to be also addressing what's going on with the Chinese e-commerce platform Pinduoduo. It's announcing a strategic partnership with the appliance retailer Gome. Going to hear more about the deal from PDD's VP of Strategy, that's David Liu. He's on next. This is Bloomberg.
Order filled. Order submitted. Order submitted.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Now, we've been covering this story about this oil trader in Singapore who hit something like $800 million worth of losses. We've got ABN AMRO becoming the latest lender to make a claim against that oil trading company at the moment that has already filed for protection from creditors, all coming amid a plunge in oil prices. Dutch bank filing applications for charges related to the irrevocable letters of credit tied to goods and documents of Hin Leung Trading. That's according to the Singapore's Accounting and Corporate Regulatory Authority. More news coming on that a bit later on. Let's move on to the Chinese e-commerce platform Pinduoduo. It's announced a partnership with the Hong Kong-listed consumer electronics and appliances retailer Gomei. As part of the deal, Pinduoduo will subscribe to $200 million in convertible bonds issued by Gomei and bring its entire product range to PDD's platform at the same or lower price. PDD's VP of Strategy is David Liu. He joins us now from Beijing. David, tell us about this.
Hello. Yes, so we announced the investment in Gomei on a convertible bond over the weekend and entered into a strategic collaboration with Gomei. We see this very much as a win-win-win partnership, bringing value to our vast consumers.
Order submitted. Order submitted. Order submitted.
From our perspective, we established a stronger foothold in the category of home appliances and consumer electronics, and for Gomei, continuing to help them develop a new business model of connecting offline and online. So we see this definitely as a three-way partnership that could bring a lot of value to our ecosystem.
But in a broad sense, it's something, it's a road that both
Order
Alibaba
filled.
and
Order
Tencent have
submitted.
been down. They've
Order
invested
submitted.
billions in this. Are you a bit concerned, pardon the phrase
Order
here,
submitted.
that it's
Order submitted.
third mover disadvantage, as it were?
Order filled. Order submitted. Order submitted.
No, we don't think that is the case. A couple things I would point out. First, Chinese e-commerce is still a very fast-growing industry. The online penetration is only around 25%, and we do see this is doubling in the next 5 years. Secondly, as we came about about 4.5 years ago, we have managed to accumulate gross merchandise volume over $1 trillion.
Order submitted.
That's about almost $150 billion of transactions on our platform and accumulate around 600 million users. That tells us clearly that there's still a vast amount of consumer interest that is not addressed by the established players. Our partnership with Gomei is furthers our efforts in this area of bringing a differentiated experience and proposition to our users. Specifically in these categories, I would say that it is very important for consumers to have access to offline delivery, logistics, and after-sales services. This is not something that Pinduoduo alone could deliver, and it's very important in these particular categories in having this ability to create trust amongst our e-commerce platform and the consumers, and then basically helping them to be able to buy with strong confidence. So no, we do not see this as a disadvantage. In fact, I would say that given the innovation both of us are making on our business model, we actually see the partnership as a leap forward.
Order filled.
David,
Order filled.
PDD talked about how this is the first such investment.
Order
Are
filled.
we expecting more? And do you see PDD needing to raise funds for it?
Order submitted. Order submitted.
Hey, Hilton, thank you for that question. So at the end of March, we raised $1.1 billion in a private placement at the end of March. And at that time, what we told the investors is that we intend to raise the money to further bolster our cash reserves, so bringing our total cash to over $6 billion. And we will be looking for opportunities to deploy that capital strategically in the second half. And the partnership with Gomei is the first strategic transaction that we have made. Our strategy remains to be very much user-centric. So if we see opportunity like this that could accrue to our user experience, you know, what we talk about interactions and about trust and confidence building, and if we can make investment in areas that will help improve their confidence and ability to spend more time on our platform, we would do so.
David, before we let you go, just a quick question. When we last spoke, you said that there was little evidence of the COVID-19 impacting business. Can you give us an update on that?
So in March, what we have seen is actually a very strong recovery in our online demand, and in fact, some shifting of offline to online interest. So take the month of March as an example. Our average daily shipment parcel volume is north of 50 million. So in the entire March, we have shipped over 1.5 billion parcels. This is on par with our momentum in December last year. Of course, we are seeing some impact in the first quarter, and the outlook remains uncertain depending on how the global pandemic plays out. But from a consumer demand perspective, we'll continue to see very strong demand, so our outlook for the year remains unchanged. We are spending efforts to work with exporters in China in municipalities like Qingdao and Ningbo to help some of the Chinese exporters to convert some of their capacities for domestic consumption uses.
David Liu Pinduoduo, VP of Strategy. Thank you for your time today. Still to come, Indian equity and credit markets got a boost last week as the RBI ramped up stimulus. Can the rally continue? We'll check in on what to expect from today's trade next. This is Bloomberg. Let's do a quick check of the latest business flash headlines. The aviation unit of Bank of China is to buy 22 Boeing planes from United Airlines and lease them back as the coronavirus heaps more cost on carriers. BOC Aviation will take 6 Dreamliners and 16 737 MAX, 9 MAX jets as the airline seeks to reduce regular outgoings as the pandemic cripples demand for flights. The deal is expected to close before the end of the year, but no financial details have been disclosed. Wynn Resorts is calling for parts of the Nevada economy to reopen next month, with a relaunch of the Las Vegas Strip to follow.
Order submitted.
CEO
Order submitted.
Maddox says any reopening may have to stop if there's a spike in virus cases, but the casino industry needs to step forward before it's too late. Wynn says it would impose reduced occupancy measures as well as physical distancing and temperature checks on all visitors.
Now we are currently down to the start of the session in India. Just under an hour to go. Asia credit reporter Rahul Sateja joins us now with a preview. Rahul, the Reserve Bank announcing big measures Friday to limit the fallout from this global pandemic. What are the latest steps? And really, is it what market participants were looking for or
Order
expecting?
filled. Order submitted. Order filled.
So
Order
after pledging
submitted.
to do whatever
Order
it takes
submitted.
to support the
Order
economy,
submitted.
India's central bank swung back into action Friday with broadly 3 big steps. First, the central bank lowered the reverse repo rate, improved lending in the economy by discouraging banks from storing their cash with the regulator. Second, it injected about $6.5 billion into India's corporate bond market to boost its liquidity by providing cheaper financing to the banks.
Order
Finally,
submitted.
it asked lenders
Order
to freeze
submitted.
dividend payments.
Order filled.
The
Order
announcement led
submitted.
bank stocks, sovereign
Order
bonds,
submitted.
and corporate notes to rally. Markets now expect the central bank to slash benchmark interest rates further, and that should keep the bond market supported going forward.
Rahul, we've also had earnings from India's second largest lender, HDFC. What did they tell us about the impact of the pandemic on banks?
So yes, HDFC Bank's net income rose nearly 18% in the March quarter, a period where we saw a bailout of another bank and imposition of a nationwide lockdown. This is a clear positive sign for the lender. No wonder analysts remain very bullish on the bank as they see it more capable than its peers in withstanding the pandemic impact. But despite the optimism on HDFC Bank, markets are very cautious on India's financial sector overall. A worsening economic slowdown due to the pandemic and a lingering shadow banking crisis is not boding well for the banking sector going forward. Even HDFC Bank expected its borrowers' ability to repay deteriorate significantly, and it doubles its bad loan provisions in the March quarter.
We've also got IT giant Infosys out with numbers. What are we looking at there?
Yes, so it's a big day for Infosys, and there are three key areas that investors are focusing on. First, investors are keeping an eye on the new contracts signed during the 3 months ended March, just to assess the demand for IT services around the world when we are seeing so many employees working from home. Second area the market is closely watching is its revenue growth projection. Most analysts expect the company to widen its band of growth projection from the usual 200 basis point spread, reflecting the uncertainty in the global market. Finally, the market is looking for any commentary on the outlook for financial services and retail businesses, especially for any indication on the scale of cost cutting by its clients. Overall, investors expect the company's operating profit margin to hold steady.
Rahul, thank you very much indeed. Our Asia credit reporter there, Rahul Satija in Mumbai. Lots more to come, including a full update on this oil price, which continues to languish below $15 a barrel. Of course, other contracts, future contracts further down, longer dated ones are much more expensive than that. But oil at the lowest price this century.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange. China's slumping onshore bond market is a great.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
It's almost 11 o'clock in Lion City, 8:30 a.m. in Mumbai. I'm Haslinda Amin.
I'm Rashad Salamat. We're entering the last hour of the morning session right here in Hong Kong, and this is a look at our top stories. We've got President Trump turning on China, overtly questioning if the coronavirus was deliberately released.
Submitted.
Beijing hitting
Order
back, saying it's a, quote, miserable U.S. attempt to shirk responsibility. Meanwhile, oil extending its slide in Asia, with U.S. crude now trading below $16 for the first time this century. The OPEC plus output curbs are seen as doing little for the global glut. And new questions about top Singapore oil trader Hin Leung. There may be a much bigger hole in the company's finances than first thought, all amid claims of a cover-up. This is Bloomberg Markets.
Looking at the markets, Rich, Asia falling along with U.S. futures. We have fears, uncertainty, concerns about the week ahead. The earnings expected from the likes of IBM, Infosys, China Mobile, all due out with the numbers amid a fresh crash in oil prices, the lowest in more than 20 years. The CSI 300 index down the most, down by about 2.5% right now, 37.45. It's trading below its 10-day moving average. Chinese banks, of course, today lowered the benchmark rate for new loans following a series of policy easing measures by the PBOC. China's one-year prime rate cut by 20 BPS, five-year prime rate cut by 10, all in an effort to help to cushion the economic impact of the virus. The Nikkei 225 currently down almost 1%, 19,715 right now, and the Hong Kong index also trading marginally higher, bucking the trend. Property developers, the ones to watch, though, existing home prices fell to the lowest in more than a month. Flip the page, take a look at where we are in terms of Southeast Asian stocks. The STI in focus today because of that company, keeping a watch on banks, all related companies, and the bank of Hin Leung filing for protection. People familiar say it owes more than 20 banks almost $4 billion. Jakarta Composite Index currently flat at 46.38. Indonesia crying foul. It says S&P's downgrade of its outlook to negative is not a reflection of its fundamentals. Rish.
Yeah, just looking at the likely open at the moment with regards to India in a second, but this is actually where a lot of the headlines are being made. You can see that 15% down for New York crude. Crude oil prices collapsing anew. WTI plunging below 16 bucks the barrel. We've got at the moment a situation where the nearest date futures contracts are reflecting that price, but longer dated ones for perhaps June are much more expensive than that. But nevertheless, we are seeing that severe weakness for crude oil as demand for the black stuff just really craters, as it were. Looking at the Bloomberg US dollar index, erasing some of the declines that we saw on the session Friday. Gold, not much of a haven, slipping below 1,700 bucks the ounce there. Let's move it along, have a look at what we can expect out of Indian markets. About 43 minutes to go before we get those underway. Nifty futures trading in Singapore down a fraction. The rupee just strengthening about 0.6%, 76 rupees 40 paisa for the dollar, and the 10-year yield 6.35%. Haslinda.
The RBI laying the ground for more rate cuts. Now, President Trump has suggested China may have deliberately caused the coronavirus pandemic, saying there would be consequences if the country is found to be knowingly responsible. China hit back, accusing Washington of trying to shirk responsibility of its own failures. Bloomberg Markets co-anchor Tom McKenzie joins us now. Tom, another ratcheting up of tensions between the two countries over the handling of the virus.
That's right, and to accuse China of deliberately starting the coronavirus is really quite a remarkable about turn for the U.S. president, and clinging on to something that many would describe as a borderline conspiracy theory that had been held in the views of just a minority of people up until just a few days ago. Now Trump is saying that maybe China started this deliberately, and if they are found to have been knowingly responsible, that's the term that he used for the virus, and there would be unspecified consequences. And you'll remember that President Trump was actually praising China and President Xi Jinping in particular in January and February, lavishing praise on the Chinese leader for how he handled the virus. Now, of course, things are looking very different indeed. We've heard not only from Trump, but also the vice president and also Deborah Birx, a member of Trump's coronavirus task force. And she said on Sunday that China has a, quote, moral obligation to be transparent in its response. Vice President Mike Pence saying that they would look at an investigation into China's role in the virus, its handling of the virus, at a later date. And it does dovetail with the Republican Party's strategy to blame China for the disease. Trump, of course, has faced significant criticism over his response to a virus that has now killed nearly 40,000 Americans. It seems that by turning the focus on China, the U.S. and the Trump administration are trying to divert attention to some extent.
Tom, I'm sure with quite an accusation like this, Beijing isn't taking it lying down.
Well, not surprisingly, that's right. We have an editorial from one of the state-backed newspapers here, the Global Times. It accuses the Trump administration of trying to shift the blame and says that the Trump administration has essentially bungled the response to the virus there. The editorial describes the U.S. administration's handling of this disease as, quote, miserable, and says Trump is essentially attacking China in an attempt to bolster his election chances in November. So again, rather than leading into any closer cooperation between the two sides on the issues of health and global pandemics, as some of the optimists may have hoped at the start of this, what the disease has done is driven another wedge between the U.S. and China, and it's just fueling more tension and distrust, it seems, between the two sides. We also heard from China's foreign minister putting his praise and support behind the World Health Organization and saying that China would step up its support for that UN agency, which, of course, Trump says he's going to be cutting funding to.
Tom, so they're trying to get to grips with how the pathogen actually spread. What are they doing to better learn about that?
Well, they've started something called a serological survey, and what that involves is researchers going across the country and taking blood samples from thousands, maybe tens of thousands of people to see if they have antibodies, if they've developed antibodies, which of course would suggest that they have been infected. Many people, of course, get infected and then don't show symptoms, and that, of course, has been a concern for people trying to tackle this disease. So they're trying to get that information. They hope that this will give scientists a better understanding of the magnitude of the disease's spread in the broader population, and it may also give them more information about exactly how the virus is transmitted. There's still a lack of knowledge and understanding how this virus is passed between people. And it is likely also part of an attempt by China to show the international community that China is trying to be transparent about the disease and that it has nothing to hide. We'll be watching for the results of that survey, of course. But there has been skepticism over China's virus data, which has been revised a number of times, of course, most recently last week when it added to its total death count.
Tom, thank you. Tom McKenzie, the Bloomberg Markets co-anchor in Beijing. Now, a little bit earlier on, we saw the U.S. administration put a moratorium on some duties. Let's find out more on that. Let's get to the first word news. Here's Karina Mitchell in New York.
Hey, Rish. Yeah, the Trump administration is temporarily halting certain tariff payments, although not the high-profile duties targeting China. The decision doesn't apply to anti-dumping or countervailing measures of the Section 201, 232, or 301 tariffs. That means action against Beijing on steel and aluminum imports and against Airbus all remain in place. The relaxation on tariffs will last for 90 days. Meanwhile, virus cases in India have surged, with 1,400 new infections, taking the total above 16,000 as a nationwide lockdown enters a fourth week. Confirmed cases have been rising as India steps up testing, with known infections up 78% in the last week. However, doctors say the true number is far higher, with only 370,000 of India's 1.3 billion people tested so far. Indonesia is tightening virus restrictions, extending curbs on millions of people in the main island of Java as infection numbers rise. The new regulations will affect about 9 million more people as the virus continues to spread. Indonesia has recorded the biggest daily increase in cases since numbers were first reported, and the government has widened restrictions to cities surrounding Jakarta. Meanwhile, Western Europe is reporting a decline in pandemic cases, with the fewest confirmed deaths in several weeks. Coronavirus fatalities in Spain rose by 410 to just over 20,000. That's the smallest one-day climb since March 22nd, while Italy reported its fewest deaths in a week, and France said deaths rose at the slowest pace since the end of last month. Data from Germany and the UK also show an improvement. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg Has.
Well, plenty more to come after correctly predicting oil slump earlier this month. ING's head of commodities tells us why he's forecasting Brent
Order canceled. Order canceled.
By year-end.
Order submitted. Order submitted.
This hour, up next, Oxford Economics giving us their outlook for Asia's major economies and telling us why China will not be able to ease and spend its way to growth this year. That and more on the way. This is Bloomberg.
Order filled. Order submitted. Order submitted. Order submitted. Order submitted. Order submitted. Order filled.
Chinese banks lowering the rate for new loans following another series of policy loosening measures by the PBOC, the central bank. They're setting the one-year prime rate at 3.85%. That's a move down of some 20 basis points from March, and the five-year dropping by 10 basis points. Oxford Economics head of Asia Economics, Lewis Kusch, joins us now. And Lewis, you know, this is all part of the huge gamut of different things that the PBOC is doing to stimulate the economy. Are they getting it right?
Well, whether they're getting it right or not, what we do observe is that China this time is taking a quite different stance to this downturn than it has done before, and also quite different from what we see in other countries. So they're just being still quite frugal in terms of spending a lot of money.
This is it. This is the marked difference that we have from what happened after the 2008 crisis, is it not? Which China is credited for spending and basically dragging the global economy from the abyss.
Yes, it is a very large difference. I mean, if you look at what is holding back a more forceful, basically a larger stimulus, it is very much the headaches that people in Beijing feel they are still suffering from as a result of these earlier bouts of stimulus. They are much more concerned these days about, financial instability, high leverage. And also, if you look at who are in charge in terms of economic policy, the people with a strong background in finance, they are dominating this whole debate. And so, therefore, I don't really think this is going to change to a large extent.
So, Lewis, are they just relying on something that I was reading about earlier, which is called a revenge spending, that when people can move around, things get back to normal, they're going to see a huge spike and a rapid movement back for the Chinese economy itself? Or is it a case that there's an underappreciation of how much global demand has been falling or has fallen?
Yeah, I think it's really reached the combination of the two things. We do see that there are some people who would like to take revenge and do lots of spending. But if you look more broadly, there is a huge amount of caution. There is caution in terms of still contracting the virus, but also a lot of nervousness about the economic climate. And that means consumption is just still very, very lethargic, very, very subdued. And I don't think that's going to change very quickly. And then on top of that, you have that fact that the rest of the world is now sliding into recession. And so overall, the demand side of things is really holding back the recovery. We do think that China will, crawl out of this hole, but that crawling out is just going to take quite some time. And that means that this year we will see very little growth.
That's right. Obviously, first in, first out, like you said, but a lot depends on the demand from the rest of the world, which is pretty much still under lockdown. When you take a look at demand recovery, what assumptions are you making?
So we assume that on the domestic side, that things are improving, that overall we do see, increases in the number of people that are doing, buying stuff, also more slowly increases in that social consumption, which is spending on restaurants, tourism, these kind of things. But it's going to take some time. So we also, in our assumptions, we have noticed that it is easier for firms to basically decide that it is worth ramping up their spending and doing capex. So in our forecast, investment is a bit stronger than consumption. And of course, also the government side is looking quite strong in terms of the numbers. But so we have a gradual recovery on the domestic side. But then, unfortunately, we have very significant declines in exports for China. We have our assumption on exports is about minus 10% for the year as a whole.
Louis, when it comes to China, job creation seems to be more important than GDP growth itself. Unemployment at a record 6.2%. Do you see the Chinese government being able to rein in unemployment?
Yeah, Linda, I think that probably from where we are now, things will not deteriorate massively. But having said that, the official numbers vastly understate the amount of underemployment and people without a job, because the official numbers, they simply don't include a lot of migrants who sometimes still have stayed in their locality, their home province, haven't yet moved to the cities because they don't have a prospect for a job. So I would say the 6.2, which actually fell to 5.9, I think, after that, but still, that these numbers don't really show the pain in the labor market that people are feeling. And it's especially when we talk about this very subdued social consumption, thinking about restaurants, hotels, tourism sites, theme parks, all in all, these employ huge numbers of people. And so, therefore, the labor market pain is going to remain very significant. And I think that overall, we do not really see a lot of interest in China for massive stimulus. But I do think that recognizing this pain on the labor market, we will see some more targeted measures trying to alleviate some of that pain.
Louis Coos from Oxford Economics, thank you so much for your insights today. Still to come, serious questions are being raised about Hong Kong's autonomy and its future as a top financial hub after Beijing moves against democracy activists. We have details just ahead. This is Bloomberg.
Order canceled. Order canceled. Order canceled. Order canceled. Order submitted. Order submitted.
You're back with Bloomberg Markets. This weekend saw arrests of pro-democracy leaders here in Hong Kong, and that is something drawing sharp criticism from the United States. This comes after Beijing's representative office in the city asserted its right to intervene in local affairs. Prominent pro-democracy advocate Emily Lau telling Bloomberg Hong Kong could actually see a resumption of street unrest.
Once the virus is over, I can assure you, the protesters will come out again if the government does not listen to us and does not engage in dialogue with the masses.
Let's get over to our chief North Asia correspondent, Stephen Engel. Now, Steve, you've been covering the protests on the streets of Hong Kong right from the get-go. What is the significance of these arrests, and what about the timing here, too?
Yeah, well, what just Emily Lau just said, it runs the risk of inflaming what had been a fairly dormant protest season, if you will, because of the coronavirus outbreak. We saw some momentum in the protests over the previous 6-7 months before the outbreak, and there was a calm. But now with this arrest at a time when, of course, Hong Kong is in a de facto state of emergency because of all the restrictions, it could possibly inflame things. And obviously the United States and even the UK putting out statements condemning the arrest of these 15 prominent pro-democracy activists that include Martin Lee, the founder of the Democratic Party, Apple Daily founder Jimmy Lai, former legislator and activist Albert Ho, long hair, which is Long Kwok Hung. He's a former lawmaker, very well-known people that could incite the people to come back out on the street, as Emily Lau said, when the virus situation dies down. Now, Beijing is firing back at criticism that has been leveled by Mike Pompeo, the U.S. Secretary of State. We've heard as well from Nancy Pelosi and Mitch McConnell in the U.S. Congress. But China is saying foreign countries have no right to intervene. U.S. politicians ignore facts and distort the Sino-British Joint Declaration and called it immoral behavior for foreign forces to collude with the anti-China activists in Hong Kong. It's an interesting turn at a time when Emily Lau says Beijing is using this as a golden opportunity when the world's attention is focused on the virus to quash dissent here in Hong Kong.
And Steve, Hong Kong's economy reeling from the virus and early by the protests were due out with unemployment figures later. What is expected?
Well, the unemployment rate, not surprisingly, given the triple whammy that has hit Hong Kong over the last year, whether it was the trade war, then it was, of course, the protests, and then the virus, is likely to increase. We've seeing the survey of economists by Bloomberg at March unemployment rate of about 4%. That's after 3.7% in February, which was a near-decade high. Keep in mind, it's not as bad as what we saw in June 2003, which saw the peak of unemployment after SARS. That rose as high as 8.5%, but Hong Kong bounced back fairly quickly. This could be much more structural, much more long-lasting, because you have those other factors, including the uncertainty that we just talked about regarding the protests and the effects it's had on service industries, travel industries, and hospitality and the like. Now, the government has passed a number of relief packages, including most recently more than $10 billion in wage subsidies for laid-off workers. But then in blog posts over the weekend, yesterday, Matthew Chung, the Chief Secretary, as well as the Financial Secretary, Paul Chen, talked about the grim situation in the labor market. And Chung is even saying that the labor market will continue to face huge pressures.
Chief North Asia correspondent Stephen Angle. Let's do a quick check of the latest business flash headlines. Alibaba is to invest about $28 billion on cloud infrastructure over the next 3 years to extend one of its fastest growing businesses to more countries. It plans to build more data centers to complement its existing network that covers 21 regions around the world. Alibaba says it will continue to develop its own tech in areas such as AI inference chips to support its cloud expansion. And Boeing has suffered a new blow because of its grounded 737 MAX. China Development Bank has reached an agreement to terminate an order for the plane. A statement to the Hong Kong Stock Exchange says CDB Financial Leasing is ending plans to take 29 of the troubled jets as the coronavirus strangles travel demand and the plane remains unable to fly. CDB still has 70 MAX jets on order which are yet to be delivered. Rish.
Okay, let's have a quick look at what's going on with some of these individual big movers right here at the moment in the Asia Pacific. There we go. Hyundai Road Temp up 19%. It's P-Stock, it's a railroad equipment maker. South Korea is planning to hold a meeting to decide on an inter-Korean railway project.
Order filled. Order submitted. Order submitted.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity
Order
Index.
filled. Order submitted. Order submitted. Order canceled. Order canceled. Order submitted. Order filled. Order submitted. Order submitted.
You're looking at live pictures of the Lion City, almost 11:30 a.m. in Singapore. We're in the middle of the trading day. The STI, well, looking like this, currently up by 0.2%. Singapore banks in focus after Hin Leong, an oil trader, said it hid $800 million in losses. Bankers now assessing their exposure to the company. The trouble at Hin Leong, of course, the latest to hit the commodities industry in Singapore, among the largest hubs alongside the likes of Geneva, London, Houston as well. Over the last 3 years, as you know, Singapore has seen the collapse of two other big names in the industry, including Noble. The STI currently up by
Order filled. Order submitted. Order submitted.
Now, let's get the first word headlines with Karina Mitchell in New York. Karina.
As Linda, as you and Rish have been reporting, President Trump has performed a dramatic U-turn on the coronavirus, saying China may have deliberately released the infection. Trump's now including the threat of punitive action if investigations prove the virus was unleashed by choice. Only weeks ago, the president was praising his Chinese counterpart for the way the outbreak had been handled.
The question was asked, would you be angry at China? Well, the answer might very well be a very resounding yes, but it depends. Was it a mistake that got out of control, or was it done deliberately? Okay, there's a big difference between those two. In either event, they should have let us go in.
Staying in China, it says testing of people showing no symptoms of the coronavirus infection reveal only a tiny fraction are actually suffering. The samples were taken in Wuhan, the city where the virus was originally reported, and where fears of a second wave of infection have been rising. More than 250,000 tests were taken this month, and less than 0.1% are said to have been positive. Meanwhile, Iran is calling on the International Monetary Fund to resist American pressure and approve financing to help alleviate the virus's impact. Tehran asked the IMF on March 6 for $5 billion to shore up an economy already battered by U.S. sanctions and falling oil prices. Washington has said it will block the application, but the IMF's regional director says the request is proceeding. And new aviation data from EU regulator Eurocontrol show the dramatic fall-off in passenger traffic across the bloc. The graphic shows how lockdowns and the subsequent collapse in demand have slashed flights in Western Europe amid the coronavirus pandemic. Eurocontrol says the bloc's leading airports are now handling as much as 90% fewer flights compared to a year ago. Global news 24 hours a day on air and on Quick Take by Bloomberg. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Okay, let's have a quick look at what's going on market-wise as we get equities back on stream over in Tokyo. And what we have at the moment is the Nikkei 225 pretty much where it was before, about 1% lower. Hang Seng here, half an hour of trading to go before the lunch break. Positive now. Philippines market after a good run-up last week, just a moment down by about 1%. Let's have a look at the prospects for the Indian trading day, about 13 minutes away, looking at what is likely to happen in Mumbai. There we go. And a bit of a turnaround here. Nifty looking as though it's pricing in perhaps a slight lift off here as well, with this background of Asia-Pacific equities currently just mixed, you could argue here as well. Rupee there just strengthening to 76.40 against the dollar, and the 10-year yield for India 6.35%. That's Linda.
Well, oil, pretty much the big story today, Rish. Front and center. Futures in New York falling to less than $16 a barrel after losing almost a fifth of the value just last week. Despite that deal by OPEC+, other producers also failing to counter the demand hit from the economy. The current May contract expires Tuesday, with a more active June futures falling by around a third, as much on more than 5 times as much trading volume. Global benchmark crude only down about 1%. There you have it. New York crude currently at $15.44. It is pretty much red across the board when you take a look at all futures. Now let's look at the prospects for oil. Our next guest says there is light at the end of the tunnel for crude in the second half of the year. Joining us now is ING Head of Commodity Strategy, Warren Patterson. Warren, good to have you with us. When you take a look at oil prices right now, what are they factoring in terms of demand?
Good morning. Yeah, I mean, looking at oil prices at the moment, obviously we do believe there's quite a bit more downside to come in the near term. And that's largely as a result of the significant amount of demand destruction we're seeing at the moment. So, I mean, just in April alone, we're seeing around a 30 million barrel a day year-on-year decline in oil demand. And that's obviously substantial. So, we're seeing significant inventory builds as a result. And I think what's very important to also remember is that the OPEC Plus deal only starts on the 1st of May.
Order submitted.
So between
Order
now and then, we're going
submitted.
to see
Order
very large
submitted.
inventory builds. And then once we even get to May, well, it's still not enough. We're going to continue to see inventory builds over the whole of Q2. So our view is that oil prices will trend lower still in the coming month, in the coming quarter. And we're currently forecasting that ICE Brent will average around $25 a barrel. But obviously, we will test the low 20s, we believe.
The oil demand, rather the oil supply is very high, but in the end, it is about the demand. Given expectations of a recession globally, where are we headed?
Well, I think we've got to see where we are at the moment, right? I mean, we've had sort of an unprecedented move, a decline in oil demand as a result of these travel restrictions. Now, I think as we move forward and we go into the second half of this year, assuming that we do start to see an easing in travel restrictions, and I think, we're already seeing signs that we could be past the worst for the virus. Once we start seeing those travel restrictions lifted or eased, we expect oil demand to really start coming back. So we expect to start seeing a recovery over the second half of this year. Obviously, still likely to be down year on year, but we're not going to be seeing anything like a 30 million barrel a day decline like we're seeing at the moment. So as you say, demand is going to be key. Assuming we see a recovery in the second half of this year, that should be enough to see the market starting to draw down the significant inventory builds that we've seen over the first half of this year.
Is there anything else that OPEC Plus can do?
Well, again, there's been talk that could they deepen those cuts? I really don't think that's going to be a likely scenario. I mean, we're seeing record cuts at the moment, just shy of 10 million barrels a day for May and June. I really don't see the appetite for the group to increase that even further. So, no, I don't think there's much more they can do from that side of things. I think what we're going to have to see for the market is really let the market sort out the surplus. And so when I say that is let these low prices
Order
will
canceled.
result
Order
in production
canceled.
shut-ins
Order
elsewhere.
canceled.
So the likes of the U.S., Canada, we're already seeing signs that we're seeing, reduction in production from those countries. If we look at the U.S., for example, just over the last month, the rig count has fallen by over 35%. So, between now and the end of this year, we could see about 2 million barrels a day of U.S. supply lost. And likewise for Canada, their prices are just far too low. Yes, we look at the WTI benchmark, trading, well, when I say benchmark, looking at the June contract at over $20 a barrel. But if you look at Canadian oil prices, they're trading sub $10 a barrel at the moment. So we will see significant production shut-ins in Canada as well.
Order canceled.
Yeah, Warren, I
Order
took it into a Canadian
canceled.
crude the other
Order
day, and I was
submitted.
actually very,
Order
very surprised.
submitted.
A lot of this can come back, and that rig can go up. How much do you think that Saudi Arabia's strategy of perhaps shaking up shale, to put it diplomatically, has resulted in them cutting their noses to spite their face?
Well, again, I think we got to look also back at the OPEC Plus deal when it first failed, right? I mean, that was really Russia who was quite keen on to walk away from that deal, given they were sick and tired of giving away market share to the U.S. Now, obviously, I think they've gone too far. It's sort of been the worst-case scenario where the whole deal fell apart at a time when we've seen this significant demand destruction. And yes, I think it's something that obviously OPEC Plus as a whole didn't foresee. And so I imagine, yes, had they would have preferred to obviously have had those cuts sort of coming in from early March rather than now only coming into effect from 1st of May.
Okay, so with all this oil which is slushing around and it's also getting into the position where there's nowhere to store it, how long does that inventory overhang last if we do get substantial cuts in output in the next few months? How long does it last, and how does it really affect oil prices for the medium term?
So we're going to have inventory builds for the next quarter for sure. Then as we go into the second half of the year, assuming that we do start seeing a fairly quick recovery in demand, we should already start seeing inventory draws over the second half of this year. So our view is that basically once you sort of get towards mid-2021, the market should have basically drawn down the builds that we've seen over the first half of this year. Now that also calls into question, okay, well, what's the future of the OPEC Plus deal? Because as things stand at the moment, that deal lasts through until the end of April 2022. But given that obviously we expect quite hefty drawdowns in inventory later half of this year and going into 2021, we're of the view that the deal will probably not need to be, well, will probably break down over the course of 2021.
Warren, I'd like to pivot to gold, trading at multi-year highs, currently at 1681. Ray Dalio says that, forget about holding cash. You should be holding some gold for sure. When is gold a buy?
Obviously, we've had quite the move already. I would wait for pullbacks to jump in, just given the fact that we are sort of approaching lifetime highs. So we're not too far away now from the highs made in 2011. So I imagine as we approach those levels, we could see some resistance with profit taking. And again, if we start seeing further signs that the worst of the virus is behind us, we could again see a little bit more profit taking on the gold side. So I think I would wait for pullbacks towards the 1600s before buying. But yeah, clearly in the current environment, where you got central banks easing around the globe, you got this low interest rate environment. The outlook is generally optimistic, but I think better opportunities to wait for pullbacks before jumping in.
Look into the crystal ball for us, Warren. Where is gold headed year end? Some say 1800, some say more.
I think we could see the highs already sort of over the summer. So I would not be surprised if we go up and test those highs of 2011, so around 1900. But then I think as we work our way through the year, with the worst of the virus hopefully behind us by that stage, I think we could see investors moving away from the safe haven asset once again. So I think we could actually see it probably come off towards 1600, 1650 by year end.
Warren, out of all the commodities you cover, which one is a screaming buy and which is a screaming sell?
I would say, looking at where we see prices going, I mean, obviously it looks terrible now at the moment given where we're trading, but I still think oil's got quite a significant amount of upside going into 2021. So I think that's probably a screaming buy. On a screaming sell, I would say, again, probably something on the base metal side. So copper has performed very well over the last couple of weeks. I think there's a little bit more downside, quite a bit more downside to come there, given the fact that the demand destruction we're seeing at the moment on the copper side far outweighs the supply disruptions we're seeing at the moment on the mining side.
Warren, thank you very much indeed for that. That's the ING Head of Commodity Strategy, Warren Patterson there. Just having a look at what's going on with regards to Japan at the moment. We've seen exports sink. We've seen more bad news coming through data-wise. According to the Reuters news agency, Japan is set to boost its stimulus package to 117 trillion yen. That's 107 billion US dollars, I believe. So that's just coming through at the moment. The Reuters news agency coming up with that line. Extra stimulus for Japan. Now, let's tell you what we have on the way. way, India and Singapore seeing a surge in new coronavirus infections. Meanwhile, South Korea reporting its slowest one-day climb since the outbreak began. We'll get a wrap of Asia's virus situation. That is next, and you are with Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Welcome back. Let's do a check on the Indian markets. We have the Sensex index rising for a third straight day, currently up by about 0.5%. HDFC is currently among the biggest advances, up by almost 5%. Remember that it was out with earnings on Friday and it posted a profit despite putting aside more in terms of loan provisions. Of course, we're expecting more earnings to come out today. Infosys among them, currently trading up by about 2% in the lead up to the numbers later on. Of course, when you take a look at bank stocks, they have surged. In fact, Friday alone, they rose about 7%, but on the year down about 34%. Rish.
Let's get to actually the latest of the pandemic. Global virus cases now passing 2.4 million. The World Health Organization saying that social distancing restrictions imposed to curb the virus must be eased in phases. And, by the way, do not spell the end of the pandemic. Bloomberg Markets anchor Yvonne Mann joining us with the latest. Yvonne, some countries in Asia beginning to already relax social distancing measures. What are they seeing there?
Yeah, in South Korea in particular has been a prime example, Rich, where they saw the fewest number of new virus cases since the start of this surge. So only 8 new cases in the past 24-hour period. That is the lowest since that outbreak began at that religious sect back in late February, when we saw 1,000 infections a day at one point. And the government now saying, at least for now, they're going to keep most of the social distancing measures in place until May 5th, but they will start to ease some of those restrictions. Church services, for example, and they're also thinking about reopening schools soon. They are still a bit cautious, though. There is this fear of asymptomatic cases that could potentially spread across the country. But getting the daily numbers to single digits is certainly a milestone, given the country didn't have a lockdown, nor do they ban travel as well. And the country has largely been credited for its aggressive testing, which has been a really good model for the rest of the world. China itself also showing some signs of stabilization, once again reporting 12 additional confirmed coronavirus cases, no deaths as well. 8 of those new cases were from abroad, that's according to the National Health Commission, and 49 additional asymptomatic cases, Rish.
The thing is, Vaughan, we're still seeing some hot spots in the region. India is one, and of course the Lion City.
Yeah, India first reported biggest daily increase in virus cases, and they added 1,400 new cases.
Order canceled. Order submitted.
Now
Order
more
filled.
than 16,000
Order
cases
submitted.
overall
Order
in
submitted.
the country as that nationwide lockdown enters week 4. And we saw virus cases surging nearly 80% from a week ago as the country expands testing. But you talk to infectious disease experts, they say the numbers are likely to be much higher because there still isn't enough testing out there. And the Prime Minister Narendra Modi extended the lockdown until May 3rd, but they also have started to relax some of these restrictions. They're allowing makers of IT hardware, farmers, and rural industries to resume operations starting today. Singapore as well, recording 596 new cases on Sunday, most of which have been the workers living in those foreign worker dorms, which has been a rising trend. We're also taking a look at Indonesia as well, extending even stricter social distancing rules in the main island of Java. That's going to impact millions more, and the number of infections there now totaling more than 6,200.
Bloomberg Markets co-anchor Yvonne Mann. Plenty more to come. A Singaporean oil trader could be the latest casualty of the collapse in crude prices. Just ahead, we'll look at alleged financial irregularities at Hin Leong and how that could ripple through the commodities trading industry. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Order filled. Order submitted. Order submitted.
We're back. Let's have a look at the latest business flash headlines. We've got Canada's Alimentation Couche-Tard walking away from a $5.6 billion deal to buy Caltex Australia. All down, you guessed it, because of the economic uncertainty caused by the global pandemic. Talks that a deal began late last year with an initial offer being lifted by $130 million. Couche-Tard says it plans to re-engage once there is clarity in the market, and it says it still sees Caltex as a good strategic fit. NAB, or National Australia Bank, has taken a hit of just over $1 billion Aussie dollars on first half earnings. The Melbourne-based lender blaming a combination of rising customer compensation payouts, software accounting changes, and a reduction in the value of its life insurance arm. The amount doesn't include an estimation in the rise of bad debts due to the coronavirus. NAB is Australia's biggest lender to small and medium-sized enterprises.
Rish, Singapore oil trader Hin Leong could be the latest casualty in the historic collapse in energy prices. Sources tell us the son of its founder claims the company has hidden about $800 million in losses on futures trading, suggesting a much bigger hole in the firm's finances than thought. Bloomberg's managing editor for Asia, Energy and Commodities, Alex Kwiatkowski, has the story. Alex, what more do we know?
Morning, Haslinda. Well, yes, for the banks involved here, the major issue for them is going to be to recover as much of this money that they're owed by Hin Leong as possible. As you say, sources tell us that more than 20 of them are owed by about $4 billion combined. Now, the company and its shipping affiliate last week applied for court protection from their creditors, according to our sources. So we're going to have to see how that pans out. And one of the key issues here for the bank According to our sources, the son of the founder says the company sold some of the millions of barrels of oil it had used as collateral to secure loans from the banks. So the company now faces a significant shortfall between the stocks it held and the inventories pledged to the banks. And that means potentially huge potential losses for the banks, which provided the loans, the billions of dollars of loans, using the oil as collateral.
Tell me here, Alex, are these banks, any of them in grave danger, financially speaking, because they provided Hinlong with billions in capital?
Well, reached that $4 billion that we know is combined of probably more than perhaps around 20 banks or more. We understand that the bank with the biggest exposure is HSBC, understood to be at about $600 million, and others less than that. So it's not an insignificant amount that the banks are exposed to.
Alex, just moving just quickly to where you are right now. You know, Singapore is a commodities hub. It's an oil trading hub. On top of that, what has it damaged the status in regards to that, or is it too early to tell? And what impact is it having?
Order filled.
Well, yes, Rishi. I mean, this is really unprecedented in the physical oil market, in the Singapore oil market. Hinlong is a huge and established participant. Its affiliates, Ocean Tankers, is the third biggest supplier of ship fuel, and Singapore, of course, is the world's biggest ship fueling hub. So there could be enormous repercussions here for counterparties with exposure to the company, and then, of course, there's the banks who are going to be in a fight now to get back to recover as much of the money that they owe as possible. Rish.
Thank you very much, Alex. Alec Fiatkovsky, there, Managing Editor for Asia Energy and Commodities. That's currently where we are. Let's quickly just check in with markets and what we're up to, or down to, if you will. And this is the position we find ourselves. Hong Kong heading to its lunch break, just up a fraction at the moment, seeing the Seoul market, the Kospi, also moving just marginally high. We are generally speaking moving to the downside. And also, really what's been grabbing all the headlines has been oil prices tumbling lower than $16 the barrel. Stocks also seeing at the moment a lot of focus being put on earnings, and many investors out there preparing for a dour earnings season overall, keeping an eye also on the infection rates of coronavirus as well, and how they are playing out in various countries. Linda.
Lots to digest, Rich. That is it. From Bloomberg Markets Asia, Bloomberg Daybreak Middle East is next. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's how we won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Daybreak Middle East. Our top stories this morning.
Oil plunges to the lowest in more than 2 decades amid concerns the world is rapidly running out of places to store crude.
Asian stocks and U.S. equity futures also lower this morning whilst the dollar pushes higher. Investors prepare for a dour earnings season.
And Chinese banks lower the benchmark rate for their new loans following steps by the PBOC aimed at cushioning the economic impact of the coronavirus.
It's just gone 8 a.m. across the Emirates. This is Daybreak Middle East. I'm Menace Crenny in Dubai.
And I'm Yusuf Gameneddin alongside you. A lot of action happening then again in the energy markets. Almost with the crack of thunder, we saw U.S. oil drop to the lowest level since November of 2001. Storage tanks, they're filling up. Demand is cratering. This is the story across the different contracts. Bear in mind, as the Market Live team points out, there may be a bit of less dire news heading over oil's way because you've got the May contract rolling over tomorrow. That's the reason why most of the slump is focused on that. Currently just about $15 a barrel. And then any relief from OPEC Plus in terms of the output cuts is unlikely to turn up fully until June. The U.S. crude explorers have already been reacting. They shut down 13% of U.S. drilling last week. Brent, relatively resilient in all of this, Manus.
Yeah, and the open interest in June is 5 times that of May, so hence the pricing differential. To the markets, you've got crippled crude, and you've got Goldman Sachs warning about the potential cash crunch and capex dissipation. Now, this comes through, Yusuf, in the Mexican peso. If there was ever an indication of headwinds galore, it is in the peso, threatening to overwhelm the market there. So you've got Mexico downgraded, and you're seeing the Mexican peso weaken. Mexico downgraded to Baa1 by Moody's, and a negative outlook also on the oil company. To the S&P 500, far be it from me to have an opinion, Jim McDonald manages $1.2 trillion in the U.S., and he says the U.S. has the most cohesive, immediate, and sizable policy response underpinning and favoring U.S. equities.
Let's get to the top story. And Chinese banks have lowered the benchmark rate for new loans in an effort to cushion the coronavirus damage following a series of easing steps by the PBOC. Meanwhile, Beijing, well, they've hit back at U.S. criticism over its handling of the coronavirus. Bloomberg's Tom McKenzie joins us now from Beijing. Tom, the borrowing cost has been cut, fine. Largely an expected move, wasn't it, on the policy front? What are some of the nuances that crystallized out of this?
Loan prime rate and the 5-year. You've got both of those. The 1-year loan prime rate falling by 20 basis points to 3.85% from 4.05% back in March. And the reason it was expected is because we've had this series of policy loosening steps in the past month by the PBOC aimed, of course, at cushioning the economic impact of the virus outbreak, including cuts to the medium-term lending facility, the short-term market operations, and, of course, bank reserve requirements. What we saw interestingly today, which was not expected, at least in terms of the timing, was the Ministry of Finance also announcing a new quota for special local bonds, around $140 billion worth to fund infrastructure spending. So you had this double punch on the monetary policy side and the fiscal side. China's leaders saying towards the end of last week that the country is facing, quote, unprecedented challenges. And they had signaled more stimulus. And, of course, it followed the announcement that China's first quarter GDP contracted by an eye-watering 6.8%. Now, most economists do expect the rates to continue falling and more fiscal stimulus coming down the pipeline fairly soon.
Tom, good to have you back with us. Let's talk about the ongoing geopolitical spat. Beijing has been pushing back, for want of better words, against President Trump, raising the prospect that China deliberately caused this COVID-19 outbreak. What are they saying?
Well, of course, it's a fairly incendiary suggestion from President Trump. He has said that they want to look into it. And you've seen a pushback, as you say, an editorial in the state-backed Global Times newspaper accusing the Trump administration of essentially trying to shift the blame over what it characterizes as a bungled U.S. response to the coronavirus. This editorial describes the Trump administration and their handling of the disease as quote-unquote miserable, and says Trump is attacking China in a way and in a bid to try and boost his election prospects in November. So as you suggested, rather than leading to cooperation between the two sides on an issue of health, which some had possibly hoped for at the beginning of this outbreak, the disease is adding and is being used as another wedge between the two sides, certainly fueling tension and more distrust. We had, of course, the intelligence agencies in the U.S. suggesting that China had not been fully transparent in the way that it's talked about its data. We also heard from the foreign minister here as well, supporting the WHO, saying that China could add additional funds to that organization.
Tom, China has been saying that they're trying to develop a more complete understanding of the spread of the disease. I mean, how is that progressing? What's involved there?
They're starting something called a serological survey, and basically it involves researchers going out and taking blood samples from thousands, potentially tens of thousands of people to see if they have these antibodies that would, of course, show that they've been infected even if they hadn't been showing symptoms. And what they're hoping is that this survey will give scientists additional information about the magnitude of the spread of this disease in the broader population. And it may also give them more information in terms of how the virus is transmitted between people. But it is also likely part of this attempt by China to try and show the international community that it is trying to be transparent about this disease and it has nothing to hide, and they've been pushing back on that. So we'll be waiting for the details of that survey. Of course, there has been skepticism, as I said, over China's virus data.
Tom, thank you very much. Tom McKenzie there, the very latest on the political machinations between the US and China. A little bit of breaking news coming through on Shake Shack. There was a $350 billion fund for small businesses in the United States of America to tap into it to help them get through. And the accusation was that many big businesses got their hands on this survival money. Shake Shack to return the $10 million. It's called a PPP loan after literally quite huge uproar. Politically speaking, over the weekend. So
Order
they're
canceled.
PPP loan.
Order canceled.
They
Order
say
canceled.
that they have enough capital
Order
to
submitted.
ensure stability.
Order
It should be said that
submitted.
they're really not the only ones that got their hands on money. Potbelly, to name but a few, along with Tex-Mex, with employees, more than 10,000 employees, Yusuf.
Yeah, we also have some breaking lines from New Zealand. They're going to be easing lockdown restrictions in a week. It's remarkable the amount of news flow we've been getting in the last few minutes. So this is a level 3 lockdown from April 27. That's going to be reviewed after a week. So a potential easing of lockdown restrictions then from New Zealand. Well, we still have plenty more ahead. This is
Order submitted. Order submitted. Order submitted.
Let's check in on where the markets are trading right now. You've got oil, as Yusuf was saying, extending its slide, WTI on the front month, which is rolling over, by the way. It expires in 2 days. So you've got that low, 2-decade low on that. Concern that the world is rapidly running out of places to store crude. That after output cuts proved insufficient to cope with the plunging demand. Meanwhile, in Asia, you've got stocks there lower and the dollar is higher as investors prepare for a dour earnings season. Let's bring in Brett McGonigal, Capital Link Chairman and CEO. Brett, great to have you with us this morning. I looked to one of our old friends, Jim McDonald over at Northern Trust. He manages $1.2 trillion. He says the U.S. has the most cohesive, immediate, sizable policy response underpinning and favoring U.S. equities. Don't worry about this earnings season. Look at the response and the underbelly of support. Does that chime for you?
Look, I think the support mechanism is very well articulated and it's extremely, it is cohesive. I think at some point, though, everyone's going to get deeper into the numbers and start to worry about how long this goes on and what the longer-term implications are of getting people back to work, getting back to sustainable levels, and more importantly, with the survival rate of some of the small, medium enterprises across the U.S. I'm very encouraged by the Fed and the monetary policy, and I think fiscal policy will work as well. But I think that the market is not as cautious as it needs to be on this snapback rally right now, considering everything that is yet to be known.
Brett, we'll talk about the U.S. in more detail shortly. I want to get to some of the data we've been seeing out of China in terms of traffic congestion as one potential metric of how a potential recovery would look like. And we put this up on a graphic. The story here being that normalcy isn't fully back in every corner of life in Beijing. In some part it has, but the volume of traffic on the road and other times of the weekday and weekends remains at extremely low levels. Is too much optimism baked into equity valuations?
Well, look, I think equity valuations, well, let's talk maybe more broadly. U.S. equity valuations were pretty stretched before this. Chinese equity valuations were not. So I would say on a comparative basis, maybe there's a little bit more is baked in than possibly could be returned here. But I think on a comparative basis, where China was starting before the virus, I don't think there was a huge level of optimism that was baked in. So I think it's okay. I think where the Chinese prices are right now, I don't think that there's a huge amount of reality check needed. So I think you'll see a step up from here. Whereas in the U.S., I think it's a little too optimistic right now.
Brett, if and when we get to a new form of opening up, New Zealand, the latest line that Yusuf broke before we went to the break, looking at a phased reopening. To what extent will the implosion in oil prices bolster the Chinese
Order
story
submitted.
of recovery?
Order submitted.
21-year low this morning on the front month. So what does that play to the China story?
Look, I've long been a believer that higher oil prices are better for the market. It's somewhat counterintuitive, and I've often met with a huge opposing opinion to that. So that said, I think that higher prices spur big corporates to spend money on R&D, which is, I think, more beneficial than the offset at the pump and the savings that the consumers can put back into the market, because I think there's a floor there. But China being a huge user and importer of oil, I think that it will be good for margins. But I just don't think that the true test would be at full capacity. This would be a windfall for the Chinese. But I think it's going to, as you said, as we're going to kind of creep into slowly getting back online in a measured recovery, I don't necessarily think that you get that multiplier effect that everyone's looking for. And I think that it's going to be some time before you're back at full capacity when you would see the true upside of that.
Brett, in terms of the policy responses, an interesting article in the last few hours from Mohamed El-Arian. He wrote an editorial for Bloomberg, and this is one of the key quotes. He says to avoid repeating the errors of the financial crisis, these efforts will need to be supported by a whole-of-government approach, combining stimulus with a range of structural reforms aimed to counter the downward pressure on productivity and growth potential. And he says otherwise, central banks may once again help win the war against the depression, but be part of a system that fails to win the peace of durable
Order
and
canceled.
inclusive growth.
Order
Do you
canceled.
see it in a similar way?
Look, I mean, I think everybody, if they were given a choice, they would not be highlighting endless monetary policy and the whole idea of just helicopter capital or whatever, wherever we want to call this right now. It's very hard for monetary policy and stimulus on that level to drive growth. We've seen since 2008 that it really doesn't happen. The quantitative easing is great. It puts cheap capital into the market, but it doesn't really trickle down to all consumers or all businesses. It's mostly beneficial. It's mostly beneficial to the bigger corporates. So I don't think that monetary policy is enough to spur growth and demand.
Order filled.
And I worry
Order
that
submitted.
as these balance sheets
Order
get
submitted.
very bloated at the central banks, that they get to a point where there's not much ammunition left. And I think that's the fear of a protracted shutdown, is that we get to kind of upper limits, and these balance sheets are not as flexible as we'd want them to be, or as elastic as we'd want them to be.
Right here, staying with us, we still have a few more things to talk about. That's Brett McGonigal.
Order canceled.
Plenty more ahead then. This is Bloomberg.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's probably won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
After the mayhem of March, treasuries have entered a period of fragile calm as traders balance hopes that U.S. businesses will start to reopen against the devastatingly weak economic backdrop that's likely to prevail for months. The big question now is which force takes precedence. Brett McGonigal, he's the Capital Link chairman and CEO. He's still with us. Brett, which one of these variables is going to dictate the trajectory of U.S. Treasury yields in the next few days?
Well, I think clearly that Trump is really determined to get out at least the idea of an opening up of the economy. I think that will actually have the most impact as people start to think about what the next couple of weeks and months will look like. You're going to start to see the sentiment pick up. You're going to start to see some more positive thinking. And I think what comes with that is you're going to start to see some more projections that look now kind of, maybe we get past how bad things may be, and we think about more of a timeline of how quickly things can recover. And I think that will be the optimism and the sentiment that drives things in the short term. But I do caution that I think this is such an unprecedented time that, unfortunately, what you're seeing in Singapore today and over the weekend, hopefully is not what portends a scale back of that, and then what looks like very positive thought turning to somewhat negative, or at least turning to somewhat of an unknown. And as we know, the unknown in the market is what gets deeply discounted. So that's the fear that I have, is that we get cautiously optimistic and then something starts to rattle around about second wave or relapse or something like that, and all of a sudden, that positive energy gets sucked out of the market.
Yeah, it's the risk of rolling lockdown and a doubly shaped recovery. Brett, can I ask you very briefly, one of the biggest issues has been dollar shortage. I look at what Larry Summers had to say about the G20 last week, and he said in regards to the guardians of the global economy, the IMF fails to agree to pump more liquidity. They did it last in 2009 with special drawing rights. The US blocked the move, and Larry Summers says, I had modest expectations, which they significantly disappointed. It's whatever it takes for us and crumbs off the table for the world. Could this be one of those moments of where we look at a policy error, not using the bazooka that they did in 2009?
Well, look, I think that the problem is certainly there's dollar shortage. We've seen that. We've seen financial products actually pulled apart as people try to grab for dollars to either raise cash or actually be able to pay for dividends and dollar cost. What I think the real issue comes down to here is I don't think that the driving force of the negative energy that we saw on the first leg of the sell-off was really all dollar shortage. I think it's over concentration risk. And I think what's happened is that we had too many people were hiding out in U.S. dollar denominated assets in U.S. markets. And what we saw is everybody moving at the same time really caused a huge problem across that spectrum. And you're going to see diversification from here, which I don't necessarily think is a bad thing for the market. So I'm going to take the other side and say that I don't think it's a miscalculation or could be a problem. I think what it may do, in fact, is drive some of asset allocation or currency allocation out of U.S. dollar-denominated assets. And I think that that's why China looks to be kind of the shining star when you think about it that way.
Okay, it's all about diversification. Brett, thank you very much. Brett McGonigal, Capital Link Chairman and CEO, talking about value in the markets. Now, the U.S. Federal Reserve backstopping the markets. Don't fight the Fed. The cliches are there. That's the mantra. And more companies are looking to test investor appetite for risky debt. Bloomberg spoke exclusively with Christina Minnis, Goldman Sachs, head of leverage finance for the Americas.
I think our clients are relieved to see the capital markets functioning as well as they are, that they continue to focus on making sure they have adequate liquidity and runway to continue to finance their businesses through what is still a very volatile time. But we're really pleased to put your quote there to say the leveraged loan market is also showing signs of life.
So then what do they have to look at moving forward here? Are they still, is it kind of all things go right now, now that it's been starting to come back, or are there still concerns in the coming weeks?
Look, I think you're going to continue to see a lot of issuance. Obviously, the last couple of weeks have been very, very strong. The investment grade market post the crisis has seen $430 billion of issuance. The high yield market with the transactions in market today are going to likely be higher than $23 billion. And the convertible and equity linked markets are over $22 billion. I think that pace of the high yield convert market is going to continue. We obviously have earnings season, so you might see some folks in blackout. But even with the resilience that we're seeing in the public markets, I believe companies continue to be very concerned about the possibility that the recovery could be slower and that they need to really shore up liquidity.
Let's get more on that point about the shape of the next recovery. We're hearing some of the private equity firms really talking about a longer U shape. What are you and your clients taking a look at in expectation for any sort of hope of life in this economy?
Right. Well, I think you're well aware of the Goldman Sachs research view, which is for a pretty sharp decline in the second quarter of 34%, with a recovery in the back half. That being said, it's only a 50% recovery of what we've lost year to date. I would say most of our clients are hopeful that we're going to have a strong recovery in the back half. But again, depending on sector, very conservatively thinking through when their businesses will be up and running at full steam. And I applaud all of them for being quite conservative again on planning for potentially a slower recovery. But again, I think everyone is optimistic, particularly with the capital markets being as open as they are, to continue to support them as they look at these plans.
What are your clients looking at here? I'm curious to see. It's interesting, you've been doing so many deals just from a home even. What are the kinds of deals that are able to make it to market, given that we've seen ones like Hilton, like Spirit, travel and entertainment starting to access high yield?
Well, I think they're looking at the fact that, when the crisis first started, Shonali, as you know, the public capital markets were effectively frozen, and they came to the banks, they came to Goldman Sachs, and we absolutely supported our clients. Now that we have a functioning credit capital market across basically equity and debt, I think they're basically saying we are hopeful that the recovery will be quick, but we're not certain. And so let's tap across all markets. Many of the transactions that we've been involved with have involved not only high-yield debt, but also convertibles and pipes. On the high-yield side, I'm pleased to say that we've been involved in over 70% of the transactions that have come to market. But again, many of those clients are doing dual tranche offerings to make sure they get maximum dollars and great execution.
I want to circle back to what is happening in the commodity markets, because you have WTI, the U.S. oil contract, getting absolutely pummeled. Now at the lowest level since November 2001, a 21-year low. The storage tanks are filling up. Demand is shriveling. But there's also real damage being done to some other benchmark grades and other contracts, like in Nigeria's Bonny Light, trading around $12, $13 a barrel. Currently, we are at $15.19 a barrel for WTI, down almost 17%. We're going to get into the regional ramifications of this collapse in energy prices.
Order canceled. Order submitted. Order filled. Order submitted. Order submitted. Order submitted.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
has extended its slide, then trading at near two-decade lows after agreed cuts by the biggest producers were seen barely making a dent
Order
in demand
canceled.
destruction
Order
wrought by
canceled.
COVID-19
Order canceled.
and an increasing concern as well that traders are quickly running out of room to store the crude. Let's get more on this with Farouk Sousa. He's the Vice President for MENA Economics Research at Goldman Sachs Group. Welcome back to the show, Farouk. I'm going to get straight to it in terms of whether the market reaction is justified. The market's live team is arguing that the bulk of these OPEC plus cuts aren't going to show up until June, and so the picture may be a lot less grim than it currently is being presented as such. Would you see it in a similar way?
Oh, I mean, certainly the OPEC cuts are going to come through. They are significant. The question is whether they're significant enough. The amounts of demand destruction we're seeing from the COVID crisis is huge. So maybe 20, 25, 30% demand destruction. That's not going to be covered by the extent of the cuts. Of the 15 million or so barrels a day cuts that we've seen agreed between OPEC Plus and the G20, only about 5 million barrels a day we see as being voluntary cuts. Sorry. So the rest is really something that would have happened, due to market forces with prices coming down anyway. So we're not going to see a balancing of supply and demand because of these cuts. That balancing has to come from the market, and that's what we're seeing, that market process at work, bringing prices down as supply continues to outpace demand and storage continues to fill.
Farouk, good morning to you. It's Manus. Look, part of the story is what the U.S. is doing. I look at oil field activity in the U.S. 36% is now offline. So let's just spring forward.
Order canceled. Order canceled.
You say some of this is simply never going to come back, and that when the recovery comes, this is going to play into you getting oil back to $40 by the end of this year, maybe even $60 by the end of 2021. What's going to go right, in addition to lock-in, to get to those levels?
Well, I think it's largely, as you say, lock-in. If we're bringing production down to these levels, then much of that production is going to be coming from areas where geologically it's going to be very difficult for that money to come back. Also, CapEx in the oil market is going to be weak and has been weak, and that's going to mean that there's going to be less investment in bringing that production back online, and prices are going to come up. Now, I've had a lot of pushback from clients on this view, so I think it's important to look at what the risks are around this, and particularly around sort of Trump action in the United States trying to support the oil industry through this crisis. If we see a huge amount of support going into the shale industry, and if we see shale not shutting in permanently as we're expecting, well, then clearly there are risks to the downside. But for the most part, we see risks being to the upside from our $40 forecast at the end of this year and $60 forecast at the end of next year. Largely because as demand comes back, now we can argue about whether, how that shape, whether U-shaped or V-shaped or what it might be, but as demand inevitably does come back following the COVID lockdowns, what we are going to see is a temporary period where supply is going to have a very difficult time catching up with that resurgence in demand, and oil prices could surprise to the upside, we think.
Farouk, in terms of the regional consequences of the drop in oil prices, of course, it's not just that. You've also got the impact from the coronavirus side. An interesting chart that was put out by the Bloomberg team in terms of Saudi Arabia's net debt to GDP. And the argument that is being postulated is that there's still quite a bit of room for fiscal intervention, for spending, for bond issuances to finance that kind of spending. Is that what you would recommend as well for the kingdom to pursue?
Well, I think we have to be careful when we say there's a lot of fiscal room. Yes, there's a lot of headroom from a net debt to GDP perspective, right? Saudi Arabia is not a highly indebted country. It can raise debt levels quite dramatically and still be in line with other single-A peers. That is not the problem. The problem is, will the markets be able to absorb the kind of issuance that implies? We're talking about tens of millions of bonds on the Eurobond market, which whether the market is ready to absorb another 20 or 30 billion in Saudi debt is quite doubtful at the moment. So that's really the constraint. It's not that they have a debt to GDP constraint; they just have a constraint getting that debt into the markets, I think.
You also go on to talk about the oil and the non-oil growth. Non-oil growth, you say, will still contract by 5%, but you have some interesting takes in terms of where the government may lean for additional sources of liquidity in the state-owned enterprises. Run us through your thinking in
Order
terms of how
submitted.
you fill your pockets.
Order submitted. Order submitted.
In Saudi.
Yeah, I mean, look, we've got quite a conservative view on where the Saudi financing requirement is going to be. We're saying it's going to be about $140 billion US. We think there's probably about 40 billion that they can raise in the markets, both international and domestically through the local market, which leaves them with something like 100 billion that they need to finance elsewhere. Now, the Saudis are going to be reluctant to tap into their FX reserves, and they've said as much in the past, and so they're going to have to look to other pockets of liquidity. These can come from either domestic bank deposits. Clearly, they've got maybe 20 to 30 billion capacity in the domestic banking system that they can tap. They've got pockets of liquidity like in the Public Investment Fund and other domestic funds that potentially have cash balances they can tap. But there are other means. They have state-owned enterprises that they can tap for larger dividends and payments through the PIF. They've got the potential to borrow through those state-owned enterprises off balance sheet, and potential to borrow in the syndicated loan market, for example, rather than saturate the bond market. So there are other places where they can look to raise the liquidity. We don't have any particular concerns on that front. It's just simply a question of how much they can raise in the markets.
Farouk, we're going to leave it there. That's Farouk Sousa, the Vice President for MENA Economics Research at Goldman Sachs Group. Thank you very much for those insights. Let's get you some breaking lines into Bloomberg from Emirates NBD. That is Dubai's biggest bank. It's also a heavyweight lender across the region. And the numbers highly anticipated by investors. The red headline coming through that they are booking impairments of $696 million. First quarter profit drop is 24%. So impairments for potential drop in credit quality, the bank goes on to say. They're also saying that first quarter operating profit came in at 2.28 billion dirhams compared to 2.75 billion dirhams in the prior period. I mean, we already saw the UAE Central Bank, in anticipation of some of those difficulties, try and ease liquidity conditions and manage some additional figures here coming through as well.
Yeah, in terms of the total income, Yusuf, for the first quarter, if you look at that, the headline there versus last year is 6.89 billion. So this one-off incendiary device of impairments is going to depend on the shape of the recovery, the shape of the reopening. So the first quarter total income, 6.89 billion. Versus last year, 4.72 billion. And
order
the first quarter
canceled.
Profit,
Order
2.08
canceled.
So that's down
order
24%
canceled.
in terms of the profitability number. But they talk about the drop in the credit quality, and we're nowhere near through this process by any stretch of the imagination. We are still in 24-hour complete lockdown with additional measures implemented this week, despite what you read out about New Zealand.
Yeah, and S&P, I mean, going into this, warned, of course, of an earnings shock from the plunge in oil prices and the coronavirus pandemic, not just for the United Arab Emirates, but for the Gulf Cooperation Council as a whole. Still plenty more ahead. This is Bloomberg.
Order submitted. Order
No
submitted.
foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
Equity markets mostly jumped across the region yesterday, with Israel's benchmark rising more than 5%. Simone Foxman has been checking out the markets from Doha. She joins us now. So, Simone, good to have you with us. Driving the market gains, was this the late flurry from the US, or what was the alpha?
Yeah, that's definitely a part of it, Manus, and that's part of why shares around the region were higher. But Israel, that up over 5%, part of that probably due to the easing of lockdown restrictions. As of yesterday, offices were able to double the amount of workers they were able to let in, so now they're at 30% of staff. Doesn't seem like a lot, but certainly a move in the right direction. Electronic stores, furniture stores can reopen, but also we did see some gains across the region because of that EM asset rally on Friday, notably Oman, the exception there.
And Simone, in terms of what some of the officials have been saying in Oman in particular, they said that the country would take new measures to ensure the country's fiscal stability. You could argue it's a little bit too little too late. What do we know about these measures?
Well, perhaps you can, and we're going to have to see how the bond market reacts here. So the comments we got yesterday were from Khalid al-Busaidi. He is an official in the finance ministry, and he said that spending cuts that the country is undertaking are going to save Oman 500 million rials. That's roughly 1.3 billion US dollars. And he did tease the potential for new policies without saying exactly what they were. But I want to point you to one phrase he said, and this was a bit ominous, in my view. He said the moves won't be enough as oil prices continue to decline. He said that Oman's budget assumes oil is at $58 a barrel. We're already seeing some pressure on Oman in the bond market. We've seen a spread to the benchmark at that 1,000 basis points level that really marks distressed territory hanging out right there. So, definitely a place we're going to be watching today and into this week.
Simone, thank you very much.
Yeah, Simone Foxman there, our Bloomberg correspondent in Doha.
Let's just quickly return
Order
to these
canceled.
numbers,
Order canceled. Order submitted. Order submitted.
If you look at the impairments, and there's a number of other things to consider here as well. If you think what their exposure was to NMC, and they are not the only bank with exposure to NMC, by the way, it's got to be said. There are a whole host of banks around the region. But Emirates NBD's exposure to NMC was $203 million. You've got this provision number and profits crushed by 24%. So the impairment allowances in the first quarter, and this is in dirhams. Okay, I know that we read out the dollar number, but in dirhams you're looking at 2.56 billion dirhams. That's versus 570 last year. So you're looking at a five-fold, I'm rounding aggressively, a five-fold upping on the provisions, Yusuf.
Yeah, I mean, what's interesting is that, this is despite the DenizBank full consolidation. Analysts are, generally still quite bullish going into this earnings announcement. 9 buys and 2 holds. I mean, the stock's gotten absolutely smashed year to date compared to banks in the region elsewhere. I mean, the other thing I would highlight in particular is that we ask ourselves how much has been really baked into this latest earnings announcements in terms of the damage that's been done to some of those margins, and how much has been put off to future quarters. In fact, Emirates NBD was cut to neutral at JP Morgan just in the last 2 days. Price target of 8 dirhams and 25 fils a share. All right, stay tuned. We're going to continue our coverage from all key market themes. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
about the world's biggest cosmetics maker because they're sounding optimistic with revenue in China already bouncing back. L'Oréal CEO Jean-Paul Agon says sales in the mainland turned positive in March and are on track for a gain of between 5 and 10% this month.
We had obviously a drop in the business, especially in February, and March. But thanks to our strength in e-commerce, our business in China was all in all able to be even positive at the total of the first quarter with a plus 6%. So that's pretty remarkable. And as I said, it's mainly due to the strength of e-commerce. We were up plus 60% in e-commerce in China in February, March, and this represents already more than 50% of our sales. So e-commerce is obviously a very important way to mitigate the crisis overall.
Will the reopening of the Chinese economy be enough to offset what you're seeing in Europe and the US, the lockdowns here?
We don't know yet. What is clear is that if the first quarter was a quarter with difficulties in China and a pretty preserved business in Western Europe and North America, the second quarter would be exactly the opposite. At the same time, everything depends on how long the confinement measures will last. Because obviously today what we are seeing is more a kind of supply crisis rather than demand crisis. Consumers are really eager to buy our products. They are eager to go to hairdressers, to go to perfumeries or to buy our products, but they just cannot because they are confined in their homes and their stores are closed. So this is very, very much linked, and this is a different type of crisis compared to what we have seen before. So when the lockdown measures will be ended, we believe that we will see a progressive bounce back of the consumption of our brands and products. So if this happens, for example, as it appears to be planned, early May or middle May in Europe, Western Europe, and in North America, I mean, we could hope for a second part of the second quarter that could be more positive.
But overall, Monsieur Agon, because shopping centers, luxury shopping centers are closed, but supermarkets are open, are you looking and are you seeing a real shift in demand for what kind of products from L'Oréal people want? Like what brands are doing well? Is it more the consumer products?
Oh, yeah, of course. Again, as some stores are closed and others are open, definitely consumers go where they can. And so the number one division for us right now is active cosmetics, because active cosmetics with brands like La Roche-Posay or CeraVe or Vichy, first they are sold in pharmacies and drugstores, and also they are recommended by doctors like dermatologists. I mean, this business is doing pretty well and did very well in the first quarter with a plus 12% growth. And so we think it's going to be very well, it's going to do very well also, pretty well in the second quarter. Also, the consumer division with brands like L'Oréal Paris, Garnier, and Maybelline selling the products in supermarkets, hypermarkets, everywhere. These stores are also open, and definitely this also will be protected. What will be more difficult until again the lockdown ends is the luxury products when perfumeries and drugstores are closed, or professional products as long as the hairdressers are closed. But I have seen some positive news regarding hairdressers because in many countries authorities understand very well that they cannot keep the hairdresser closed too long because people need to go back to their hairdressers. So I think salon will be probably the first to reopen after the end of confinement.
There you go. That's the CEO of L'Oreal. He's got a supply crisis, not a demand crisis, and expects a progressive bounce back. Now, this is something that we haven't talked about for a while. Brexit. Talks between the UK and the European Union are set to resume later via a video conference as the two sides try to reach a post-Brexit trade deal. Remember that? In the shadow of a coronavirus pandemic. Now, the EU leaders will also host their own virtual summit later this week. Let's get to our senior international editor, Jody Schneider. She joins us now. Jody, good to have you with us. So what can be expected out of first of all, the EU leaders summit this week? More cohesion, more unity?
Well, it doesn't look like they're going to get that because the virus is going to be a topic there as well. This is this virtual summit they will be having on Thursday. The Italian Prime Minister, Conte, is going to be asking for joint euro area bonds, basically to aid his economy, which has, of course, been crippled by the virus. They've had to shut down for a while now. That is not going to go over well with Germany's representative. They want a European Stability Mechanism rescue fund. That's their preferred tool, at which Mr. Conte said that tool has a bad reputation in Italy. So it seems to be setting the stage for a fight, or a skirmish at least, over how to best help economies that have been really crippled by this in the EU, and particularly Italy and Spain.
Jody, what's the UK government saying here about reports it could be lifting
Order canceled.
lockdown restrictions?
Order canceled. Order canceled.
Yeah, so we heard from several cabinet ministers or several ministers over the weekend, particularly Michael Gove, who's the cabinet office minister, who of course has been helping run the government while Boris Johnson has been recovering from the virus. And he basically pushed back pretty hard against reports that the government would be easing those restrictions perhaps very soon. They're very tough restrictions, not allowing people to go outside except for about an hour a day. And he said it's too soon to do that. They will look at a staged easing of that lockdown. But things like the hospitality industry, pubs and restaurants, which have been pushing to try to get this lifted, he said they would be among the last to exit. And of course, the government there has been, government ministers have been really this weekend trying to push back on these reports of that Boris Johnson and the government there really were very, very late at dealing with the virus. There were some very prominent newspaper reports this weekend, and again, the government has been pushing back against that, saying that mistakes could have been made. They are really we're trying to fight a lot of those allegations in those stories. So they've had a tough couple days there, but they're saying that those reports of a lockdown ending are very premature.
Yes, indeed, some serious rebuttals, 2,900 words in length, and another one 2,100 words that they had missed that. Can we pivot to Europe, because the epicenter of this virus outbreak is Italy, it is Spain, but we're looking at lockdowns. So where are we in terms of the progression with Germany and with Spain?
Yeah, so that's a really interesting question, and it's going to be a complicated kind of equation. Spain, Italy, Germany are reporting fewer cases, fewer deaths at this point, and of course the real question, and it's a question around the world right now, is how do you get back to some kind of normal? How do you end lockdowns and let businesses start operating again and people getting back to work? Each of these governments says they are looking at these kinds of things. They are going to try to do this in phases, but none has really announced a plan yet to do so. And really far off is the question of borders. And that's going to be a big question in Europe, obviously. If you start opening up borders, that's where you have real concerns about second and perhaps even third waves of the virus, for particularly places like Germany that have been able to make real progress of late.
Yeah, it is going to be a rolling sequence, isn't it? New Zealand looking at ways to relax the lockdowns. You're looking at Germany potentially opening up some smaller stores today. And then you've got this second wave coming through in Singapore. Jody, thank you very much. Jody Schneider reminding us that there is a whole world called Brexit and negotiation. So throughout the day, we're going to have these conversations. Nera Church and myself are going to catch up with Frans van Houten. That's going to be interesting. If you look at if you think what L'Oreal was saying, Yusuf, in regards to it's a supply crisis, not a demand crisis. Frans van Houten at the front of the respirator global push to make respirators for the rest of the world. And then, of course, you talk about the two other major areas of the world.
Absolutely, yeah. And then we're also going to be catching up with the Societe Generale Chairman Lorenzo Binismaghi and the Intercontinental Hotels Group CEO Keith Barr, and that comes after the conversation we just had recently as well with the CEO
Order
of
canceled.
Accor, an
Order
absolutely dire
canceled.
state of play.
Order
You begin to
canceled.
wonder whether they're seeing any light at the end of the tunnel. What we're not seeing at all in the oil markets, because massively under pressure, WTI then at the lowest level since 2001, a 21-year low, and much of the pressure on the front month contract.
Yes, we see 5 times the open interest in that June contract than in May. Nera Church and I'll take you through Daybreak Europe. That's it from Yusuf and I. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market. Temperatures down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
Founded more than a century ago from humble origins, L'Oréal is now the world's biggest beauty products company. Specializing in cosmetics, hair, and skincare, it boasts an international portfolio of 34 brands and has a market cap of more than 105 billion euros. At the helm,
a man who's dedicated his entire career to the company. Over 4 decades, he's covered all facets of the business. Today, on Leaders with Lacroix, we meet Jean-Paul Agon, Chairman and CEO of L'Oréal.
Monsieur Agon, thank you so much for speaking to Bloomberg.
Pleasure.
What happened to L'Oréal in the last 10 years? Innovation, your share price has grown. Was it exciting times?
Yeah, very exciting. You know, I started as a CEO 10 years ago. It has been 10 years very exciting. Of course, we had a crisis in 2008 and 9, but globally the business has been very good. We have been growing, acquiring brands, launching new products, gaining market shares everywhere in Europe, USA, China. No, very exciting, fantastic.
What's been the most fun?
In fact, the most fun has been the past 3-4 years because thanks to the digital revolution, everything has been transformed. And as I tell my teams, I think that this industry, our business, our company has more changed in the past 3 years than in the previous 30 years. So it's an amazing time, extremely exciting.
So is this the way you sell, or is it the way that people actually look at makeup?
No, in fact, it's the relationship between brands and consumers. In fact, the digital has completely transformed the relationship between the two. Before that, you know, the brands were talking to consumers, pushing towards them information or whatever. But now the consumer has taken the power. The consumer decides how he wants to see the brands, what he wants to know, how he wants to discover them. Digital, in fact, creates a relationship that has nothing to do with what existed before.
But isn't it much more difficult, therefore, to control your brand?
Yeah, but at the same time, it's more exciting, and it enriches the relationship. So now, thanks to digital, we can communicate the content of our brands. We can do tutorials to explain how the products work, how they should be used. We can have a personalized relationship with consumers. So it's a completely new dimension. It's much more rich and exciting.
So what sells at the moment? Is it the luxury brands or is it the more consumer brands?
This year, luxury. This year, luxury has been booming everywhere, mostly with Chinese consumers. You know, Chinese consumers are fantastic. They love beauty, they love luxury, they love our brands, and our business with Chinese consumers everywhere has been booming.
L'Oréal's global reach stretches across 140 countries. About 2/3 of its sales are generated outside of Europe. Much attention has shifted to China, where strong demand for high-end lipstick and perfume is driving growth.
谁说爽肤水都一样？不。
In 2015, China surpassed France to become the group's second biggest market behind the United States. Some of the success is being attributed to selfies, with camera-conscious millennials buying more makeup than ever before to look good instantly.
Have you had to adapt to the Chinese market?
Yeah, in fact, the products we sell, not for all brands, because the luxury brands, for example, are the same all over the world, of course, but for our mass brands like L'Oréal, like Maybelline, the product that we sell in China are formulated in China by Chinese, in our Chinese labs.
Because of regulation?
Not only, but also because we want to create the products that are absolutely right for them, especially skincare, because their needs, their skin, their aspirations are specific, are different. So we formulate in our Chinese labs, we manufacture in our Chinese factories, and L'Oréal now is L'Oréal Paris is the #1 beauty brand in China.
I've also been reading that one of the most popular products is actually a homemade, I guess, range of cosmetics wear, which is favored by the wife of the president, President Xi.
Yeah, it's a great brand, but still the #1 beauty brand in China, the preferred beauty brand by Chinese women is L'Oréal. L'Oréal Paris. They call it with the Chinese name. It's Pali Olaya, which is beautiful, by the way. And it's it's great because, you know, the L'Oréal Paris is the #1 beauty brand for Chinese, for Americans, for Europeans, for Russians, everywhere. So it's a
not
great
bad.
Satisfaction. Yeah, yeah, not bad.
So tell me about your success in China. Is it through distribution? Is it through ads? Is it through celebrities? What's the attraction for your brand by the Chinese?
You know, the reason of success of our brands everywhere is always the same. It's #1 quality. You know, we for all our brands, our absolute priority is the quality and safety of our products, and it's something that the Chinese respect a lot. It's very important for them. Number one, innovation. Innovation is extremely important. It's an industry where you have to innovate a lot. You know, more than 15% of our products every year are new in order to keep innovation flowing very strongly. Of course, it's the imagery of the brands. You know, brands like Yves Saint Laurent, Lancôme, Giorgio Armani, L'Oréal Paris. It's a beautiful imagery, and Chinese consumers are very sensitive to that. They like it.
Is the U.S. tough?
Order submitted.
Tough market?
Order
The
submitted.
U.S. this year is a bit tougher, a bit softer, let's say. It's not really tough, but it's a bit softer. Certainly softer than China. But it depends. You know, last year the U.S. was very good. So every year, it's funny because every year the market, roughly, globally, is more or less growing at 4%. But it's never made exactly the same way.
But so how difficult is it to predict what will work and what won't? Why am I using this mascara, not the other mascara? Why am I using this foundation, not the other?
Again, it's very, you know, when you know well your consumers, when you understand their desires, when you can guess their dreams or expectations, then you can really create what they will love.
What will the next 4 years bring? Is there a specific market that you think will grow more? Is it, for example, men's cosmetics or something else?
You know, digital, I think, will be the most important element of transformation of the market. So definitely we're going to see the e-commerce growing. For example, e-commerce in China is already more than 30% of our sales for our mass market brands. So it's huge. So we're going to see digital growing. We're going to see probably new channels also emerging, like specialty stores, our own stores. We are very big in also growing segment is the travel retail, you know, the stores in the airports, because more and more people are traveling. So I think there will be new channels. In terms of regions, of course, the emerging markets are still growing, and our categories are growing too. Makeup has been booming for 2 or 3 years. I think it's going to keep booming. Skincare is growing too. So honestly, I'm very optimistic about the short-term, middle-term, and long-term perspective of this industry.
What do you think you spend most of your innovation on? Is it, for example, making a lipstick that lasts longer? Is it kind of changing it a little bit? I know you have so many products, it's unfair.
And a few secrets.
And a few secrets, but you can tell us, we're amongst friends.
Order submitted. Order submitted. Order submitted.
We were talking about what the next 4 years will bring, and it's a lot more e-commerce. How do I choose my makeup online? It must be difficult to choose the right coloring.
No, because now you have some technologies that are amazing. You know, you can test online on your cell phone, for example, simulate the application of the makeup on your face, and then you see yourself with the lips covered with the lipstick you want, the shade you need, the powder, the mascaras. You know, I did a demonstration of that to my board, you know, completely made up, and it was they were ecstatic.
Was that for the launch of the app?
Yeah.
And so they said yes.
Yeah, I wanted
fantastic.
I wanted to share with the board the fantastic progress of technology. It's amazing.
Oh, I could look like pure reds. Oh, wow.
The lipstick is moving with my mouth, and I know that I don't have any on.
It's like Amy Winehouse flicks. It's brilliant. I can't stop looking at myself.
So this is amazing because you also have to then change, I guess, your research and development. How much of the overall cost goes on actual digital products?
Well, it's
Order
difficult
canceled.
to say
Order
because,
canceled.
it's
Order
everywhere
canceled.
in every brand, in every division. But what I can say is that now, more in terms of media, 1/3 of all the media that we do now goes on digital. In terms of e-commerce, 7% roughly of the sales that we do go on e-commerce through digital, and it's growing 30% a year. So there is a shift happening, which is extremely fast, extremely strong.
The company that invented the platinum blonde is constantly innovating and developing new products as consumer demand changes. At its lab in Paris, scientists have studied more than 7,000 types of hair and are now experimenting with 3D printing. The hope is to one day help people suffering from hair loss. L'Oréal's already created fake skin to avoid testing products on animals and invented a UV patch to monitor exposure to the sun's rays.
We have the #1 R&D facilities in the world. We are spending roughly 3.5% of our sales in research and innovation. And obviously, the most important topics are hair, skin, and hair. This is where we invent and create new formulations for hair care, hair color, all type of hair products.
You also have a patch?
Yeah.
Is that right?
UV patch.
A UV patch, so you put it on to see when you're overexposed to the sun.
Yeah, it's a creation that was made 2 years ago that we presented at the Consumer Electronics Show in Vegas last year. And it's a UV patch, you put it on your skin, and it's linked to your cell phone. And it calls you or it rings when your exposure to UV has been too high. It's a fantastic tool.
So do you think there's going to be more of a trend, which I guess is between the cosmetics and the healthcare?
Yeah, absolutely. Yeah, and also with internet, you know, this triangle between beauty, health of the skin or hair, and Internet of Things is creating new opportunities, and that are going to be very useful for consumers.
What do you like about your job the most?
I love understanding people. You know, I think that one of my strengths is the capacity of empathy with consumers. So I have this capacity to understand, to feel, to
Order canceled.
guess,
Order canceled.
what consumer want, what is their desires, sometimes their dreams, and then to be able to formulate products that will respond to these dreams.
Do you believe you have to take risks to innovate, or
yeah.
actually, do you?
Oh yeah, of course.
Order
Yeah,
submitted.
because every
Order
innovation,
submitted.
by definition,
Order
is a bet.
submitted. Order submitted.
Every launch is a
Order
bet.
submitted.
It's like a new film or a new movie or new music. You never know in advance. But that's the magic of it.
So what do you think you spend most of your innovation on? Is it, for example, making a lipstick that lasts longer? Is it kind of changing it a little bit? I know you have so many products, it's unfair.
And a few secrets.
And a few secrets, but you can tell us, we're amongst friends.
No, we are working on all categories. You know, we have 3,500 researchers from many departments, and they are all working on all type of cosmetics, skincare, hair care, hair color, all sun care. And because fundamentally, as I told you, we really believe first and foremost in terms of efficacy and quality. So the mission of the company, which is beauty for all, is also not only beautiful, but the best of beauty, the best quality, the best performance, the best efficacy, the best safety, and that keeps us busy.
3,500 researchers.
Yeah.
How long does it take from, I don't know, who has a concept of, for example, a new product, until that product being on the shelf for someone to buy?
Depends. Can be very quick when the formulation is easy. Can take maybe 6 months. Or when for example, a marketing guy has a vision, has a dream, but the labs don't know exactly how to formulate it, can take 2 years, 3 years. Really depends.
Mega volume on top, mega volume on bottom. Share it with your friends and buy makeup instantly.
One of the criticisms
Order
often
filled.
leveled
Order
at the beauty
submitted.
industry is
Order
that it's only
submitted.
for young people. Is there any truth in that?
No, not at all. Of course not. First, that would be stupid because we are addressing all needs for all people. And look at our ambassadors. For example, Jane Fonda, Helen Mirren. They are not millennials. So no, honestly not.
Do you sell more to millennials or to people of a more certain age?
No, we sell to everyone. It depends the brand. The brands, of course, some of our brands like NYX, Urban Decay are more targeting
Order canceled.
young
Order
people.
canceled.
Biotherm or L'Oréal Paris may target other categories of consumers, but no, we cover the whole scope of consumers, and in terms of age, in terms of diversity,
Order filled.
in terms of
Order submitted.
countries,
Order
Chinese,
submitted.
Brazilian, Europeans, everyone. It's a beauty for all.
So how do you sell to the emerging markets?
We adapt
Order
the
filled.
the
Order
products
submitted.
that we sell, of course.
Order
We
submitted.
make sure that they are affordable and that people can buy them. Brazil, for example, is very interesting because Brazil is the country in the world where the hair is completely unique because it's such a mixed country in terms of ethnic origins that the blend is completely amazing, and that you have to create for Brazilian hair care products that are completely specific. And by the way, it's very interesting because sometimes they are the most demanding consumers, and so when you can create in Brazil a product that is good for them, then you can make it for the world because it's going to be great for everyone.
Do you think Generation X cares more about this than millennials?
There is an urgency. Clearly, we are not talking anymore about a potential threat. I mean, there is a clear and present threat.
For Jean-Paul Agon, life at L'Oréal began in sales 39 years ago. He quickly understood the power of advertising.
Read my lips. I'm worth it.
The company obviously thinks it is worth it, spending more than $8 billion a year selling and marketing its brands. A third of that on digital media.
When I was 20 years old, I was in a business school, and at the end, I knew I wanted to do marketing. And for me, beauty is the supreme art of marketing, because it's a marketing that is not only about understanding, analytics, but it's also about emotion, guessing, creation. So I think it's a fantastic
Order
marketing.
canceled.
There is no
Order
better
canceled.
marketing than
Order
beauty
submitted.
And from that
Order
20-year-old
filled.
Jean-Paul
Order
Agon, what have
submitted.
you learned
Order
about
submitted.
yourself?
My God, a lot, a lot, because it was a long time ago. No, it took me, many years to get where I am today. But I was always passionate. I think the incredible part of L'Oréal also is that every day is a new adventure. Every day is a passion. It's a company made of really passionate people. And every new mission is an adventure.
So what are you like as a leader, micromanaging or overview?
I like overview, and from time to time I'm tempted to do micromanagement. But when I do that, my team say, Jean-Paul, you should not bother with that. Let us do it.
Do you review, though, the end product every time, or how does it work?
As much as, I have meetings of course, with all the brands. Not all the time, of course. I travel in many countries around the world, and I'm just trying to help to make sure that we are taking the right directions, pushing in the right innovations, understanding enough the consumers we are dealing with, trying to pilot the ship.
L'Oréal's Sharing Beauty with All program, launched in 2013, was designed to transform the business. Jean-Paul Agon was determined to make the company ethically and environmentally sustainable. It's been recognized for its efforts, awarded a AAA for water management, climate, and action against deforestation.
So when did you start thinking about sustainability?
Pretty a long time ago, especially when I came back from the USA and I took over as a CEO. I really understood at that time that for a company like L'Oréal, especially because we are the leader of the beauty industry, we had to make sure that also we would do the best and the most to make the planet a beautiful place.
What started it? Is it because you say we sell so much that we have to make sure that it doesn't go to waste? Or is it also because the consumers want something that's more sustainable? Or is it because the employees you hire want something more sustainable?
Very good points. I think it's all of that. First, because we have a moral duty. Secondly, because it's what our employees are asking for. Third, because it's what consumers want. Fourth, because it's what the society expects from a big company like us. So that's why we really went into this direction.
Does it make a difference for the consumer? I remember you telling me a couple of years ago, that if a consumer has a choice of a sustainable shampoo or a shampoo that makes our hair better, we'll always go for the shampoo that makes our hair better.
Yeah, but now what we want to do is to make a shampoo that makes the hair better and sustainable. Because now in fact, you're right. Our vision is that we have to find a way that it's not opposite, that it goes in the same direction. And it's the same for economic performance. For example, the sustainability performance should not be opposite to the economic performance. And in fact, we are able to prove that. For example, in the past 10 years, we reduced our carbon emission by 67%, when at the same time we were able to increase our production by 30%.
How do you do that?
We work a lot. We transform all our factories. We have now 10 sites that are carbon neutral. We completely transform the way also we engineer with water. We have what we call dry factories, that they don't use water at all. They completely recycle the totality of the water that they use. We eliminate waste. So it's a very comprehensive effort on all fronts to transform completely the way we produce, we distribute, etc.
And shareholders are behind you every step of the way for sustainability?
Yeah, absolutely. They are very, I think that our shareholders are very proud of what we do. I cannot say that they are pushing us hard to do it, but they are happy and proud.
Do you think Generation X cares more about this than millennials? The younger you are, the more you think about this?
I think that everybody now cares. You know, I think that it's very well understood that there is an urgency. Clearly, we are not talking anymore about a potential threat. I mean, there is a clear and present threat to the planet, and if we are not all doing the maximum in the very short term, it's going to be very difficult. So I think that every generation now understand that.
If I speak to you in 5 years, what will be your story?
In 5 years, probably I will tell you that the most important mission has been the transmission. Because, of course, I will not be CEO forever. And I will be, by the way, very glad to pass the baton one day to my successor.
So if you think a lot about succession, what kind of successor would you like, and what would you like your legacy to be?
I will be proud to have been able to adapt L'Oréal to the new world. I think that we are living in a very special period. The world tomorrow will be very different from the world we knew a few years ago. And you know, my absolute priority right now is to adapt, transform the company in order to make it as successful as a leader, as performant in the new world as it was in the world before. And I'm very confident about it, because that's what we are doing. You know, we are doing a cultural revolution, a digital revolution, a sustainability revolution, and so the L'Oréal will be a fantastic company. And then someone else will take the baton and will drive the adventure further.
Jean-Paul Agon, thank you so much.
Thank you very much.
What do the world's tallest building, KFC in the Middle East, and e-commerce site Noon all have in common? They're all owned by billionaire Mohammed Al-Bar. His investments like the Burj Khalifa and the Dubai Mall have become iconic landmarks, and he's diversified into hospitality, retail, and e-commerce. He was named the most influential man in Dubai and consistently ranks amongst the top 5 most powerful Arab business leaders. But it's not all business all the time. He's also a sportsman. He's an active member of Emirates' horse racing community. Today, on Leaders with Laqwa, we meet Mohammed Al-Bar, the founder and chairman of Amar Properties.
Thank you so much for joining us. You've really built a conglomerate. You've built a company that has multiple interests, multiple units, multiple portfolios. Did you diversify because you saw an opportunity or because you had to?
Well, I think all of us, we look at opportunities.
Order
we don't really
canceled.
have to do anything.
Order canceled.
But I think looking at the Middle East and looking at the industries that I went in
Order
with my
canceled.
team, I think
Order
we saw
submitted.
amazing
Order
opportunities
filled.
in the Middle
Order
East
submitted. Order
in these
submitted.
sectors.
Order submitted.
And I'm glad that even though we've got difficult years, the past 2 years have been difficult years for us, still these businesses are operating well. So definitely it's based on opportunities and the sector's long-term growth potential.
Where do you see the most growth coming from? Which portfolio, which part of your business will do better than others?
The food operating well and strong in the region as a whole, especially with the food delivery business, and that's another story. I would say that our real estate business is still flying really strong. I mean, last year we grew about 28% in the region as a whole. Our e-commerce business is something that's very, very interesting. And we've got an amazing team looking at it, and that's also growing quite fast. But even with this growth, I think one have to be realistic as well. So you look at this growth and you look at what's going on in the Middle East, government policies, look at the world economy and what changes might take place. So you have to be alert at all times.
Okay, what does that mean? Do you expect a lot of the growth, in the Middle East? If you look at e-commerce, and we'll talk a little bit more about that, do you expect it to go threefold, fivefold over the next 5 years?
Well, I would say that our real estate business should continue to grow at about 20% a year. And that's the shareholders' expectation. And it's hard work to achieve that number and keeping cost under control, margins under control, and political and macroeconomic issues in hand. So a food business, I think we should be growing 10% a year, year on year as well in the region. And keep in mind that, we're talking about the Middle East where, there is a need for most of industries to grow, just because that I think the Middle East still has room to grow. And the other thing is that if you look at the population in the Middle East as well, and the whole demographics is in our favor.
Because they're young, and therefore these are I guess, the youth will spend a lot more in 5-10 years.
Yes.
Order submitted.
How will the economy
Order
shift?
submitted. Order filled.
Well, I think
Order submitted.
the economy
Order submitted. Order
will
submitted.
shift positively
Order
only because
submitted.
I believe Middle Eastern governments are really working harder than any other time in the past, and you see the changes that are taking place, positive changes that are taking place in Saudi Arabia. I think that's the same thing within UAE. I would look at Egypt. I'm quite interested in Egypt as well, and the change that's taking place in Egypt.
Order
with all
canceled.
the other issues that we have in the Middle East, where I believe that I don't think it's going to get any worse than this. I think we're looking forward to a more positive trend in policy and in politics, in economic growth as well.
Order
in terms of growth, country by country, which is a country that will outperform the others in the Middle East?
Order submitted.
The majority of our focus is Saudi Arabia, UAE, Egypt. And I would say Egypt is going faster now. Saudi Arabia, I'm quite optimistic with the changes that you see taking place within the coming 24 months. I think you'll see quite a good trend, and the the UAE as well. You've got, of course, the other Arab countries who are some slow, some moving forward, but majority of our business are in these countries.
I mean, you're holding a big investment with the PIF on e-commerce for Saudi Arabia. Will there be more, for example, on property in Saudi Arabia?
Well, the Public Investment Fund, they are with us in our e-commerce business, but they are also with us in our food business. Now, are we going to do more together? I think there's a possibility. There's a lot of work that they're doing in Saudi Arabia and outside Saudi Arabia, in the region and outside. So I would expect that maybe we should look at real estate together as well, because I think Saudi Arabia will look very interesting the coming years.
How much can it grow, property in Saudi Arabia, over the next 5 years?
Oh, Saudi Arabia, I think it's at infant stage. I think Saudi Arabia can really grow if you talk about pure infrastructure, if you talk about retail, industrial, hospitality, residential. So you just have to make sure that you are going at the right category of residential or the right category of retail. So there's plenty of room to go that way.
When you look at how you spend your time for each of the units and also each of the countries, how do you do it? How do you keep on top of it all?
Well, I try.
Order canceled. Order
I
canceled.
still say that
Order
the
submitted.
real estate takes
Order
the majority
filled.
of my
Order
time.
submitted.
Is that 50%?
Order
I
submitted.
would say the real estate takes about 40%
Order
of my
filled.
time. And then the rest is a split. Noon takes a lot of my time as well. The food takes the least of my time, because the team that sits on top of that business is really world-class team. And they've been in the industry, they know the industry well. Noon is a vibrant team. It's a new organization. I need to give it more time. While my real estate business, I have an A team, but I'm emotional about real estate.
Yeah, I mean, this was like the foundation of it all, right? Do you still see it as your baby?
I think my name is really linked to the real estate more than anything else, while all these other businesses, I've been with them now for about 2 years. So it's a new brand of product that's associated with me.
When you look at the various IPOs and the various units, was it to unlock value, but did you ever feel like it was also high risk?
I think mainly to unlock value, and we have investors who have put in their money with us, and it's time for them to get rewarded. But at the same time, I really like putting management under pressure, because IPO is quarterly results. You're out there in the public eyes, under pressure to perform. But mainly value creation. I think that's the business we're in.
Value creation, because what shareholders understand what you do more, and it almost focuses the mind of managers more?
Well, that is one, but many of our units, that if they're under the mother umbrella, I think value-wise, they're not fairly valued. So as we put them on the side and put them as separate entities, I think you create better value that way, and then you cash out a little bit and put management under pressure.
Are you looking at IPOing any other units or portfolios?
Order
when you look
canceled.
at our business,
Order
we have businesses.
Order filled.
We have India.
Order
we
submitted.
have
Order
our hospitality
submitted.
business.
Order
we have
submitted.
Turkey business. We have another business in Saudi Arabia. So the reality is that you can take all these businesses public at the right time. I think within the coming 3 years, we'll probably have India going public. We'll probably have hospitality as well going separately to the public route.
But so how much bigger will you be if I speak to you, and I hope to speak to you before, but if I speak to you in 5 years, how much will your holdings be worth?
I think we should be double in value, because we should be growing in value 20-25% on an annual basis. And I hope that my management and my boards really put that as a focus. And to be honest, I think we're capable of doing that. We just have to focus and have to make sure that we have the right people to do it. And we do this day and night. And that's really how we do business in our region.
But that's acquisitions or that's organic growth?
I would look at organic growth. If you talk about acquisition, which we have not done much of, I'm expecting that we do more acquisition in the coming 2 years.
Mohammed Alabar, thank you so much. Coming up next, going from bricks and mortar to clicks, we talk Mohammed Alabar's big push into e-commerce and how his company Noon could become the Amazon of the Middle East.
Order canceled. Order canceled. Order canceled.
Mohammed Albar is not only a titan of property, he's also betting on e-commerce. His startup, Noon, launched its operations in the UAE last year. The site is described as an Arabic-first e-commerce platform and is rivaling the Amazon-purchased Souk, looking to take over 15% of the growing market. One of the biggest investors in Noon is Saudi Arabia's public investment fund, which put up $500 million. But Albar is not just competing against Amazon. He's also a major player in the luxury space. He's partnered with Yux Net-a-Porter Group to offer a premium retail service to the Middle East's fashionista set.
So Mohammed Albar, do you ever feel like there's a conflict that you actually own Dubai malls, but at the same time you're trying to sell on e-commerce platforms?
The issue is that, are you relevant? That's really the big question that we have, is that I don't think it's if there's a conflict or not, but are you relevant to the space? So are we really relevant in this retail scene, or in the whole, the economy is becoming so digital. If you are not thinking about it, if you're not acting to do something about it, I think there is a risk of your business, being probably at huge danger the coming 24 months.
And so how do you stay relevant?
I think staying relevant, first of all, I have to talk to my kids all the time. And I learn from them because, I have a little girl that sells jewelry to women in Korea out of Dubai on her Instagram. I mean, what type of world is this? So therefore, I think all of our business, from real estate to retail to hospitality, I think the digital scene is changing all that. So if we talk about e-commerce specifically, or if we talk about Net-a-Porter, it is just moving your business to the digital scene. And I think the whole economy is moving that way, from healthcare to education to retail. So therefore, I think we just want to be relevant. And I don't think there's any conflict, because at the end of the day, there ought to be a collaboration or connection between the real world and the physical world. And can we really try to find a solution and work them together and stay relevant in our business?
But so how much of your sales will actually be done on your e-commerce platform in 5-10 years? And in general, for the Middle East, are you a step behind in actually selling on e-commerce? And so is the potential much bigger than here in Europe or in the US?
Canceled.
Well,
Order canceled.
I mean, when I look at the Middle East right now, I mean, e-commerce is between 1.5% to 2%.
Tiny.
Which is tiny compared to the rest of the world. So there is room for all of us to grow. Where will this be? I think it will go much faster than the rest of the world, and it will get into the 10-15% quite fast, again, because of the demographics of the region. So we owe it to our society, we owe it to our 300 million Middle Eastern Arabs, that there ought to be a native organization that look after this sector and participate and learn and serve.
What will Noon become? And are you nervous at any point that you're going to head with the most successful retailer of all times, Amazon?
Well, Noon, of course, it will be an ecosystem. And am I nervous? Of course I'm nervous. I'm nervous from everybody. In my real estate business, I'm nervous. In my e-commerce business, I'm nervous. In my Net-a-Porter business, nervous, because competition is severe and markets are open. Anybody can come in. The big players are going to come in. Some of them came already. More are going to come to the region. But I am from that part of the world, and I think it's our duty to participate in the scene. And remember, we as Arab businessmen, we're a bit tribal, which means that I am from this society. I have a duty that get into business and be aggressive and achieve the numbers, achieve success. But that's a duty that I feel responsible for. That competition is good for the consumer in the region, rather than one player come and controlling the life of our customers. I think it's fair to have competition and let the customer win at the end of the day.
Okay, but how do you decide? I mean, how will you go against Amazon? Do you have to convince retailers to sell on your platform instead of Amazon's platforms, or is it a price war? I mean, how do you see the kind of the fault lines?
Well, we are working with the local retailers, and we are their partners. Now, how other international players, they do it through sourcing overseas or working some other methods, that's their business. But we differ is that our partners are the local retailers. Maybe our margins will be a little smaller, but that's okay. We'd rather win on the long term rather than alienating the local retailers. Now, will there be a price war? Well, the past 2 months, there's a price war. Customers are winning. Everybody's 20% or 15, 10% cheaper in some of the product. So I'm so happy that people in my region, they don't have to milk for their kids at 10% more expensive. There was one operator or one monopoly controlling, the human life. I think this is good for all of us. So of course there'll be a competition. But the amazing thing is that the world is open. So much new technologies are being provided to everyone that want to go into the scene. But are you planning long term? You have good people with you. Are you serious about it? Are you willing to provide quality service?
But is it the service or is it the products? How does the Middle East actually shop? What's selling at the moment and what will sell in 5-10 years?
Well, if you look at the mix of what's happening on the e-commerce scene, it's not much different from what's going on in the world. People want delivery, fast delivery. People want quality.
Will they pay for the delivery?
For the time being, we're subsidizing delivery. Because, as I said, people are just learning the art of e-commerce, and that's what global companies are doing. They give it to you for free first, they get you used to this way of life, then later on take a little bit of margin, maybe control market, the usual trick. But what I'm saying is that people want it all. Want quality, want value, want consistent, want delivery time that's fast, and we want the product that they want, which changes from 1 month to another month. And therefore you have to provide that and then get ready to provide the new thing that might be happening next month.
Okay, how important is market share? And how important is market share right at the beginning so that people get used to your platform and not Amazon's?
Market share is very important, and at the beginning you have to be aggressive and you have to probably provide the best service ever. You will be cutting prices as usual because we see it, it's a live competition, there's nothing wrong with that. But the good thing is that the market's big enough. 2 players can come in. But imagine if you do business in UK and there is only one operator. How fair is that?
Order
to your
submitted.
family?
But isn't there only Amazon here?
Well, there are many other players, I think, in UK as well. I prefer that more than one player in a market. And in the Middle East, there will be more than one player and will be one of the major players in the market.
Up next, we talk the leadership skills it takes to create both the world's largest mall and the tallest building in the world. More with Mohammed Alibar next.
Order filled.
MR Properties has grown more than threefold since 2011 and expanded heavily in the Middle East and North Africa despite political instability in the region. So what kind of leadership does it take to shepherd a global company through turbulent times? Well, Mohammed Albar, chairman and founder of MR Properties, is here. What kind of leader are you? Throughout the program, we were talking about encouraging your leaders, your regional leaders, and also your portfolio managers to be aggressive. Do they always need to be on their toes?
Well, I think, number one, they have to be relevant because the change that's taking place in the world. So are you relevant? And the other thing I like is that I think we all have to believe in the reset. Are you doing this upgrade? Are we upgrading every 1 month? Because there's so much happening. And do we really act? I mean, that's, so we have to be relevant, we have to act, we have to have discipline, we have to believe in the best people, and we have to take care of our society. These are things that these are the elements that I really depend on to manage my business.
Okay, but what does it mean being relevant? Because in more traditional times, you could ask a customer what they wanted, and you're saying, okay, I'm relevant. But now the change of pace is so fast.
Well, relevant is that, are you watching social media daily, what's going on with your customer? And what's going on with your business? There's no more I'll do a research and I'll wait 30 days. How alert are you? And how alert about how your customer feel, or alert what's going on to the industry, what's going on with politics, what's going on with the economy, what's going on in new tools of management, how fast can you go? So I think, are you awake?
What do you need to be awake for more? Is it for your clients, or is it politics, or is it how your business interests are going?
Well, it's about my customer, number one, my people, number two, the society, what's going on in politics, what might happen to interest rate. You almost have to have all that construction risk in my business, what's going on in technology, what's going on in digital. You almost have to be alert of all this but number one, people. And then you have to make sure that you share with them this environment, and are they fit in this environment?
So what does that mean? What do you see your role? Are you putting the fire under your manager's feet to kind of keep them going, or do you micromanage?
I don't think I micromanage, but there's a situation where I do have to go and micromanage, and I think that's we should be able to go down in case we want to. And remember, I came from my mom's kitchen. I used to work in my mom's kitchen, and when we were all 13 kids living in one room, so I know how to do that. So I can pull back and be the chairman of the organization. But if there's need to move in, I can comfortably move in. But I have reasonably good qualified people with me. But I really think that I'm the target creator. I'm the guy who does the monthly performance reviews. I'm the guy who push the limits. I want people to work hard, because I think we as human beings, our productivity is still low.
I mean, you spend a lot of time in property because that's where you came from. That was the first company. But what excites you the most in all the others that you're doing? So hospitality, retail, e-commerce.
I would say e-commerce excites me a lot, because when I look at how the digital world is changing our lives, I come back to my real estate business and I say, maybe this office is null and void. Maybe this is all not required anymore. But also, if you look at the digital guys and you see how fast they work, or the process they use, or the age of people in these offices. Therefore, I really believe that the younger generation are running the world, and they run it extremely well. So much learning in the digital side of the e-commerce. But I think my investment in MEVP, which is a private equity firm that specializes only in digital and technology in the Middle East, with almost 80 ventures, that's amazing learning about what's going on in the Middle East as well, and the industry that are about to come.
Do you focus a lot on diversity for your companies? Is that important?
Yes, very important, very important. And I think it's happening naturally. I mean, we don't even have to do it anymore. It's just naturally, that's how.
So do you have metrics?
We have metrics, we have KPIs for that. But as I said, it's so nice that it's really embodied in the organization. It's happening automatically, and I like that.
Do you think it will increase with time, or are you going to see more female workers?
The female workers are really taking charge.
Order submitted.
If you look at the people who run my organization, most of our organization, I would say most of our organization, our food boys have to have more of that.
Order submitted.
But look at our government. highest percentage of senior people in government anywhere in the world.
Mohammed Alabar, thank you so much for joining us. He is, of course, the chairman and founder of MR Properties.
Thank you so much.
Thank you.
Thanks.
Order filled. Order filled. Order canceled. Order canceled. Order canceled. Order submitted. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order submitted.
Good morning from Bloomberg. I'm Anna Edwards, live in London. This is the European Market Open on
Order
Bloomberg
filled.
Television,
Order
alongside
filled.
Matt Miller, who's in Berlin.
Good morning, Anna. Today the markets say weathered the storm. Oil markets collapsed, but stocks trade mixed after China pledges more stimulus.
Order submitted.
European
Order
futures
submitted.
are higher
Order
ahead of the
submitted.
cash trade less than an hour away. Here are your top headlines. Blame game. President Trump raised the prospect that China deliberately caused the coronavirus outbreak. This as the U.S. pauses some tariffs for 90 days, but not those on Chinese steel or aluminum. Crude collapse. WTI sags to its lowest level in the 21st century on concerns that storage space is running low. The demand outlook remains gloomy. And signs of easing. Germany begins to reopen its economy as Spain, France, and the UK report the fewest coronavirus fatalities in weeks. As I said, just under an hour away from the start of cash trading. Let's take a look at where futures are headed. In Europe, futures are higher, whereas
Order
US futures
submitted.
are down. Here you can see
Order submitted.
the FTSE 100 futures up more than 1%, as are the DAX futures. However, if you look at S&P, Dow Jones, and Nasdaq futures, you'll see red arrows there. So further away from the start of trade on Wall Street, but it looks like we'll kick off the week here in Europe higher. Anna?
Yeah, indeed. So yeah, that divide between Europe and US futures interesting. We'll watch out for that as we go through the morning here, Europe time, of course, Matt. Let's get up to date on the first word news, our top stories here at Bloomberg. We start in the United States. The US is temporarily postponing certain tariff payments for 90 days. The move is aimed at freeing up cash for businesses hardest hit by the pandemic. It's also limited in scope, so it won't ease US duties on China, steel and aluminium, or enforcement actions, including those taken against Airbus. In the UK, the government is furiously defending its handling of the coronavirus crisis. This comes after a Sunday Times story suggesting Prime Minister Boris Johnson failed to take the outbreak seriously enough in its early stages. The government issued a rebuttal saying the article contains, quote, a series of falsehoods. The coronavirus pandemic is showing signs of easing in Europe, Italy, Spain and France. all of those countries reporting the smallest increases in fatalities in weeks. But the path to return to a normal life isn't clear. France says it will unveil its plans within 2 weeks. The current lockdown could see the French economy contract by about 10% in the year 2020. Matt?
All right, so that's your Bloomberg Business Flash. Now, Asian stocks traded mixed while the dollar strengthened on Monday, which is today, as investors prepared for a dour earnings season, while keeping an eye on tentative signs that the coronavirus infection rates and those deaths as well are decelerating in some countries. Crude oil prices collapsed anew, with West Texas Intermediate crude plunging below $15 a barrel, down to 14 and change, the lowest level since at least 2001. Let's get into the markets now with Laura Cooper, our Bloomberg MLive macro strategist. So, Laura, let's talk first about oil. This month's contract has absolutely tanked. What does that mean for next month's contract?
Well, certainly when we look at the May contract, we are seeing it as in part a technical move because it is coming unto expiry. So some of that pressure sending it to a 21-year low is just on the back of those calendar rolls. But then even when we look to the June contract, what's interesting is that that's actually under pressure as well. And it's actually trading at about 5 times the traditional volume. And so this suggests that markets are concerned about the near-term capacity to store a lot of this crude, because ultimately when we still have, these 10% production cuts coming from OPEC plus members, that's not enough to curtail any kind of demand destruction that is in play. So likely at this point, we're going to have to see some kind of U.S. lifting of lockdowns, because they account for about 20% of global demand, to spur a catalyst in terms of the West Texas price in and of itself. But then something else that's worth noting is that we are seeing actual retail investors really pile into ETFs. So this does point to potentially there's hopes of this market rebound coming through.
Yeah, really interesting to see the June taking over as the most traded contract as we get towards the
Order
end
submitted.
of the relevance
Order
of May.
submitted.
Because if
Order
you've
submitted.
got the May contract, of course, you only have a day or slightly more than a day perhaps, but a day to either sell it or take delivery. And that's perhaps something that with storage running out, some people don't want to do. Laura, let me ask you about stimulus, because anybody following the oil story will one day think about stimulus, even
Order
if right
filled.
now that's not the story.
Order submitted.
China, of
Order
course, putting
submitted.
in place some
Order
further measures,
filled.
some rate
Order
cuts
submitted.
of a sort.
Order submitted.
Over the weekend. What's the latest thinking on what China has done and more to come from the Chinese?
Well, so we did see China lower
Order
its loan
filled.
prime rate.
Order
now, this is largely
submitted.
as expected.
Order
so the
submitted.
1 year was slashed by about 20 basis points. And this is crucial because this is where most new and outstanding loans are based, in this 1 year prime rate. Now, the 5-year rate was slashed just by about 10 basis points, so it's slightly less. And this is just ultimately to keep a lid on home prices. But given the fact that, we are likely to see the Chinese economy, it's going to take quite a number of months to get it back to those pre-crisis levels. So this points to the need for these accommodative positions or accommodative stimulus to persist, and likely even to be the case that we're going to need further cuts down the road, just given the fact that we are going to need to continue to see borrowing costs be contained in China. But then even then, we are seeing interest rates across the curve extend decline. So the 3 years about a 10-year low. So it's not yet an
Order
issue of
filled.
concern in terms of tightening conditions here, but certainly it's going to keep the PBOC on
Order
watch.
filled. Order filled.
Laura, today I'm just wondering what the bull-bear debate is like. I saw Cudmore out saying that the bears are hard-pressed to make their case, although he is in that camp as well. What are you hearing from the rest of the team?
Well, I think it's interesting because I think at this stage it's really the question of, will these lifting of lockdowns be successful to the point that we will see this unleashing of pent-up demand, and that will, spur a sharp V-shaped recovery in the U.S. economy in particular, or whether we're going to have to see potentially a second wave of restrictions, which is going to actually even magnify the economic downturn at hand. As well, we're seeing markets largely shrug off what is record declines across economic activity. And so this does point to markets looking through this dour period to that recovery. And a part of this could be just the swift and proactive and quite exceptional massive measures of stimulus coming notably from the Fed.
Order
so it could be the case that is that enough to actually pump up a lot of these businesses, a lot of households, to allow for a fairly swift recovery. Now, we're getting mixed reviews from certain Fed members, but ultimately there's so many uncertainties at this point. It's really too hard to declare victory for either the bulls or the bears at this stage.
Laura, thanks very much. Laura Cooper joining us from our Markets Live team. Of course, IB plus TV Go is the function to use if you want to get in touch with the TV team, the M Live team, and give us your thoughts on what you see on the blog or here on Bloomberg Television. Up next, oil plunges. We've been talking about that with Laura. We'll get an investor's perspective on what's going at least on in the front end of the oil curve. Oil plunges to the lowest in more than 2 decades amid concerns the world is rapidly running out of places to store crude. We'll get thoughts on that next. This is Bloomberg.
Order filled. Order submitted. Order filled. Order submitted. Order submitted. Order submitted. Order filled. Order filled. Order submitted. Order submitted. Order canceled.
Welcome back to Bloomberg Markets. This is the European Open. We are just under 50 minutes away from the start of cash equity trading across Europe and in the UK, and right now we're seeing futures that point higher. Let's get to Bloomberg Business Flash. Here are today's top corporate stories for you. A $1.2 trillion fund says forget earnings season, buy U.S. stocks. Jim McDonald of Northern Trust thinks this round of reporting won't offer much for investors. What's more important is understanding how the economy will get back on its feet when the lockdown ends. For that, he says, look to Europe for clues. Alibaba is planning to invest $28 billion on cloud infrastructure over the next 3 years. It's a major effort to extend one of its fastest growing businesses. The sector's revenue rose 62% in the December quarter. The Chinese e-commerce giant will build more data centers and will continue to develop its own technologies, such as AI chips. Credit Suisse is compensating managers and employees with additional shares. That's after the price dropped sharply amid the coronavirus pandemic, getting cut more than in half from a late February high. The bank's overall bonus pool is down 1%. The new CEO, Thomas Gottstein, signaled to a Swiss TV channel that the lender may curb pay for 2020 to show solidarity amid the crisis. And that is your Bloomberg Business Flash. Anna?
Matt, let's talk more about oil then. We touched on this a little earlier and in the headlines, of course. Oil extending its slide, with WTI prices falling to the lowest in more than 2 decades, on concern the world is rapidly running out of places to store the crude. That after output cuts proved insufficient to cope with plunging demand. The current May contract expires tomorrow, Tuesday. However, with the more active June futures falling by around a third as much on more than 5 times as much trading volume. Joining us now is Charles Dumas, Chief Economist at TS Lombard. So even excluding, good morning to you, Charles, even excluding the May contract, looking at the June contract, we are still seeing further moves to the downside in oil prices. That's where the volume seems to be right now. What kind of visibility can you hope to have, Charles, around the oil price? We see strategies to cooperate seemingly agreed, but then perhaps not followed through on, or difficult to conclude, a lack of storage. Any visibility at all around oil?
Yeah, well, I think the point is simply that the economies of the world are going down by much more than was previously reckoned in the second quarter. Specifically, if we look at what happened to China in the first quarter, which after all was the lead element in this whole coronavirus problem, on our recalculation of Chinese GDP, it fell over 12% in the first quarter from the fourth quarter of last year, which is to say an annual rate of about 40%.
Order filled.
And
Order submitted.
In those
Order
circumstances,
submitted.
The oil price, of course, is going to go down.
Filled.
If
Order
anything
submitted.
like that is happening
Order
elsewhere, the oil price is going to go down quite a lot further. And in fact, arguably, you might have to sort of pay someone to take delivery of the stuff.
What effect does that have on the economy, Charles? Because it would seem to me that cheaper oil prices are good for consumers and good for business. On the other hand, people are talking in terms of miles per week now instead of miles per gallon as the lockdown continues. And of course, in economies like the U.S., the oil industry employs a ton of people.
Yeah, exactly. If you look at who benefits and who loses, quite clearly the consumers benefit and the producers lose. So obviously it's very bad news for the Middle East and for Russia and for anyone really dependent on oil production. In the case of the Eurozone, it is almost entirely an importer of oil and therefore is a beneficiary. On the other hand, in the case of the United States, there are very large sections of the economy, and particularly the shale frackers, who are going to be in serious trouble as a result of this. And specifically, of course, what this does is give evidence that the world economy is actually suffering probably more in the second quarter than even our dire forecasts have suggested.
Worth pointing out, of course, as you suggest there, the role of the US in producing the stuff these days as well as consuming it, and that perhaps different to the last time we saw oil prices down this low. What does that do then to the US economy, Charles? Taking those two dynamics that Matt was illustrating together, what does this do to the US economy, a weaker oil price to this extent?
Well, what it does is it sends the stock market down. There's been an absurd run-up of the stock market on the basis that somehow people can just ignore the fact that there's going to be no earnings at all this year to speak of. But actually, of course, people will not be able to ignore the lack of earnings, and neither will they be able to ignore the lack of dividends and so on and so forth that make a large part of U.S. personal income. So what this actually tells you is that there is a substantial and very, very major recession in the United States. And of course, what that in turn means is that the stock market is, as the technicians might put it, whistling Dixie.
That's a great phrase, a great American phrase there, Charles. What do you expect in terms of the economic rebound on the other side? Because that's what some firms like Northern Trust are pointing to as kind of light at the end of the tunnel that will bring markets back. And Northern Trust notably says watch Europe as an example for what happens in the U.S.
Yes, well, I think optimism is a very admirable state of mind, but I think we've got to realize that people are not going to come out of this and suddenly say, oh yeah, okay, well, in fact, I'm going back to that sports event that I went to before and that theater, I'm going back to that restaurant, I'm going back to that bar, because there won't be a complete cure. There'll simply be some sort of decisions about just how to handle things on a day-to-day basis, and so it is absurdly optimistic to imagine that people are suddenly going to snap back and do exactly what they were doing 6 months ago in 3 or 6 months' time. They're not. And in addition, there's going to be, in response to this very substantial drop in the economy, there's going to be a very significant slowdown of business capital spending. And that in turn means that it carries the slowness forward into the third quarter, we think for sure, as another negative quarter after a huge crash in the second quarter. And then only a very tepid recovery starting in the fourth quarter. So I think it's completely unrealistic to imagine that you can just look through this downswing that's taking place now.
All right, Charles, you're going to stick with us. We get more from Charles Dumas, chief economist at TS Lombard, in the next block. Coming up, Europe starts the week with some tentative signs of an easing on restrictions of everyday life. We'll bring you the latest next. This is Bloomberg.
Order filled. Order filled. Order filled. Order canceled. Order canceled. Order submitted. Order submitted. Order submitted. Order submitted. Order submitted.
Welcome back to the European market open. 36 minutes to go until the start of the European equity trading day. We're seeing this divergence between US futures and European futures pointing slightly in different directions right now. Let's focus on what's going on here in Europe. The region starts the week with some tentative signs of an easing in restrictions on everyday life. From today, Germany will allow shops of less than 800 square meters to open. Spain, meanwhile, plans to extend its lockdown into May, but will loosen restrictions on children going outside, which have been up to this point in place. Charles Dumas is chief economist at TS Lombard and is still with us. Charles, what is your concern around the Eurozone right now? Clearly, everyone's focused on infections in various countries, on lockdown measures, on the easing of lockdown measures, but more structurally, if you like, around the Eurozone. You, as well as others I know, have concerns around the sustainability of or the lack of fiscal infrastructure.
Well, I think the basic problem is that the measures that have been taken to deal with the financial stress of companies under the recession that's taking place in the second quarter, the solution has entirely consisted of measures to make sure that they don't go under, which is fine by itself. But of course, what's needed is actual spending to take the economy out of this recession. So if we take the Eurozone economy in aggregate, and of course you focused on Germany, which is the best placed of the countries, the reduction of GDP in the first quarter we think will come out at about 1.5% to 2%, and in the second quarter at about 5%. Which is a 20% annual rate, of course. And that means you by the third quarter, or indeed by the second quarter, you're already down by about 6 or 7% from the end of last year.
Order
and the
canceled.
question is,
Order
are we
canceled.
suddenly going to bounce
Order
out
canceled.
of that? And I think the short answer is no. People will, of course, consume a little bit more, but on the other hand, business capital spending will be down, and world trade is very weak. Which means that exports, which European countries depend on to a great extent, will not be bouncing. They will almost certainly be down and depressed through most of the year. So we really
Charles,
depend upon spending.
What's the problem with the government spending or the government aid packages that are out there? I mean, I read that, for example, the lockdown has deprived German retailers of 30 billion euros in sales. On the other hand, the German government has fast-tracked 1 trillion euros in aid to company and workers. Is there a problem with the pipes? Are too many people gaming the system? I mean, that just doesn't add up.
No, I don't. I'm not concerned about whether the German government can afford to do what it's doing.
Order submitted.
And the
Order
Germans
submitted.
actually handled
Order
the
submitted.
2009 recession rather well with a system they call Kurzarbeit, which means short-time working, and they're probably doing the same again now. So in that sense, the measures are okay. But the problem, of course, is that if I'm insolvent and the government supports me, that's fine. But it doesn't mean that I'm suddenly going to go out and spend money on expansion, or indeed, if I continue to be insolvent, it won't be obvious that the government will continue to support me indefinitely.
Charles, thank you very much. Thanks for your time this morning. We appreciate it this Monday morning. Charles Dumas, Chief Economist at TS Lombard. Thank you very much for joining us. Up next, we'll talk further about oil. Oil is heading for an extra dose of unpredictability as the current contract nears expiration. We've seen a lot of volume jumping from the May contract into the June contract, even if the May contract still has a day or so to go. But even the June contract does look to be relatively under pressure. Storage is filling up, and various people pointing out that we have had statements of cooperation from producers of oil, but sometimes they have not been followed through on with any real agreements on production. We'll talk about oil next. This is Bloomberg.
Order canceled. Order canceled. Order canceled.
Welcome back to the European Market Open here on Bloomberg TV. We're 30 minutes away from the start of cash equities trading, and European futures do point higher. US futures a little more sluggish, a little catch-up happening here in Europe, but European futures do point up by around 1.2% for UK futures. Let's talk about some of the things we're watching out for this week. We've got quite a few things on the agenda. As first quarter results from Europe's biggest companies start to come through, markets are bracing for the worst numbers in years after major economies closed down to stem the spread of the coronavirus. So, of course, there'll be a lot of focus on the outlooks and any visibility and what this does to return of cash to shareholders. But tech firms such as Netflix are set to tell different stories, of course. The streaming service is expected to show strong subscriber growth when it reports numbers. That's coming on Tuesday. That follows increased demand for home entertainment, as no doubt all of us can attest to. Health comes into focus on Wednesday when pharmaceuticals giant Roche reports. The company announced on Friday that it aims to start selling a COVID-19 antibody test early next month. And on Thursday, Credit Suisse publishes its earnings and outlook. The bank, which suspended its plan to buy back as much as $1.5 billion of shares, has said it will withhold part of its dividend payments until the second half, something of a trend, of course, within the banking sector. And multinational food manufacturer Nestle reports its sales and revenue for the quarter on Friday. Really interesting things to talk to you about anybody in the food business, both the challenges and indeed the windfalls they're getting, or they did get at least, from stockpiling in the early phases of this. Matt?
All right, let's get the Bloomberg First Word News right now. Here are today's top stories off the terminal. China is pledging more stimulus after the central bank lowered its one-year loan prime rate to 3.85%. Beijing is promising another trillion yuan in bonds. That's about $140 billion after the economy's first contraction in decades. China's leaders say the nation is facing unprecedented economic difficulties. President Donald Trump says China may be knowingly responsible for the coronavirus outbreak. It's a major change from January and February when the president praised China's leadership in their handling of the crisis. It also echoes comments by Vice President Mike Pence. He told Fox News Sunday China wasn't as forthcoming as it should have been. European central bank officials are pushing for a Eurozone bad bank, according to the Financial Times. The paper reports it could take billions of euros in debt off lenders' balance sheets including non-performing loans left over from the financial crisis. ECB Supervisory Board Chairman Andrea Enria proposed the idea in early 2017, and now he's trying to get it off the ground again. 16 are dead in the deadliest shooting in Canadian history. A gunman in Nova Scotia disguised himself as a police officer, shooting people in their homes and setting fires. Officials have confirmed the perpetrator is now dead. The province's premier says, quote, "This is one of the most senseless acts of violence in our history." Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Matt, let's turn to the subject of oil prices and the weakness there. Oil in New York is heading for an extra dose of unpredictability over the next 2 days. That's as the current contract nears expiration, adding extra volatility to a market that's grappling with a glut of, and of course, evaporating demand. WTI is extending its slide, falling to the lowest price in more than 2 decades. This, of course, is about concern that the world is rapidly running out of places to store the crude. Joining us now from New York is Bloomberg's Anne-Marie Horden. Anne-Marie, talk to us about what's going on in the prices first off. So we see in particular the May contract under real pressure, but much of the volume has switched into the June contract. Those holding May perhaps don't want to take physical delivery of the oil with few places to store it right now. So tell us what's going on with the current or the most the nearest term future, if you like, but then also what's going on a little further out the curve.
Yeah, it's a really good point, Anne, and I'm really glad that you guys brought up there on the chart. You could see all of the deliveries. What you can see happening is just deep contango, and that's what we're in right now. So these contracts that expire tomorrow, you're going to see intense volatility, which we're already seeing, until that's closed out. Basically, financial instruments are meeting the physical market of storage hubs and pipelines. So if you're in this market and you're holding on to that contract that's going to expire tomorrow, if you don't settle up, you have to physically take on that crude. And in America, all that is going to be going to the hub in Cushing, Oklahoma, and then from there it's pipelines to Canada, to mid-Texas, to the Midlands, and to the Gulfs. So if you do not financially settle up, you have to take on that crude. But right now, the rates for the storage are going up. There's just nowhere really left to store them. So twofold, if you're a holder, you might be willing to just capitulate on the price because you just want to get rid of this contract. If you're willing to take on the physical oil, though, you're going to be asking for some seriously steep discounts because of the storage situation. Later out in the year, you can see the prices are a little bit higher, but still, they are still coming under pressure today, the June, July contracts as well. And if you're looking in the physical market, I just have to bring up this one point. In Texas, bidding for crude in Texas offering as little as $2 a barrel for some oil. This is potentially a harbinger of the fact that we could potentially have negative numbers on this physical oil trade.
And yet, I mean, prices at the pump have dropped to $1.80, but people are talking about the fact that, you know, it doesn't matter how cheap gas is if you're not driving anywhere. What about the forward curve, Anne-Marie? I mean, does it look like oil is going to be valued more highly in June, in July, in August?
Yeah, well, that's exactly right. June, they're still under pressure, these contracts, but the prices are higher in June, July, August, and well out until later in the year in December. And that is what the point is of contango is. And that just basically shows that we are flush with crude. But you're not going to really see, Matt, as you say, these gasoline prices, jet fuel prices, all this is under pressure just for the simple fact that no one is using it. I shouldn't say no one, but a majority of people aren't using it. People are stuck in their homes. There's lockdowns. People aren't traveling. Once that starts to pick up, and which is what the curve is trying to foreshadow, that's when you're going to see prices get a little bit more of a floor under them.
And what about producers agreeing concerted action here, Anne-Marie? We talk about this often, certainly between Saudi and the Russians and then the US, talking about what they could do as well. Where does that leave us? Because some suggest, you know, there's a lot of talk and then it's not followed up by action. Others say that there's very little they could do. You know, to Matt's point, if nobody's going anywhere, it becomes very difficult to sell this stuff.
Well, they have agreed, Anna, as we know, this OPEC Plus deal, but the point of the deal is that it just doesn't meet the demand destruction that we are seeing. Whether or not there was an agreement or not, these producers were going to have to ratchet back because of the storage concerns, especially for the likes of inland countries like Russia as well as in the United States. One thing to watch out for, I would say, is that the U.S. has decided to join this agreement in the sense that it will have these economically driven output production cuts. Not mandated, of course, there's more than thousands of producers in the United States, but something to watch is the Texas Railroad Commission. They're in charge of the oil in Texas, this advisory board, basically, and they're going to be voting on whether or not they should pro-mandate on pro-rationing on cutting production in Texas. Potentially, this is something we could see. Normally, we would never be talking about this because everyone in American producers want to talk about this free market that we have in the United States. But this is something that is on the agenda. And the
Order
fact that people
canceled.
are talking about
Order
it, following
submitted.
it like they would
Order
almost
submitted.
an OPEC meeting, brings up some potential that this could potentially be something coming to the United States.
Yeah, I think free market is a term that goes in quotes right now, and you can take it with a huge grain of salt. Anne-Marie, thanks very much. Anne-Marie Horton there reporting on the oil market for us out of New York. Coming up, has the cure been worse than the illness? As Europe begins to reopen, we'll focus on this week's EU summit and the plan to fix the region's broken economies. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are just under 20 minutes away from the start of cash equity trading, and we're looking at futures that are higher. FTSE futures up a little more than 1% right now. Let's get the latest on economic measures in Europe. In the wake of the coronavirus shutdowns, the region starts the week with some easing of the restrictions. Here in Germany, small shops are going to be allowed to open from today in most states, not in Berlin until Wednesday. Meanwhile, the FT reports ECB officials have held talks with the European Commission on setting up a so-called bad bank to vacuum up all the lost loans. Let's get more with Bloomberg's Maria Tadeo, who joins us on the phone from Brussels. So, Maria, what do we know about Europe's economic response, including this bad bank proposal?
Well, exactly, Matt. So what we know is that on Thursday, European leaders are going to meet, and this is a very highly anticipated meeting. And as it usually happens, we're seeing all of these ideas and leaks just go out and being put out in the public to see what sticks when European leaders meet on Thursday. The latest one has to do with the European Central Bank floating the idea of a bad bank that would allow the most stressed lenders to offload some of that bad debt into a bad bank. And you have to put this in the context of the fact that there are people right now who are not going to work, who are not getting paid, companies that have not been able to do any business and have made no money. So there is a likelihood that some companies are not going to be able to service those payments to banks. But the same story does report that the European Commission is saying not so fast. They're not too keen on the idea. And this does show, to some extent, the pattern that we're seeing between countries and institutions that want to put forward new ideas, new tools, and the more hawkish voices that are still saying, let's use what we have.
Maria, talk to me about the latest news flow surrounding lifting of lockdown measures across Europe, because different European countries are going at different paces, and that might be entirely appropriate. They all have their own situations and different levels of infection to deal with. What about Italy? Because this, of course, was the early point of concern for Europe, wasn't it? And now what is Europe saying about lifting lockdown measures? What is Italy saying, sorry?
Well, Anna, at this point, we know that the lockdown will be extended until May 4th. That has been announced already. But tomorrow, Giuseppe Conte will speak before the Senate, and he is expected to provide and put out more detail. We still want to know how many tests, for example, Italy would be able to handle on a weekly basis when they go back to work. But you can see right now the Italian politics, to some extent, are at boiling point this week, because there are two big decisions that will have to be taken almost in conjunction, and that is when to reopen, how to reopen, which regions will go first, but on a bigger macro basis, what to do with the ESM, what to do with that money. Will Italy trigger it or not trigger it? Will Giuseppe Conte put up a big fight on Thursday when he meets with European leaders, and how is that going to end? So you can see that there's a lot of nervousness around the news flow that's coming out of Italy.
Maria, thanks very much. Maria Tadeo there in Brussels with your rundown on what to watch for, basically, in Europe this week. Now, Cleveland Fed President Loretta Mester says it's going to take time for the U.S. economy to reopen. She added that the central bank is too busy limiting damage to the U.S. and markets to be concerned about excessive risk-taking. Take a listen to some of that exclusive conversation.
So we're in a real unprecedented, incredibly deep shock to the economy. And I think it behooves us at the Fed to really use our tools as best we can to get us through this pandemic shutdown period, mitigating the negative impact on the economy so that the recovery can be as best as it can be when we get to that point. Yes, we are moving into unprecedented territory, but remember, we're trying to then lend to firms that, through no fault of their own, were impacted by the virus. And so there are, we are going into, for example, corporate debt programs, which we haven't done before, and we are going to include some fallen angels, right, that, had an investment grade rating before the virus hit. So you're right that we are doing things that we hadn't done before, but at this point, I don't think we can be that concerned about those kind of moral hazards. I really think we have to really look at, this is a hugely impactful and negatively impactful shock, and we have to do all we can to make sure that we're not doing permanent damage to the underlying fundamentals of the economy, so that when the time comes and activity can pick up, we can get a decent recovery out of this.
A lot of what you just said will make sense to a lot of people. Where people struggle, though, Loretta, and maybe you can help us, buying BB credits that were BBB before this might make sense to tons of people. They're huge employers. Buying high-yield ETFs that have CCC credit in them, exposed to a very shaky energy sector that weren't on firm footing before this, doesn't make sense. Why the decision to buy junk ETFs?
Yeah. So part of what we're doing and all the things that we're doing are twofold. One is, right, we're trying to make sure that the markets stay functioning. So some of the efforts that the Fed has done, right, are really geared at market functioning, and some of them are geared to make sure that, right, we mitigate the negative effects on households and businesses by making sure that we have credit flowing to those businesses. So I look at the ETF part of that as a market functioning issue. And we're continuing to look for gaps to make sure that our markets are functioning. And I would say that some of the efforts that we've taken already have improved functioning in the market. So there's two things going on. One is making sure that, and this is the Fed's responsibility, right, is to make sure that we have markets that are well functioning so that credit can flow, right, and do what it can to help shore up the economy to prepare it for the recovery. So, you know, we can disagree on kind of what the right way to do that is, but part of what we're doing is to try to make sure that we have functioning financial markets, precisely because those are an essential ingredient for the economy, for that any other policies that we do can flow through. So there's a transmission to the households and businesses that need those fundings.
I know that at this point the Fed is all in, doing everything it can to try to support the economy. When we get to that third quarter maybe reopening and it's time to stimulate the economy, is there more you think you need to do or can do, and what would that be?
So I think we're going to have to see how what it looks like when we get there. I don't think we're up against any kind of constraint on what we can do. As you've seen, I think we acted appropriately, rapidly, in an unprecedented, rapidly way, really because of the recognition of how deep this shock was, and engineered because of the investment we're making in public health, right? So when we get to that point, we're going to look at our tools, do what we can, again, to support some of the programs that the federal government is doing, in terms of like the PPP, the Paycheck Protection Program, et cetera, and then be prepared to use our tools as appropriate to make sure, one, markets function, and two, that we're supporting the economy as we always do, so that we can get back to a normal, sustainable growth with full employment and price stability. And so that's what our goal is going to be. That's what our goals always are. And we have tools to do that. Yeah. We have forward guidance. We have our interest rate tools that we're doing right now at zero. And we're going to move those things around as appropriate to make sure that the economy can recover and get back to a sustainable growth path.
That was the Cleveland Fed President, Loretta Mester, of course, speaking to Bloomberg exclusively about what the Fed is doing, what the Fed is buying and why. Let's talk a little about what's going on in the UK. The HMRC, that is the tax collecting agency, of course, the HMRC's Chief Executive Officer, Jim Harrer, is speaking elsewhere on domestic radio, saying that the furloughing firms, so companies that have decided to furlough staff, will have their money by April the 30th. This was a scheme that was announced back on March 17th. That's when the Whatever It Takes Chancellor, Rishi Sunak, announced this plan. It's taken some time to get into gear, as it has in many other parts of the world, perhaps, although many questions will be asked about the time it is taking to get money to companies here in the UK, and also questions being asked about loans being given to small and medium-sized businesses and whether the government needs to underwrite or back up a higher percentage of those loans. But lots of questions still here in terms of the UK's response. That latest line then from at the HMRC. Now, we're minutes away from the open. Up next, we'll talk about the burger chain Shake Shack. It says it will return all of its $10 million in loans from the US government, talking about businesses, not so small or medium-sized, perhaps, having access to government funding. That's as the nation faces criticism for struggling to deploy promised funds to struggling small businesses. We'll get some analysis on what that story is all about. This is Bloomberg.
Order filled.
welcome back to Bloomberg Markets. This is the European Open, just about 6 minutes away from the start of trading. Shake Shack, the U.S. burger chain, says it'll return $10 million in loans from the U.S. government. The move follows widespread criticism over large companies that got access to the funds despite them being aimed at saving small businesses. The U.S. is among the nations that crafted massive stimulus programs, but now they face the challenge of getting the funds flowing to where they're most needed as the SME loan program completely dried up. Here to detail global efforts to provide relief to SMEs is Danny Berger. Danny?
Matt, we should probably start with the idea that if there's any hope of minimizing the economic impact of coronavirus, the governments need to do what they can to support small and medium businesses. We can't lose sight of the fact that employees here are actual individuals who will be losing their jobs. And in G7 countries, small businesses under 250 employees, they're about 50% of the workforce and 50% at least of value added to GDP. But the responses, they've definitely been uneven between nations. The biggest portion tends to be guaranteed
Order
loans.
submitted.
In the U.S.,
Order submitted.
It includes
Order
$250
submitted.
billion to help small businesses, but the funds have already run out of money, and mom and pop firms have complained they've been frozen out. That's where we get those complaints of big companies like Shake Shack actually getting the loans. Now, Italian firms, they've warned that the relief isn't coming quick enough to keep the economy afloat. Other nations are facing backlash. In the UK, just 1% of companies have reported successful applications. Germany and France, by far the most successful, but their existing bureaucracy means that they don't face a lot of the logistical hurdles that other countries do. Matt, Anna?
Danny, thank you very much. Yeah, I remember talking about this previously, and one of our commentators suggesting that you need both deep pockets and the organisational abilities of Napoleon to get the money to the right places speedily enough. Danny, thank you very much, Danny Berger, on what's going on for smaller businesses. We are minutes away from the Open. We will talk to you about what's going on with equity markets. Futures in Europe point higher, US futures point downwards. So this is Bloomberg.
Order canceled. Order filled.
A minute to go until the start of cash equities trading for this Monday morning. Here are your headlines. The blame game. President Trump raises the prospect that China deliberately caused the coronavirus outbreak. This as the United States pauses some tariffs for 90 days, but not those on China. Crude collapse. WTI sags to its lowest level in the 21st century on concerns that storage space is running low. The demand outlook remains gloomy. And signs of easing. Germany begins to reopen its economy as Spain, France and the UK report the fewest coronavirus fatalities in weeks. Matt.
Let's take a look at European futures. We're hovering around 1% gains for the major equity indexes. Certainly that's what we see on the FTSE right now, as well as, well, the DAX and the Eurostoxx 50. So it looks like we could kick off this week on a positive note here in Europe, even as U.S. futures are down. Let's take a look at the live trade here as they kick it off. The Spanish IBEX right now up about 0.75%. We see the FTSE up just about 0.2%, but it continues to rise into the early seconds of the session. And it takes a while, a little bit longer for, of course, the DAX to open up. But you start to see the benchmarks like the blue chip, Eurostoxx 50 come here. Actually, the DAX now open up 0.75%, and the CAC is as well. So things generally rising higher on in terms of European markets right now, even as I say, even as U.S. futures are down. Anna?
Matt, let's talk about what's going on in these markets then. We've got, as you say, European equity markets making these sluggish gains this morning, or making at least some gains. Freddie Late, who is the CIO at Latitude Investment Management, he's joining us this morning, and very good to speak to you, Freddie. Do you believe in this rally? I mean, we've seen quite a bit of a rally, haven't we? We've actually got the S&P, we've rallied quite a long way off our lows. The Nasdaq is only 3%, I think, away from, or 3.5% in a year-to-date percentage terms. It is only down by 3.5%. So that's quite incredible when you consider what kind of sell-off we saw. The S&P now in a new bull market, up some 28% since the middle of March. Have you believed in this rally, and do you continue to do so?
Good morning. The rally's obviously happened incredibly quickly, as the initial crisis in the bear market did too. And I must say, in the very short term, it feels like it may be due another fall if news gets worse. But I do substantially believe that markets will be higher in the next 6 to 12 months and 18 months. And I think that's what investors are trying to do here. They're sort of, when it hit the bottom on March 23rd, a lot of investors were betting on an end to the bull market and a sustained low. And then when it started to rally again, just about everyone we spoke to and all of the surveys, and everyone was saying, but the economic data is going to be getting worse in the next 6 months or 3 months or whatever we know is going to be happening. So surely we're going to double dip. Surely there's going to be another crack through that floor. And I see the levels that we reached at that point as sort of top 10% valuations for global equities globally. They're still trading in the sort of top quartile of attractive global valuations based on the last 50 years. So even at today's level, you have a high probability of making decent forward-looking returns from equities. It's just that you're going to have to ride out increased volatility. And the more it rallies in the short term, the more liable it is to shorter-term falls as well. And I would highly expect, probably for the remainder of the year, to see extreme levels of volatility. But volatility in the true sense, as opposed to just crashing markets up and down. And I think this recent swing hasn't surprised me. We added quite a lot to our equity portfolio in the third week of March. I've added a little bit more since then. So we're continuing to see a lot of opportunities at a single stock level, as well as the market as a whole, and do believe that it's probably the most exciting asset class left to invest in, especially even US yields now yielding less than 1%. I think as and when the dust does settle, Equity markets are always a discounting mechanism that tries to look through events in the short term. And the long-term returns do look very exciting.
Freddie, aren't you concerned that, in the U.S., for example, 20 million people are unemployed. The country hasn't been able to get money out to small and medium-sized businesses, so there could be a cascade of bankruptcies there. And on the other side of this, those companies that do survive are going to be saddled with debt, as are
Order
countries,
filled.
and they
Order
will have
submitted.
had no
Order submitted.
income.
Order filled.
In the meantime,
Order submitted.
I mean,
Order
it just
submitted.
seems like an absolute recipe for disaster for earnings in 2021, and we see already downward revisions across earnings globally. In fact, Hillary's even made a special chart to show that
Order
off.
submitted. Order submitted.
And it just doesn't seem there's any reason for optimism we come out of this any stronger or as strong on the other
Order
side.
filled. Order submitted.
So
Order
I think that's
submitted.
one of the key reasons we focus on the large cap stocks. I think if you're looking at small and medium cap businesses, which obviously may or may not be listed themselves, and we're talking in particular of really minority-owned businesses, small businesses, they will struggle through this environment. And there's an offset there, which is obviously that more people will be unemployed or looking for work post this, which is going to be very difficult. And there'll be lower levels of consumption as we get higher over the next 12 to 18 months, and people hopefully re-find work. But the larger businesses, the market-dominating businesses, those that are in the main market indices, and those where we truly focus, a lot of people have said, aren't the small caps going to be the ones that rally out of this decline? And often small caps rally more because they've fallen more, but in the long term, or the next sort of 2 to 3 year term, I do see this being a great opportunity for the larger cap stocks to steal market share, to continue to invest through this period. So talking about being cash strapped, if the majority of our businesses have cash on hand, have debt that they're funding at 1%, 2%, 3% for 5 or 10 years, so long-term debt, and they're investing in their businesses now to be better and stronger on the way out of this. And of course, their earnings this year are going to get hit dramatically. We own some retailers and restaurant businesses where they're currently earning close to zero revenues on a daily basis. Yet they're still investing, they're still growing, and they're going to come out stronger. And my belief is if you can build a portfolio of those sorts of businesses, franchise businesses, in both cyclical and defensive sectors, which will survive and hopefully be able to thrive on the other side whenever that is, well, given the opportunity cost and the discount rates that are left in the market, you don't want to be uninvested in these assets. Maybe not fully invested yet, but you don't want to be uninvested.
Okay, so not being uninvested entirely. Freddie, where do you see resilience then in your portfolio? We'll get further into some of the individual stocks perhaps in our next chat, but where do you see resilience coming through? Has it been in the places that you would have expected, the supermarkets and the like, or where else?
Yeah, so some of the sort of more obvious sectors, telcos are guiding flat or up this year, and that's obviously a revenue stream which we all still pay our phone bills. In fact, probably paying more for data if you're pay as you go. Supermarkets have had a bit of a boom. Certain other sectors like tobacco stocks are doing well this year. Some of the healthcare stocks are doing well this year. And some of the slightly more niche plays like industrial gases, where, yes, they have an industrial business that is going to suffer as industrial production falls, but they have healthcare oxygen businesses which offset. So there's slightly more niche areas like that. And a few other essential retailers globally, and then the obvious. So Netflix and Amazon and computer games, those real stay-at-home trades have obviously been doing well as well. And I think that's kind of phase one for what happens. You continue to see these growthy, quite expensive but very high-quality stocks doing well until we can start to discount a cyclical recovery. And I agree with Matt's comment, the underlying economic situation is very, very bad.
Freddie, thanks very much. Freddie Lates from Latitude Investment Management, the CIO there, of course. He stays with us. Further thoughts from Freddie coming up on the programme. We'll get his top stock picks next. As coronavirus keeps large swathes of the world at home, why does Freddie include a travel company in his portfolio? We'll get his thoughts on that. Also some banking names he wants to keep across as well. So we'll talk more about Freddie's picks next. This is Bloomberg.
Order filled. Order filled. Order filled. Order submitted. Order submitted. Order submitted. Order filled. Order submitted. Order submitted. Order canceled. Order canceled.
Welcome back to Bloomberg Markets. This is the European Open right now, just 11 minutes into the session, and you can see that we're looking at gains 0.25% to 0.5%. The DAX up 0.5%.
Order filled.
The FTSE just barely treading water right now. Freddie Late, CIO of Latitude Investment Management, is still with us, and we want to get some of your top stop picks and also say, you know, there are a lot of people, I think, right now who agree with you, Freddie. Howard Marks, for example, I believe Oaktree is raising about $15 billion to go out and buy stocks right now. You also have a new investment vehicle for investors who want to pick up what they see, what you see as relative bargains right now. Isn't that the case?
That is, yeah. We've just announced that we're actually going to be launching a new global equity strategy to try to take advantage of what we see as a sort of once in a decade opportunity to be investing. And so we're in train doing that at the moment, speaking to clients. And I do see this as a very, very exciting opportunity to invest in equities for the long term. So I agree with Howard. And, you know, it is across the board as well. I think what's interesting about this market is we're going to have volatility for the next few months, which is great for stock pickers, especially patient ones who have the long term in mind. And I think we're likely to see a change in leadership. It doesn't have to come immediately, but this sort of tech and growth-led market that we've had for the last decade, every time you get a serious crisis and a serious bear market like this, some change in leadership happens. And in the past 70 years, we've had 6 quite distinct kind of value versus growth markets. This has been the longest growth versus value market. Quite often there's decades where they trend together. Both can do well or badly together, or one can have strong leadership against the other. And I'm very keen within this opportunity fund to manage it and include some cyclical exposure, to include some of the cheaper stocks in the market that we're seeing, in order to get that velocity on the other side. And when I say the other side, I don't mean June. I mean probably next June. But investing with that time frame in mind, I think investors can pick up some real bargains here. And I genuinely believe this market is alive with opportunities.
So not very much, not in the very short term perhaps, but certainly as you suggest, June of next year is your time horizon you're talking about here. So you also mentioned a little earlier on about keeping an eye on companies that are going to win out in certain sectors where the competition is going to be less at the other side of this. And so does that explain why you have a company like Booking.com, which must be, you know, a poster child for a difficult sector to be in right now?
That's right. Yeah. So Booking.com, obviously the largest online travel agent in the world, is pretty much bang in the eye of the storm for this one. But they have sort of something along the lines of $8 billion in cash. They've always had a business model where versus their main peers like Expedia and Booking, they don't have a sort of negative working capital cycle. So they don't charge you in advance for booking. They charge you once you've booked. And what's that meant in this unwind is that Expedia and the other competitors, as well as any smaller players, have had to pay all this money back. So this huge cash drain from their business. So they're firing far more people. They have far less capital to invest in their systems. And Booking already had an advantage in terms of systems, margins, sales growth, market position, and we believe corporate strategy ahead of its peers and scale coming into this crisis. And it's only going to come through it stronger. And so the question isn't for me, you know, do I believe it'll be a Q4 this year or a Q3 next year point where we recover back to traveling, or is there going to be any kind of structural impairment of business travel and people doing fewer conferences? Of course, all those things are very interesting and they matter. The bigger question to me is, will we still book travel online? Will we continue to book more travel online each year for the next 5 years? I think that's very likely. And will there be one very dominant player in that marketplace in the future in the form of one of the best businesses I've analyzed in the last 5 years, which is Booking.com? And so we're happy owning some of those stocks through this period, knowing there'll be extreme volatility and knowing this year there's going to be a huge miss on earnings, but for that very long-term advantage. And I think it's about being willing to pick those stocks up as and when you see them as attractive, not trying to call the bottom. Everyone's permanently trying to say, is this the bottom? Is this the cheapest I'm going to get it? And for us, it's very much about saying, is this cheap enough? If this is cheap enough for our, you know, many future models of what could happen, then we are already investing in these stocks.
Will you be willing to sell investments that have done well or that have held their value, Freddie, like, for example, a Google, in order to pick up those that have been hit hard?
Absolutely, yeah. So we've been doing a bit more rotation. We tend to trade very little. Our average turnover per year has been about 10% for the last 3 years. But, you know, we've probably done that in the last month. In fact, we've possibly done more than that in the last month. So we're very happy buying and selling. I mean, I think, again, when you have a very trending-led market like we've had for the last 3 years, the right answer broadly is to do very little. But when you have this high levels of volatility, you've got to be willing to sell the winners, to buy back into some of the ones that have been suffering, or especially the ones where you believe the business will succeed, but the stock price is falling. And so you do have to take some money off the table in some of the winners from the last decade.
All right, Freddie, thanks so much for joining us. Freddie Late there, CIO at Latitude Investment Management, taking advantage of this moment. Freddie's going to continue the conversation with us on Bloomberg Radio at 9 a.m. UK time. So go ahead and join us. Tune in if you're in London on the DAB Digital Radio Network. Up next, oil is heading for an extra dose of unpredictability as the current contract nears expiration. We'll explain. This is Bloomberg.
Order canceled. Order canceled. Order filled.
Welcome back to the European Market Open, 8:22 here in London, 9:22 if you're in Paris or Berlin. European equity markets a little higher this morning. Now, Philips says it is investing more than 100 million euros on increasing production of ventilators and other hospital equipment needed to combat the coronavirus. The Philips CEO, Frans van Houten, spoke to Bloomberg a little earlier. Take a listen.
At Philips, we see strong demand for diagnostic equipment, for ventilators, for patient monitors, but also for telehealth and informatics that aid the treatment of critically sick patients in hospitals. At the same time, we see that hospitals have postponed so-called elective procedures, and therefore the demand for our image-guided therapy is down. We also see lower consumer demand for our personal health business. Adding all of that up, we saw a 2% decline of revenue in the first quarter, and that included what we estimate a 5% impact from the corona pandemic. In the second quarter, we expect that to be a little bit more severe, but then in the third and the fourth quarter, we actually have some assumptions that lead us to say that we expect positive year-on-year growth. And we expect the second half to be so much better that for the full year, we expect a modest revenue increase. Now, the confidence that we have for that second half year is built on the back of a strong order book, strong demand in connected care and precision diagnosis, and hospitals resuming some of these elective procedures that, for example, for cardiovascular patients, they really don't want to postpone too long. So altogether, we have given guidance, but we have not made it, let's say, quantitative. And I think that is what your headline is referring to. Overall, at Philips, we are working very hard to deal with the customer demands. We call it our triple duty of care, taking care of customers and patients, supporting business continuity, and of course, ensuring the health and safety of our 80,000 employees around the world, many of which are working exceedingly hard 24/7 in 3 shifts in order to cope with the strong demand for critical care equipment.
And on that critical care equipment, Frans, one of the big things, of course, that you're working on is gearing up to produce 15,000 of a new easy-to-use ventilator, Respironics E30. As far as I understand, hundreds of components are needed for the ventilators that you're producing in the US, around 650. The fact that there are some non-medical equipment makers currently stepping in to help combat ventilator shortages, is that making it more difficult for you to source the components you need for your ventilators?
We have 3 factories for ventilators in the United States, 2 in Pennsylvania and 1 in California.
Order filled.
And we are adding production lines. We are investing over 100 million euro to add capacity to make as many as we possibly can. We are working with partners, Flextronics and Jabil, to do so. Ventilators are not simple products. Besides the components, you have sophisticated software that will look, what the patient really needs in terms of ventilation. And the gating item indeed is the supply chain of components. And we need to make sure that we deliver as fast as we can. To that extent, I'm also glad that we have been able to build an airlift between Asia and Europe and the United States, because no day can be lost. You refer to other companies with initiatives. To some extent, that is distracting. I think people want to have a proven ventilator in the hospitals
Order canceled.
For both intubated patients as well as non-invasive ventilation needs.
I suppose everybody out there trying their best to join this global move. Can we go back to the reporting side for a moment, Franz? I want to dig a little bit deeper into the dividend. The rhetoric you've just used there in terms of a very confident second half, with the dividend of 0.85 cents, you've gone to scrip on this. You've gone to paying this in shares only. Do you anticipate getting back to cash dividend before the end of this year, given the guidance you've just given to us?
Well, we are announcing today that we will keep the dividend of 85 cents over the year 2019.
Order submitted.
But we are turning it into a dividend in shares, a scrip dividend, as you say, because we want to preserve cash. It is an uncertain world out there. We don't know exactly what will happen. If everything works out fine, then that's great. But we feel that liquidity conservation is a strategy that we have to embrace.
And that was the CEO of Philips, Frans van Houten, speaking to Bloomberg earlier. Now, one input cost that's going to be cheaper for Philips production is oil. WTI is extending its slide, falling to the lowest in more than 2 decades, on concern the world is rapidly running out of places to put the crude it would potentially buy. You can see right now West Texas Intermediate trading on the NYMEX for $14.95 a barrel. That's an 18% slide today. In terms of the next month's futures contract, so June futures right now at 23.69, maybe in hopes that some storage will open up. You can see that the contracts rise throughout, and of course, in hopes that some demand will come back. The contracts rise as you go out the curve. July futures 28.52 and August futures 30.53. Anna?
Yeah, really interesting looking at the curve ahead and what that tells you about oil prices and expectations there. What's still to come on the programme? We are going to be talking about the lockdown and what it means for the UK around house prices. We'll get insight from Rightmove's commercial director, Miles Shipside. That's going to be coming up next. Just want to tell you also, we're losing a little bit of steam on European equity markets. So the European equity is still up by 0.3%. The FTSE fairly flat. The CAC up just very modestly. The DAX up around 0.4%. So very modest gains here as US futures still look weaker. This is Bloomberg.
Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order submitted.
Welcome back to the European Open. 30 minutes into the trading session right now. Let's take a look at how equity markets are doing. It looked like we'd come out of the gate strong this morning with futures up more than 1%, pretty much across the board. We have dissipated a bit, and right now we're looking at the Stocks 100 just up above the even water level right now, 0.1% at 333.77. So we're not doing quite as well as you may have thought, and we still have U.S. futures trading lower this morning. Let's go ahead and take a look at how the industry groups are trading. As you can imagine, it's going to be a split picture here with positive returns today for healthcare as well as insurance and personal and household goods. So some pretty defensive names are rising, although auto parts are up today, as well as travel and leisure. Those are two of the hardest hit, of course, in this crisis. On the downside, basic resources, as the price of oil absolutely collapses. Oil and gas and basic resources stocks, the biggest losers. Food and beverage, though, as well as construction materials, also down. Anna?
Yeah, no surprise then to see the oil sector under pressure as we continue to see pressure on oil prices. Let's get a first word news update for you. Then our top stories this hour here on Bloomberg. The US is temporarily postponing certain tariff payments for 90 days. The move is aimed at freeing up cash for businesses hardest hit by the pandemic. It's also limited the scope, so it won't ease US duties on China, steel and aluminium, or enforcement actions, including those taken against Airbus. China is pledging more stimulus after the central bank lowered its one-year loan prime rate to 3.85%. Beijing is promising another 1 trillion yuan in bonds, around $140 billion. That's after the economy's first contraction in decades due to the coronavirus. China's leaders say the nation is facing unprecedented economic difficulties. The coronavirus pandemic is showing signs of easing in parts of Europe. Italy, Spain and France are reporting the smallest increases in fatalities in weeks. But the path to return to a normal life is not clear. France says it will unveil its plans within 2 weeks. The current lockdown could see the French economy contract by more than 10% in 2020. 16 are dead in the deadliest shooting in Canadian history. A gunman in Nova Scotia disguised himself as a police officer, shooting people in their homes and setting fires. Officials have confirmed the perpetrator is now dead. The province's premier said this is one of the most senseless acts of violence in our history. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Matt.
Now, average asking prices for UK homes fell slightly in April, according to Rightmove, but the property website warned that the coronavirus lockdown has made it virtually impossible to produce meaningful statistics. Joining us now is Miles Shipside, commercial director at Rightmove. Miles, I wonder if everything's just so frozen right now. I mean, it's very difficult to go out and look at real estate. I'm looking for a new place. Is that the biggest problem?
It is indeed. Unsurprisingly, with stay-at-home, very few properties can be put on the market or sold because you can't go and physically view them. So it's hard for the market to function. Activity is bubbling away underneath, and there seems to be pent-up demand, but you can't physically transact. So hard to produce statistics, and all people can do really is research online or watch videos of properties online, but can't physically view.
Yeah, and we're seeing those virtual viewings really picking up, aren't we, Miles? Good morning to you. How else, and this is an innovation that's been around for a while, of course, videos of properties, but no doubt it's being pushed further to the fore, given more prominence by these events. How much can we see the sector innovate then, Miles, so that when estate agencies, real estate vendors can open up again in the UK, they are able to do so in a way that is safe?
Absolutely, and that means the staff in the office being safe, and also sellers and buyers. And social distancing will be here for a long time to come, and keeping safe is becoming ingrained in people's psyche. So therefore, I think, as you say, use of virtual viewings, not just to garner initial interest in the property, but maybe your first viewing that you would have done physically, you will now have a detailed online viewing, so you limit the number of physical viewings that you actually do. And you've got estate agents offering virtual valuations as well, the vendor wandering around their property with WhatsApp or similar at the moment, or indeed, once lockdown's finished, people may not want 3 or 4 estate agents valuing their home physically, so they may decide to have 3 online valuations before choosing an agent to come around and do photographs and measure up. So whilst this is a terrible outcome, it does force change and innovation out of the terrible coronavirus situation.
If you look out, Miles, to the second half or 2021, 2022, a lot of people have missed out on income. A lot of companies and consumers will be soaking up debt right now. Do you see price pressure
Order filled.
into
Order
the rest
submitted.
of 2020
Order
and 2021?
submitted.
I think after lockdown, we'll probably get a slow motion period as the market finds its feet. People, as I said, will be wary of visiting each other's homes up for sale. So you might actually have fewer properties coming on the market and fewer buyers, but that equilibrium may actually about match, and you might therefore get prices underpinned.
Order
Key
filled.
thing, I think, is
Order
forbearance and by lenders. People are going to be struggling to pay their mortgages, but with record low base rates, interest payments on mortgages as a percentage of income are at a record low as well. So I think that'll keep people in their homes, stop forced sales, which do drive prices down. So outlook is more uncertain for 2021, but I think this year a slow motion period. 2021 very much depends on recovery and employment levels and confidence boosting other signs in the economy. And indeed, it may well be that the government, recognising that the housing market is a key part of economic recovery, will look to put some incentives in place to try and kickstart the market.
If we were looking for incentives, which would be the ones that would be appropriate then, Miles? Not at this point, because the market is locked down, as are many other parts of the economy, but when it comes to the time when we need them.
Well, Help to Buy supports, obviously, the house building industry. That supports employment. There's still good demand for brand new homes. So I think we'll see some sort of extension to Help to Buy. Getting first-time buyers back into the market is critical because they're often at the bottom of the chain. Stamp duty already gives most first-time buyers no stamp duty to pay. But I think the key thing is going to be low deposit mortgages, freely or readily available. Mortgage availability has been one of the drivers of the housing market. We went into the busiest start of a year for 4 years, so number of sales agreed were up 11% on prior year. So mortgage availability with low deposits helps first-time buyers and helps the market. So I think the government will be encouraging lenders to make sure that low deposit mortgages are available.
Yeah, Miles, the start of the year seems like a long time ago, doesn't it? Thank you very much for joining us today. Miles Shipside, Commercial Director at Rightmove, talking about the UK housing market. Coming up a little bit later on Bloomberg, we should tell you that we're going to be speaking exclusively to the White House Economic Advisor and National Economic Council Director, Larry Kudlow. You can see that conversation after 3 p.m. UK time. This is Bloomberg.
Order filled. Order submitted. Order submitted. Order canceled. Order canceled. Order filled. Order submitted. Order submitted.
Welcome back to Bloomberg Markets. This is the European Open. We are 40 minutes into the trading day and still looking at 0.5% gains on the DAX. The CAC 40 is little changed. Let's get a Bloomberg Business Flash, your top corporate stories from the Bloomberg terminal. Credit Suisse is compensating managers and employees with additional shares after the price dropped sharply, more than cut in half from a late February high. The bank's overall bonus pool is now down 1%. CEO Thomas Gottstein signaled to a Swiss television station that the lender may curb pay for 2020 as well to show solidarity amid the crisis. A $1.2 trillion fund says, don't worry about earnings season, buy U.S. stocks now. Jim McDonald of Northern Trust thinks this round of reporting won't offer much for investors. What's more important is understanding how the economy will get back on its feet when the lockdown ends. For that, he says, the U.S. should look to Europe for clues. And that is your Bloomberg Business Flash. Anna?
Matt, let's talk about what's going on in the UK. The UK government has issued a furious defence of Prime Minister Boris Johnson's handling of the coronavirus crisis after a report in the Times newspaper criticised the procurement of ventilators. That was at the FT, and the Sunday Times story, which suggested Boris Johnson failed to take the virus seriously. In its early stages, the government published two separate rebuttals. Responding to the Sunday Times article, the government said it contains a series of falsehoods and errors and actively misrepresents the enormous amounts of work that was going on. Ministers added there was no imminent prospect of lifting the lockdown on the country. Joining us now, I'm pleased to say we're joined by Tony Blair from the Institute for Global Change, now and formerly, of course, UK Prime Minister. Very good to speak to you today then, Tony Blair. Good to have you on the programme. Let me ask you how you would be setting expectations for the country right now around life as normal, around the extent of the lockdown and how long it continues, because the government has been very resistant to enter into conversations about lifting the lockdown. The message at the moment is just stay at home. So how would you be preparing people
Order submitted.
for the life
Order
that lies
submitted.
ahead?
Order filled. Order
my
submitted.
Institute put out a
Order
paper
submitted.
today, which is a detailed examination of how you
order filled.
from the lockdown
Order submitted.
whilst
Order
obviously
submitted.
controlling the
Order
disease.
filled.
You've got two
Order
phases
submitted.
to this. You've
Order
got the suppression
submitted.
phase, which is what we're in now, and then you want a managed or controlled revival of the economy, because the collateral damage, economic and therefore health, by the way, because it's a false dilemma between lives and livelihoods. The economic and health damage is so great that you need to be considering now what are exactly the measures that are going to allow us to get out of the lockdown and return to what will, by the way, be a new normal. It's not going to be the normal we experienced before the virus took hold. So really it's a question, for me, not so much of looking back on what the government has done, but looking forward to what it's got to do now to put the preparations in place order to make sure that we can ease that lockdown as significantly as possible, whilst not, of course, losing control of the disease. So it's that balance that we try and set out in our paper in order to stimulate a debate about it, because I think now is the right time to have that debate.
And now is the right time to have that debate. So what should people's expectations be? And if you were in government, what would you be saying right now to prepare people for the life that won't be normal, as you say, for how long into the future?
So I think that there are two things that we're saying. The first is that you've got to reposition the whole of government in order to make sure that even though you may say with hindsight that we were somewhat behind the curve in respect of the suppression phase, we've got to get well ahead of the curve in terms of the revival of the economy. So what we suggest in this paper is that you identify the absolutely core tasks around this, things like mass testing, making sure that there's adequate and proper business consultation sector by sector, make sure that you've got the tracing in place, which is going to require not just through technology, but also through manual tracing, an enormous amount of work. How do you, for example, get international travel started again? What we suggest is you take each of these areas, and we suggest what they are in the paper, and you've got to put a proper command and control structure in place with each of these, with a senior person who may well be from outside government or bureaucracy, because many of the skills that you require from this are skills that are more appropriate in the business sector, skills of logistics and procurement and so on. So one thing that we say is you've got to reposition government to be able to do this effectively with a different structure within government. And the second thing we say is you've got to really take people with you in explaining that the normal will be new. For example, I think there will be widespread use of masks, and we may have to insist upon that. When you're doing the tracing, if you look at the countries like South Korea where tracing has been successful through the application of technology, it's been pretty invasive. We've got to prepare people for that. We've got to be able to, for example, make sure that we're accumulating all the knowledge over what therapies globally, not just in Britain, globally have been working or not working, in order to make sure that people get a proper sense, obviously, of the severity of the disease, but also recognize we've got to get our way out of a situation where, even though only a very small proportion of the population at any one time is at risk, at the moment everything has had to be shut down in order to protect the population at large.
And you also mentioned in your paper how we need to play with dividing up the country either by geography or by age group and assessing whether we can have different policies for different groups. How would you suggest those messages would be communicated? Because although the science might suggest those are sensible things to do, some of the polling suggests at the moment the public's buy-in to this lockdown is based on a kind of we're all in it together mentality. How do you get through the need? How do you address the need to segregate the country a little bit in a way that could become divisive?
I think this is a very difficult thing to resolve, but I do think you can treat people in a reasonably adult way, in the sense that at the very beginning of this, the anxiety in government, I think rightly, was that people weren't treating this seriously enough. So you had to make sure that this lockdown really worked. I don't think there's any danger at this present time of people not treating this seriously. They know it's serious. I mean, people now have enough experience from their own lives, people they know who have either had the disease and really suffered with it, people who even have died with the disease. So I don't think you need to persuade people this is really serious, but you are going to have to take them on a journey that says, look, there will be a certain amount of experimentation as we release people from this. And so, for example, you might decide to trial certain things in areas where there's been not so much of a spread of the disease, because one of the things we do in this paper is we break down the country into different geographical districts, and you can see some have been hit much more severely than others. You might decide, for example, around schooling, that you experiment, and of course you've got a lot of lessons that in 3 weeks' time you will have accumulated lessons from elsewhere in the world. I mean, Austria is opening up its schools. There's other countries that are going to be doing the same. You will therefore be able to see what is a sensible way forward. And I think you've got to take the public with you in this, because my worry is that it's the disease, of course, we have to suppress because it is severe. But I think it's possible that after this, we go back into the familiar old landscape and find it's completely changed economically and socially. And I'm not sure people are really prepared for that at the moment.
And talking about the economics and the economic legacy of this, what about the debt that the government is accumulating here, Tony Blair? Will this result in a return to austerity? Is that going to be the only way to pay for this, or will there be alternative solutions?
Well, I think it's hard to judge that at the moment. I mean, I think at the moment the government will want to do everything it can to stimulate economic activity. But of course, you know, in order for that stimulus to work, you've got to have the rules in place and the confidence in place that people feel they can go back out again. I mean, at the moment, for example, I'm not suggesting you do this, but if you opened up restaurants and pubs, how many people would actually go? So it's really, it's very hard to judge what the right response, medium and long term, of government is going to be economically until you see how you can get out of this and return to as much of normal as you possibly can. And one of the things we set out in the paper is, you know, there are different levels of this. I mean, when you're doing a very hard lockdown, the economic damage is very severe. And then obviously, as you ease it, the economic damage is progressively less. But, you know, you won't be able to tell, I think, what is the right long-term position for the government economically until you see how the easing of the restrictions really works.
Tony Blair, thank you very much. Thanks for joining us with your new paper from, of course, the Institute for Global Change and former UK Prime Minister. Thanks very much to Tony Blair for joining us with that. Coming up on the programme, which assets will do best as lockdowns are eased? And as we were hearing there from Tony Blair, the former UK Prime Minister, lockdowns are being eased in some way in various parts of Europe. We'll talk about that next with Market Live team member, of course, Richard Jones, who joins us next. This is Bloomberg.
Order filled. Order submitted. Order submitted. Order submitted. Order submitted. Order canceled. Order canceled. Order canceled. Order canceled. Order submitted. Order submitted.
Welcome back to the European Open. We are almost an hour into the trading session right now, and we are still looking at green arrows. In fact, the CAC has come back now from little change to 0.4% gain. The DAX up 0.7%, and the FTSE rising up 0.5%. Let's take a look at what's moving markets with Richard Jones, our MLive FX and rates strategist. Richard, I guess oil is probably the biggest story of markets today. We saw WTI, NYMEX crude come down below $15 a barrel. How does that affect FX, the FX and rates world that you cover so closely?
Well, I think the first thing to say about the oil move is that if we do get these lockdowns ending, and I think the lockdowns are going to end very, very slowly. I mean, in Germany here, for example, the government is taking a very cautious incremental approach to unwinding the current
Order
restrictions.
canceled.
But
Order
even
submitted.
If we get
Order
small
filled.
increased economic
Order
activity
submitted.
increasing,
Order submitted.
I think it should
Order
benefit the
submitted.
oil market, especially given how beaten down the oil price has been. I think it's important to emphasize that any return to normality will be very slow to materialize. But I think oil should be one of the beneficiaries. And in terms of the rest of the markets I look at, I think the lower for longer oil price narrative, I think, is something that's going to feed into lower headline inflation. And as a result, I think interest rates, which already were probably going to be lower for longer given the response to the pandemic, I think there'll be even more downward pressure on yields because central banks will be required to stimulate the economy and try to fight against any potential disinflationary impulse that comes from these lower oil prices, Matt.
All right, Richard, thanks so much for joining us. It's going to be a quick one today, but we'll get you on for a little bit longer. Richard Jones there, MLive FX and rate strategist, coming to us. He's actually just down the road here in Berlin. That's it for the European Open. Stay with Bloomberg Television. Up next, it's surveillance. I'm headed over to radio. This is Bloomberg.
Order canceled. Order canceled. Order canceled.
& Co. is a new media company that largely reaches millennial women and aims to inspire, inform, and empower them to be more creative. My past is largely out of tech companies. I worked at Google and Apple, and I started realizing the world of digital media was becoming a big trend. I left Google at the age of 25. I was not married yet, and I had saved up enough money to bootstrap my own business for about 6 months. And ultimately, within that 6 months, I made enough traction to raise a seed round, and the rest was history. We have a three-legged stool of revenue. The first is through advertising, and we do primarily native advertising, so branded content as well as experiences and events. We also sell classes online. We have almost 100 courses that women pay for. And then the last leg is through our merchandising business. So one big challenge over the last 12 months has been the notion of whether or not to put our content natively on distributed platforms, ranging from Snapchat to Pinterest to Facebook and Instagram. A lot of the platforms will automatically give you a little bit more reach per their algorithm if you're putting content natively on them. However, they initially had not built monetization tools. So it was a question as to whether we wanted to sacrifice our control over our content and our distribution.
Order submitted.
I personally believed that the social networks and all of these platforms would get nowhere if they didn't have great high-quality content, and that they would figure out a way to support those people who are providing that content. And that's been paying off. We now reach 125 million uniques a month. We also have 350% growth in revenue bookings year over year. Some of our newer business segments, like our online classes, have grown over 300% year over year as well. We are producing over 100 pieces of content every day and hundreds of videos every month. I think it's so important for a digital brand to have an offline counterpart, especially for any brand that's trying to reach millennials or Gen Z. So we started an event called Remake 4 years ago, just a year into the business. Fast forward to today, it's a 15,000 person festival. It's been doubling in size year over year, which is proof that it's working and that it's only going to go bigger and better from here. We know millennial women, and we want to create content for them no matter where they are and no matter what they're listening to, reading, watching, or generally consuming.
Order filled. Order submitted. Order submitted. Order canceled. Order canceled. Order filled.
We are a luxury bedding destination that's online only and direct to consumer. The company was started by my wife and I, and we were in the market for new sheets. We just really hated the shopping experience. It wasn't consistent with what we're used to with shopping with apparel or other items online. We first started with some of our savings, I'd say about $20,000, to get the prototypes going, build a website, do a photo shoot. It really went to the bare minimum product. And then we raised a little bit of money from friends and family, about another $100,000 or so. That got us to our Kickstarter, where the goal of the Kickstarter was to finance our first purchase order. Our goal was $50,000 of sales. We ended up selling $230,000 worth of product in the first 30 days with no marketing dollars spent, really just word of mouth. Social media has been really, really important to building the brand and getting the word out. There's some logical people that are in market for our product. People that move into new apartments. Facebook has this data of, an address change. People recently engaged that are doing registries. Pinterest is really, really great for the home decor space. And then there's influencers, that people that really spread the word and advocate for the product. We're very confident that once it gets into someone's hands, that they're gonna love it. We didn't take any funding until very recently, and we bootstrapped the whole thing, so we had to sell to buy. We would sell all of our inventory, use that money, and roll it over to buy more inventory and more and more. And that created problems of like this up and down, up and down, up and down. It's very hard to get momentum in the wheels turning when that happens. It's planning ahead, getting ahead of your inventory, getting ahead of the demands, just to make sure that you have enough to facilitate the growth. It seems simple, but it's super complicated, the forecasting element that we've gotten much better at. And that's one of the biggest challenges to any consumer products business in year 1 or 2. Our first year of sales was about $250,000. It was mostly the Kickstarter. Year 2 was 10x growth. We broke 20 million in sales last year, so it was another 10x, and now we're on pace to more than double that yet again this year. 5 years down the road, who knows? We might be, the biggest, bedding home goods company in the world. We might get acquired by a bigger company that's looking to get a closer relationship with customers. Once we feel like the bedding category, like we've really mined everything that's there that we could, then there's opportunity to move on to other categories that supplement it in the home space as well. But we're not ready for that. There's a lot more to do where we are right now.
Order submitted. Order submitted.
Dia & Co is a personalized online shopping service for women who wear sizes 14 and above. Plus-size women in the U.S. make up about 67% of the population in the U.S. and pretty shockingly make up only 17% of apparel spend in the U.S. Dia was founded on the simple mission of really creating equality for her as a customer and therefore really bringing her to the table for the first time within fashion. One of the things that was very clear for our customer was she was as underserved in retail as she was in media. And what that meant was that discovery channels were actually quite challenging. The one group of people who had meaningful sway and were truly, in a way, the gatekeepers of the plus-size community were the bloggers. And bloggers became our earliest advocates. From there, we benefited from word of mouth and the power of a positive experience, and we've kind of grown from there. We very quickly realized that we had this growing, avid, excited customer base and a distribution network that was working. And where we were having the biggest trouble was in finding really great supply. We're based in New York City, and we would literally scour Manhattan to find the best merchandise in our customers' sizes to send. Eventually, we were able to work with a group of designers that agreed to partnering with us to expand what they were offering. So we've worked with some of the best design and product development teams in the industry to develop 8 brands that are exclusively at Dia, and those brands in a lot of ways make up the backbone of the service. We recently elevated the call that we were making to brands by taking out a full-page ad in the New York Times on the first day of Fashion Week, really calling on brands to step up. The conversation around inclusivity in fashion is one that is had often, but what we haven't seen yet is an actual move from speaking about inclusivity to actually producing the garments that women can wear. And that's a role that we can play, that we feel a responsibility to play, and that we're very excited to play for our customers. The core of our product is understanding our customer as well as is possible. We serve women who are very early in their style journey and some who are much farther along in terms of understanding what they like and what they don't like. And the goal of the service is to really meet her where she is. And it really becomes an iterative relationship where we're showing her product, she's giving us feedback, we're showing her better product, she's giving us feedback, and over time, we get to know her incredibly well. Our mission at Dia is to be the beloved brand of plus-size women.
We were able to start Warby Parker with $120,000. That enabled us to build a website, get some PR support, and purchase our initial inventory of frames.
Order
I remember
canceled.
launch really vividly. It was February 2010. We made it live February 15th. We didn't tell our friends or family because we didn't know the website would work. Immediately the orders started pouring in. We hit our first year sales targets in 3 weeks, sold out of our top 15 styles in 4 weeks, and accumulated a wait list of over 20,000 people. We had to start cutting class because we were full-time students at Wharton at the time, getting our MBAs. It was really crisis management. We had orders coming in. We actually didn't have enough inventory to fulfill those orders. We had to think about a communication strategy, a customer service policy. We would just profusely apologize, but also explain to people what was going on. We just launched. We didn't expect to have this much demand. And when you tell people the details, they can have patience and they can understand and sympathize. Brands build relationships with customers much like human beings build relationships with other human beings, and that's through vulnerability. Our first store was actually my apartment. We laid out the glasses on the dining room table, and that was our first foray into learning about the bricks and mortar world. So we did a pop-up, we bought an old yellow school bus, ripped out the interior and turned it into a mobile store, went to over 15 cities across the country. In each city we would be in roughly 3 locations, so we could tell you which intersection performed best for us. So suddenly we had a roadmap for where to open stores. We now have 46 stores across the country. It's really been an important part of Warby Parker's growth. We founded Warby Parker to create a company that would do good in the world. At the very beginning, we committed to distribute a pair of glasses for every pair that we've sold, and we've now distributed several million pairs of glasses to people around the world. We've always believed in aggressive but sustainable growth. There's this mentality of move fast and break things. We believe in moving fast, but move fast deliberately, and when you break things, let's make sure it's not catastrophic. By staying focused and reducing complexity as much as possible, you can actually grow faster, longer. We're trying to build a company that's going to be around for the next 100 years.
Dara, thank you very much for coming here.
Thanks for having me.
I've always been relieved ever since you were appointed, because at least until your appointment, I seem to have the most unpronounceable name. But now so we will keep it as Dara and John. This conference is called The Year Ahead, but in your case, you are close to 6 months into the job. And I wondered what you saw in terms of the year ahead at Uber as your biggest challenge. What's the thing that you think about most when it comes to 2018?
We definitely have our share of challenges at Uber. And for me, where I want to get Uber to the year ahead is a year of normalcy. 2017 was, I think, will go down as one of the most difficult years for any company out there. And I have to give credit to the Uber team and the employees there. It is a group of true believers who believe in our mission, who believe in mobility as a service being available to consumers everywhere at a reasonable cost. And what my job in 2018 is to get rid of the distractions and get the company back to business, get the company back to normalcy. There's a lot that we've done in the past 6 months as far as bringing in new investors, driving a new culture and norms where doing the right thing, period, comes first, bringing a new management team, et cetera. There's a lot that we've gotten done, but this is a company that knows how to execute. This is a service. Mobility as a service is something that's universal, that's needed in the world. And I just want to get back to doing business.
It's quite interesting. You said true believers. Yep. Normally, true believers are the last possible people where you're able to change a culture. Can you explain a bit about that?
Well, I think that they understand that mobility as a service, bringing the cost of transportation down, making transportation services available to anyone and everyone on a local basis, and partnering with cities to be a solution to traffic, to pollution, et cetera. That is a mission that they all believe in. And I think that having seen what happened in 2017, to some extent, the crisis, the enormous crisis that the company has gone through, is a benefit because everybody at the company knows now that we need to change, that we need to break with the past as far as the way the company was run. We need to go from growth at any cost to responsible growth and growth in partnership with other players out there. That's clear, but now I've got to kind of get the company down to the normalcy of execution, of building great technology, and I think we're going to get there. It's still some tough sledding early on, but I absolutely think we're going to get there.
When you talk about execution, is profits one of the things you want to get? I think you lost $4 billion last year.
Well,
peanuts by the standards of
profits would help. So at some point we absolutely have to become profitable, and that's part of the plan.
Do you have a kind of goal for that? Do you think you should be profitable by 2022 or by 2020?
I think that we'll be profitable before 2022. This is the business itself.
Do you want to come back a bit closer, 2020?
Yeah, listen, it's not going to, I don't want to name a specific year, but this is a business that the core business, the ride-sharing business, can be profitable within 3 years. We will continue to make very aggressive investments in building out autonomy because we think that's a terrific opportunity for building out new technologies such as Uber Elevate, where near-term profitability is not a goal, but long-term growth is. So we will look to balance near-term profitability, but as a company, we will always be a company that makes big, bold bets and takes big risks.
To what extent, though, do you think that drive to become profitable fights against a little bit of this culture change? If you want to make, you talked about making money, but not at all costs. Do those two things spar against each other?
I don't think that profitability and culture are their issue. It's the company in the past was willing to make trade-offs as it related to how it did business. And I think was guilty of hubris, was guilty of thinking that they knew better than others. And I think that what we know now clearly is that breakneck growth can hide cultural issues. that there are no excuses for not doing the right thing, and that you do have to make trade-offs. And as a management team, we're specifically talking about those trade-offs that you have to make. We have to be a little more patient sometimes because working with governments, regulators, et cetera, sometimes takes longer, but in the end, you build a more lasting business. And so maybe what we went through was necessary, but we're here. We can control our actions from this moment onwards, and I think everyone at Uber from this moment onwards wants to build a great company, not only in terms of growth, but in terms of the kind of company anyone would want to work at.
Can I ask you one thing which you have got a sort of hangover from last year, which is all the
Order submitted. Order submitted. Order submitted.
There are 6 criminal probes or whatever going on.
The lawyers are lining up outside the door.
Which one do you sort of think? Which one do you fear most? I suppose, out of these different things.
Listen, I think that all of them are serious issues, and my response is that we're going to be transparent and we're going to take responsibility for our actions in the past. I do think that there are certain circumstances where there was smoke but no fire. And I think as a company, we have to defend ourselves and work within kind of the appropriate frameworks. And my goal is just to get beyond this stuff.
Some of these things like pricing policies, surely they go right to the heart of what Uber is, or am I wrong about that?
Yeah, I think they do, but I think that there's a way of being smart but transparent at the same time, and that's where we've got to take the company.
Take me through governments. When you talk to governments privately, do they talk any differently than they do publicly?
Governments?
Yes, governments.
I think that they are honestly a bit relieved with how we are engaging with them, because I think that the engagement is now real. I think they feel like we're out there, we're genuine because we've learned our lessons of the past, and I do think that we can take, for example, the data that we have in terms of traffic and in terms of movement of our drivers and riders, and we can use that data to partner up with cities in order to solve congestion issues, because congestion doesn't help anyone. It wastes enormous amounts of time for consumers. It hurts the environment. And I think that we are aligned with cities, for example, to partner with them in a fundamental way to solve these problems. And I do think that when these are conversations that a number of regulators and cities have wanted to have with us for many years, and I think we are really engaging with them at a depth that I think is going to create a real win-win going forward.
Do you think you were too confrontational on this before?
Yeah, I do. I think that the company was pushing
Order
growth.
canceled.
Listen,
Order canceled.
any innovator, to some extent, the innovation is about questioning past kind of present practices. It's about breaking things, the Facebook breaking things. We just went a step and a half too far. And what I want to keep, hopefully, is the best of both worlds, which is this spirit of innovation, the spirit of can-do, et cetera, but the responsibility of partnership. We don't know better than you. We're actually going to work with you, of actually having dialogue and respect for our city partners, for regulators, and then continuing to take risks and continuing to do daring things. And I think we can accomplish that.
Imagine this audience here is a collection of mayors or a collection of city officials, and you want to depict, this is the Year Ahead conference, depict what the years ahead in this thing are going to be like. How far is driverless cars going to go? You talked just a few days ago about the idea of there being flying cars in 10 years' time. Can you just give a description of what you think transport is going to look like?
Well, I think that we think there are 3 keys to transport and where the industry is going: autonomous, electric, and shared. And I think all 3 are necessary in order to get to the next level of city planning, et cetera. There are many cities where up to a fifth of the space taken in these cities is taken by parking and storing these cars. And so I do think that you need autonomous, you need electric, and you need shared. And I do think it's going to take some time. True autonomy for every single use case is some ways away. What we bring to bear is our developing autonomy, and we will have autonomous cars on the road, I believe, within the next 18 months, not as a kind of a test case, but as a real case out there. And over a period of time, we're going to bring autonomous transportation and feather it in with the non-autonomous transportation with drivers.
What does feathering in mean?
Feathering
to,
in
mean
means
to a layman like me? Crashing.
Yeah, feathering in means if you're, for example, in Phoenix, and you make a request to go from A to B, which is what you do with Uber, there will be 95% of cases where we may not have everything mapped perfectly, or the weather may not be the right weather, or there may be an accident on the road, or you may not have 2 or 3 ways of getting from A to B, where you may say, you know what, that's not an autonomous use case. We're going to send a driver to pick that person up. For 5% of cases, everything is going to fall into place. And we will send an autonomous car. The user will be able to pick, do you
Order
want
submitted.
this autonomous
Order
car, yes
submitted.
or no? And we'll be able to service that A for B. That 5% is going to go to 10 and 15 and 20 as our computers and our algorithms learn more and more about what it takes to drive in a city in a real life situation. And every minute of every day, that driver, that computer is going to get better and know Phoenix better and better and better. And in 5 years, we'll have the perfect driver in Phoenix. We will have to retrain that driver in every single city. We're going to have to build out 3D maps of these cities.
Order submitted.
And it will take time, but over a period of time, you essentially have a driver who becomes the perfect driver. It'll take 10 to 15 years, but that's the feathering in that I'm talking about.
And will a child born today, will they ever need to learn how to drive?
A child born today? No, I don't think so.
So within sort of 20 years from now, we will...
I don't think so. Listen, I hear some groans.
And also,
listen, I heard a couple of groans. 1.3 million people die from car crashes every year. 1.3 million people die from car crashes every year. That doesn't count an estimated 20 to 50 million people that are injured. Okay, this is actually a public safety issue. If you look at cars, 96% of cars, 96% of time, cars are sitting there not being used. It is a huge amount of pollution that's caused by these cars being in the road, and a huge amount of wasted time. So the safety is there. Electrification is absolutely key, and sharing these platforms is going to allow us to be much safer and also put our assets where they add value.
It's quite interesting because when you first came in, I remember you sounding somewhat more skeptical about self-driving cars. You've been converted. Is that a?
The choir has spoken, and I'm listening. It's pretty exciting technology out there. But again, it will be a hybrid technology for some period of time.
What about flying cars? That came as a slight surprise.
Yes, that's a great project that we're working on. It's called Uber Elevate. And it is actually about battery technology.
It would have helped a lot of people here.
I know. I wish that I was available. We'll launch it here if we can. But battery technology is allowing us to have multiple rotors on planes, or helicopters, if you want to call them that. These rotors that are much smaller will be much quieter than helicopters are. Much quieter, much safer. If you add sharing into the equation, you can actually get the economics of going from A to B. We think within 5 to 7 years to a place where normal people would think about taking these flying cars.
Order canceled.
That'll be the beginning, and then it's about scaling. And we're working with a number of partners right now.
Do you think the regulation on flying cars, I've heard some proponents of it argue that it might be easier than it has been on driverless cars, because driverless cars you have to deal with existing roads, existing everything. Flying cars, essentially you're going into unconquered space.
I think that mayors that are forward-thinking understand that traffic and pollution are a real issue, and I think flying cars can be a significant solution to traffic issues in cities. And these cars, to start with, they're going to be very specific. They'll be kind of highways in the air. There'll be very specific routes that these flying cars go on. They're not going to be able to take you to your backyard and land in your backyard. There'll be these skyports.
Order submitted.
So
Order
there'll be
submitted.
very specific routes
Order
that you
submitted.
go on. And I think if you build a regulatory framework that has that kind of structure around it, I think you get to a better solve.
Can I drag you back somewhat reluctantly back to the real world? But you have Rajiv Misra, who came in with you from SoftBank.
Yes.
He's going to become a director. Last week he said that Uber should focus on repairing its market share in the US and on key European markets rather than going to new ones. Do you agree with that? Is that the way you look at Uber?
I think one of the fundamental strengths of Uber is the global scope that we have. This is a
you
brand.
had that motto, everywhere. What's it? Everywhere for everyone.
Yeah, everywhere for
everyone. Do you
everyone.
want to make it some places for some people?
No, we like the everywhere for everyone. It's much sexier than some places for some people. That's
telling me.
Just not interesting. I do think seriously though that the global scope that our company brings is important. Our being able to build technology that we can amortize essentially everywhere in the world is hard, but it is part of the fundamental value that we introduce. So I would look at Uber very much as a global brand. That said, we're going to look at all opportunities, but at this point we are leaning forward, and 2018 for us is going to be very much a lean forward year for the company.
But without, I'm not trying to create new boardroom tension at Uber, but that would appear that SoftBank is keener on a more limited idea, whilst you're keener on everywhere for everyone.
Well, listen, SoftBank is a very important shareholder. They're our largest shareholder, and many of our shareholders have opinions over what's the right thing to do. Ultimately, the governance of the company is going to be at the board, and we'll have those discussions at the board, and we'll set our long-term strategy, and then execute on it.
One of the things which Uber played, perhaps not very fortunately, a role in was the whole sexual harassment questions and everything to do with that. I suppose one very obvious question, do you think that you have solved that part of the culture? But secondly, do you think that this time this is a real revolution and it's going to stick?
I think that what was happening at Uber was serious, and I
Order
think that
canceled.
while
Order canceled. Order canceled.
what Uber went through, what was difficult, I think the Susan Fowler blog was probably one of the best things that happened for Uber, and it certainly started a movement that's an incredibly important movement of the company. I'd be reticent to say that it's solved.
Yeah.
But it's not an endemic issue within the culture of the company, and I think the company has learned, and I think the company took very harsh and appropriate steps to make sure that kind of behavior is absolutely clear, that kind of behavior is not
Order
accepted
submitted.
in any
Order
way, shape, or
submitted.
form of the company,
Order submitted.
regardless of where you are, regardless of if you're a great performer or not. So I think we're at the right place for Uber as a company, but I think in general we're not where we need to be in terms of women in senior positions, making sure that we're welcoming of women in technology, and we help women really build their careers within our company. There's a great kind of bottoms-up energy there, but we're not where we need to be, and we have a lot of work ahead of us.
On the issue of, you talked about the top performers, is that looking back, and also I suppose looking forward for many of the people in this room, because there are a lot of people's businesses which have been affected by this. If you had to give lessons to other people who are now looking at this issue perhaps more seriously than they have done before, is the really bad issue, and I suppose I'm thinking in some ways about the media industry in this, is that giving top performers more room for maneuver or whatever than people, or more discretion than people thought? Is that top performers need to be treated the same as everybody else?
I think they absolutely need to be held accountable. One of the really valuable lessons that I got early in my life was actually through Jack Welch, and he said, it's very tempting to allow top performers to misbehave in any way, but for me he was talking about being aligned with the CEO. Sometimes you allow top performers, the tendency is, well, let them get away with some kind of behavior that is not the right behavior because they're so good. And what Jack told me very early on is that it's the top performers who are problematic culturally that are the most dangerous because they have followership within the company because people look up to them. So he's like the dumb person who is bad culturally. He's not the problem because everyone says, well, that's a dumb person, so who cares? It's the smart person who has followership. So it is incredibly important for the top performers to actually be held to account more radically than anyone else because they're the ones who have followership at the company and they have to set the example. So for me personally, that has absolutely guided how I've managed. Expedia was a company that had,
Order
excellent
canceled.
cultural
Order
values.
canceled.
And one of the first
Order
things we
canceled.
did at Uber was to go out and reset our cultural values, and we call them norms because to me, it's not just these values that you put on the wall and kind of people stare at and it's all nice. It's about behavior. And we set out to change behavior at Uber, and I think that the company was thirsting for it, and we are starting on a path, and I believe it's going to be a positive path.
An inevitable question, I hope you won't regard it as a cheap shot, but you talked about smart people who have followers throughout a company. I mean, Travis would seem to be the epitome of that sort of figure. Is that it? Do you think of him as being in that category of people that Jack Welch was talking about?
I think, listen, Travis was the CEO of the company, and he had incredible followership, and he was held to account, right? I mean, he's no longer the CEO of the company, and he's a board member. He's a big investor, and so he's absolutely going to play a part on the board. But we've also been very clear as a company that we do have to make a break with the past, with how we behaved as a company, and to some extent with the new CEO being a very different kind of a CEO. So in the end, you have to be held accountable, and I think that Travis was held accountable, and at this point, he's a board member and a constructive one at that.
If you look around the world now, where do you see the next competitors to Uber? You've obviously got Lyft breathing down your neck.
Yes.
Where else do they come from?
Well, I think that as you move into a world of autonomy, the position of the car manufacturers, the position of, for example, Google, who's developing Waymo and Waymo autonomous technology, you're going to get a lot of players interested in this space. And a lot of people think about Uber and ride sharing as a significant enterprise, and it is. But the fact is that we account for less than 1% of miles driven on the road now. When autonomy comes in, that number over the next 10 years is going to be closer, I believe, to 15 to 20%. So because we're not yet a true alternative to car ownership, and I believe that as you bring autonomous and you bring the price of mobility down and make it available to everybody, everywhere, then we become a real alternative to car ownership, and that really opens up the market for us, but it also opens us up to many more competitors.
And is Google at the forefront of those competitors at the moment?
Google is one of many. I think that they've developed very strong autonomous technology, but what we think, which is exceptional, is having autonomous technology and the network under one roof, which allows us to use autonomous in a very practical way, nearer than you think.
Order submitted. Order submitted. Order submitted.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. Origins of the creative content of a lot of the work at Light Bright comes from a variety of sources. Sometimes people come with a napkin sketch, some people come with an Adobe Illustrator file, and we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. Turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template.
Order canceled. Order canceled.
We use a blow
Order
hose to
canceled.
connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress. And sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind.
Order canceled.
I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I learn so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it. and we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when I see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, it is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
Order submitted. Order submitted. Order filled.
WTI opens the week by sinking to its lowest level since 1999 as the demand picture remains pretty grim. Some signs of hope. New York sees a drop in daily deaths as U.S. leaders say an agreement on additional aid is close. And Spain, France and the UK report the lowest fatalities in weeks. Germany reopens its economy on a limited basis today. Well, good morning, good afternoon, good evening, everyone. As always, it's Tom and Francine from London and New York. Tom, we have a pretty interesting week ahead of us. I'm looking forward to the conversation with Larry Kudlow a little bit later on how he wants Americans to go back to work. Then we look at Germany and seeing some of the efforts today. And then I have to say there are two stories that I'm really watching out for. One is oil, and then that story that the ECB could be looking at a bad bank like some other regions did in 08, 09.
Yeah, there's a lot going on today. There's no question Mr. Kudlow will be a key interview of the day. Right now, for those internationally, the White House and the House of Representatives seem to be in negotiation with the Senate, the Republican Senate really stepping aside, and Mr. Kudlow, no doubt, will move that forward. This oil story, Francine, is absolutely remarkable, and particularly the confusion of the end of the May futures and over into the June futures as well. We're about ready on the spot market to get a 13 handle on West Texas Intermediate.
Yeah, Tom, so you're absolutely right. Because of this change in futures contracts, we could see heightened volatility in the next couple of days, starting from today. Now let's get straight to the Bloomberg First Word News in New York City is Viviana Hurtado. Hi, Viviana.
Hi, Francine. Tom, the White House and Democratic leaders are close to agreeing on the next coronavirus aid bill. This measure would be for up to $500 million. It includes more money for the small business loan program, plus funding for hospitals and testing. And sticking with the Trump administration, it's trying to free up cash for businesses hit hard by the coronavirus. It will allow importers and manufacturers to delay tariff payment for 90 days. This on many overseas products. But the move doesn't stop ongoing punitive tariffs. They are the centerpiece of the current U.S. trade policy. And now to the worst mass shooting in Canada's history. Authorities in Nova Scotia saying a man dressed as a police officer went on a rampage. He shot people in their homes. He also set fires. 16 people were killed. The gunman also is dead. And we end with the price of oil falling to its lowest in 21 years. New York crude plunging 16% to around $15 a barrel. And there's concern the world is running out of places to store oil. Those output cuts haven't been enough to cope with plunging demand. Global news, 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Viviana Hurtado. This is Bloomberg. Francine, Tom.
And let's look at the data right now. Equities, bonds, and oil. Equity, they're off a little bit. I'm not going to make too much of it with the VIX back a little bit above 40. There's been a churn there as well. In the yield market, there's no question yields come in. The two-year yield nicely has moved down, really touching on recent low yields. We're not there yet, but I would watch the two-year yield very much so. In oil, we just had a 13.99 print on spot West Texas Intermediate. The June future has also plunged from a 24 handle down to a 23 handle. I'm frankly, and I rarely do this, folks, because it's complex. On TV, I really don't like to talk about the futures market, but the June future is what to watch today on oil. The West Texas, Francine, will make the headlines, but the June future is critical, and it really gets to show that huge capacity that's out there right now, going $25, $24, $23 a barrel. West Texas Intermediate for June. Francine?
Yeah, Tom, we just have a headline actually from the Bank of Spain seeing the economy shrinking by 6.8%. Let me just look at the headline again because it does feel very significant and it could move euro dollar. So the Bank of Spain seeing the economy shrink by between 6.8% to 12.4% in 2020. We just had a pretty stimulating conversation with the chairman of Societe Generale also about some of the debt accumulated by European countries. Now, as you say, Tom, U.S. equity futures actually down. Asian stocks were down. Here in Europe, they're fluctuating. So investors trying to figure out the latest evidence of coronavirus slowing and preparing for earnings season to ramp up. Treasuries rising with the dollar, oil plunging. And you're absolutely right, Tom, because of the change in the futures contract, it could have a lot more volatility heading this way. I'm looking at WTI, and at some point it was below $15 a barrel. Now, joining us now is Eric Nielsen. He's UniCredit Group Chief Economist. Eric, thank you so much for joining us for a bit of economic insight. A million questions here to talk about, which is the changing role of government, so what the legacy of this crisis will be. But maybe let's start off with European debt. how detrimental and how difficult will be European debt unless we have some kind of either splitting of government debt or debt forgiveness? Eric, I don't know if we do have Eric Nielsen. All right, we don't have Eric Nielsen, Tom, so we'll get back to Eric Nielsen in just a second. But if you look at some of the main debates here in Europe, it's very clear, certainly for European countries, I don't know if it's different in the US, that the government will take more of a role, whether that role extends also to much more of a safety net. And then we have European leaders this week to try and figure out what the best response is, to speak with a common voice. A lot of people here in Europe, and I'm looking forward to speaking to Wolfgang Munchau later, have said that this is the time for Europe to come together and find a common solution, or they could actually face disintegration, Tom.
I don't observe it right now. It's absolutely fascinating. I actually read a fair amount about this over the weekend, Francine. I certainly don't see a Brussels approach to pandemic. It does seem to be almost every nation for itself. And what's fascinating, Francine, is how alone Sweden is. And over the weekend, there was an abrupt shift in the zeitgeist of Sweden, saying they could see a more commingled society and less social distancing. And they got some respect yesterday with statistics that said, you know, maybe the Swedish model bears study at least, if not respect. It's a huge, as you know, it's a contentious debate how Sweden's taken this alone.
Yeah, a contentious debate, but if you look at the mortality rate, Tom, and the way that various countries have dealt with it, it's also pretty incredible how the responses have been different. But even in cases where the response has been the same, actually how to deal with it because of ICU and because of number of nurses available has really, really changed widely, Tom.
Well, it's really, really interesting. What we're going to do here as we set you up for Monday is begin a discussion here of policy. Now, we've got fiscal policy, and Mr. Kudlow will join us later today, advocating for the White House, is with Kevin McCarthy, the minority leader in the House, really making that push on Friday and over the weekend. And maybe we get an announcement today for vote on Wednesday of another $450 billion of stimulus. It is fiscal authorities catching up with monetary authorities. And of course, that's identified by Chairman Powell, by the presidents, and by the governors. Our conversation last week, our Michael McKee with Loretta Mester of the Cleveland Fed.
Order canceled. Order canceled. Order canceled.
So we're in a real unprecedented, incredibly deep shock to the economy. And I think it behooves us at the Fed to really use our tools as best we can to get us through this pandemic shutdown period, mitigating the negative impact on the economy so that the recovery can be as best as it can be when we get to that point. Yes, we are moving into unprecedented territory, but remember, we're trying to then lend to firms that, through no fault of their own, were impacted by the virus. And so there are, we are going into, for example, corporate debt programs, which we haven't done before, and we are going to include some fallen angels, right, that had an investment grade rating before the virus.
Submitted.
So
Order submitted.
You're right that we are doing things that we hadn't done before, but at this point, I don't think we can be that concerned about those kind of moral hazards. I really think we have to really look at this is a hugely impactful and negatively impactful shock, and we have to do all we can to make sure that we're not doing permanent damage to the underlying fundamentals of the economy so that when the time comes and activity can pick up, we can get a decent recovery out of this.
A lot of what you just said will make sense to a lot of people. Where people struggle though, Loretta, and maybe you can help us, buying BB credits that were BBB before this might make sense to tons of people. They're huge employers. Buying high yield ETFs that have CCC credit in them, exposed to a very shaky energy sector that weren't on firm footing before this, doesn't make sense. Why the decision to buy junk ETFs?
Yeah. So part of what we're doing and all the things that we're doing are twofold. One is, right, we're trying to make sure that the markets stay functioning. So some of the efforts that the Fed has done, right, are really geared at market functioning, and some of them are geared to make sure that, right, we mitigate the negative effects on households and businesses by making sure that we have credit flowing to those businesses. So I look at the ETF part of that as a market functioning issue. And we're continuing to look for gaps to make sure that our markets are functioning. And I would say that some of the efforts that we've taken already have improved functioning in the market. So there's two things going on. One is making sure that, and this is the Fed's responsibility, right, is to make sure that we have markets that are well functioning so that credit can flow, right, and do what it can to help shore up the economy to prepare it for the recovery. So, you know, we can disagree on kind of what the right way to do that is, but part of what we're doing is to try to make sure that we have functioning financial markets, precisely because those are an essential ingredient for the economy, for that any other policies that we do can flow through. So there's a transmission to the households and businesses that need those funding.
I know that at this point the Fed is all in, doing everything it can to try to support the economy. When we get to that third quarter maybe reopening and it's time to stimulate the economy, is there more you think you need to do or can do, and what would that be?
So I think we're going to have to see how what it looks like when we get there. I don't think we're up against any kind of constraint on what we can do. As you've seen, I think we acted appropriately, rapidly, in an unprecedented, rapidly way, really because of the recognition of how deep this shock was, and engineered because of the investment we're making in public health, right? So when we get to that point, we're going to look at our tools, do what we can, again, to support some of the programs that the federal government is doing in terms of like the PPP, the Paycheck Protection Program, et cetera, and then be prepared to use our tools as appropriate to make sure, one, markets function, and two, that we're supporting the economy as we always do, so that we can get back to a normal, sustainable growth with full employment and price stability. And so that's what our goal is going to be. That's what our goals always are. And we have tools to do that. Yeah. We have forward guidance. We have our interest rate tools that we're doing right now at zero. And we're going to move those things around as appropriate to make sure that the economy can recover and get back to a sustainable growth path.
That was the Cleveland Fed President Loretta Mester speaking to our Jonathan Farrow and Michael McKean. In the last couple of minutes, we had those pretty ugly numbers in terms of possible recession between 6 and 12.8% from the Bank of Spain. So we'll talk about that with Eric Nielsen shortly. And also coming up later at 3 p.m. London time, our conversation with Larry Kudlow about how to get Americans back to work. This is Bloomberg.
There have been any number of Mondays in this pandemic, and we welcome all of you. Again, Tom Keene from near Fifth Avenue above Mount Sinai here in New York. It has been an extraordinary weekend in New York, a little more activity, finally spring-like weather on a Sunday. And then Francine Lacroix in West London as well, and of course London with their own challenges, including, as Francine mentioned earlier, the Sunday Times really going after the Prime Minister for February and March actions. Right now, to help us adjust and recalibrate, Eric Nielsen of UniCredit. Eric, what have you done to your forecast? Is it forecastable right now? Have you adjusted anything, or are you just giving up until you get more information?
Hi, Tom. Yeah, I wish you could give up because it's virtually unforecastable. But we are in the business of trying our best. And so 2 weeks ago, we adjusted our forecast, and we are among the most bearish for the world. We are about double as bearish as the IMF numbers from this past week. So we think the world economy is going to sink by about 6% this year. In Europe, for the Eurozone, by about 12-13%, and the U.S. maybe by 10 on average.
What is the distinction there between what you're forecasting and the Gopinath team at the IMF? Is it a consumer rebound? What's the differential there of lousy towards a Nielsen grim?
It's primarily two things. First of all, we think that the initial shock we are hitting now is deeper than they think. And I think the numbers we have gotten out of consumption in America for the just last 2 weeks of March, really, that took the whole March number down dramatically, and the numbers in France and now Spain, I think actually lend support to our more bearish view on the initial slowdown.
Order canceled. Order
the IMF
canceled.
thinks that the bottom is going to be a bit shorter than we think. And there maybe they're a little bit more right. Certainly we are opening up the economy here and there, but I would like to see how much activity will actually recover until we get a clearer picture on vaccines and general sort of contagion of this disease. So I'm happy with our forecast, but it is, as you said, virtually unforecastable.
Eric, we just had some figures from the Bank of Spain seeing the Spanish economy shrinking between 6.8% and 12.4% in 2020. Are those the kind of numbers that we're looking at for a lot of European countries? And does it mean that at the end of it, if debt is too big, we go back to the Greek scenario of them needing a bailout?
Well, so on the first question, Francine, yes, I think that is what we're looking at. So our forecast for Spain this year is minus 15, and about the same for Italy. This is sort of the story of countries in Southern Europe, which are very dependent on the tourist sector. So not only do you get the biggest hit in Europe, in Southern Europe we've seen, but also it's going to, even if you open up the economies, we think that it's unlikely people will go on vacation this summer to the Mediterranean. So we have a bigger hit there, and then the Northern Europeans will be more in the 8 to 10% range thereabout. Now, but it's a guess, really, more than anything else. But it seems to me to be most likely of that order of magnitude. And then, of course, I should say a good rebound, a comparable, stronger rebound. If I may come back to that point vis-a-vis the IMF, Tom asked about, if you go forward to the end of 2021, we are almost at the same place as the IMF. So we have a deeper hit and a better rebound than the IMF. On the debt number, Francine, it all depends on the policies. And my view is that people are overestimating the damage that we get from public debt. And the reason is that the ECB is buying it. And so long as the ECB buys it and holds it, it's cost-free. And therefore, and it is ultimately the debt service payments that's going to cause you trouble, not the debt stock numbers. So I think people are overly concerned about the big increases of 10, 20 percentage points of GDP in public debt during this crisis.
What do EU leaders need to figure out this week, Eric? I mean, there's been a lot of apologies, blunders, unhappiness about how the bloc as a whole has dealt with. Will we have something substantial to make Europe stronger by the end of the week?
Well, we have the Thursday summit, obviously. I hope there would, it's basically set for a number of things on the agenda, as you know, but including basically approval of what the Eurogroup decided on the three components, the 200 billion in guarantees for the EIB, the credit line for the ESM, and then the unemployment scheme with supposedly 100 billion from the Commission. I think that's okay. I wish they would do something much more dramatic, and I wrote about this in my note yesterday. I think there should be an agreement that you finance yourself through this crisis because it takes too long to make it mutual or some other construction. But then there should be a pledge that if the ECB one day starts to unload their papers into the market, you mutualize that debt. But go to my note if you want. But we won't get a big, ambitious, dramatic move from the European side, unfortunately.
Eric, I have to leave it there. Eric Nielsen of UniCredit with us. Please stay with us worldwide for you on this Monday. This is Bloomberg.
Happy Monday from all of us at Bloomberg. This is Bloomberg Surveillance, and this is what your markets are doing. Now, we did see a little bit of a sell-off when it came to Asian stocks. That's filtering through to U.S. equity futures. Here in Europe, a lot of the focus is actually on corporate earnings. A lot of the focus is also on the number of debt stabilizing across many countries, including Spain, Italy, and even the UK. So European stocks are still holding on to gains, gaining some 0.2%. Treasuries rising with the dollar, oil plunging. Now, Tom was saying because of a change in the futures contract in oil, we could have a lot more volatility in the coming months. For the moment, I'm looking at WTI, and that's tumbling below $15 a barrel to the lowest level in 21 years. Euro also weakening along with pound and yen. Now, coming up, we'll be talking to Wolfgang Bunschau, Eurointelligence Director, about this talk about the ECB issuing a bad bank, but also European debt. This is Bloomberg.
Order canceled. Order canceled. Order submitted. Order submitted. Order submitted. Order submitted. Order submitted. Order canceled. Order canceled. Order submitted. Order submitted.
You're watching Bloomberg Surveillance. I'm Viviana Rotato. Let's start with your first word news. The coronavirus pandemic is showing signs of easing. And actually, we do begin with a deal that is close on the next coronavirus aid deal. President Donald Trump joining Democratic leaders and some in his administration. They're working on a new package that would provide up to $500 billion. More money would go to the loan program for small businesses, plus hospitals and testing.
Order canceled.
Now to
Order
China.
canceled.
the nation is adding stimulus. This after the economy shrank for the first time in decades. Banks cutting borrowing costs. The government promising to sell another $141 billion in bonds for infrastructure spending. Now to Vice President Mike Pence. He will discuss today testing shortages with governors. President Donald Trump says some governors are relying strictly on state laboratories. He said they should also turn to large commercial and academic labs. Governors of both parties are calling for more widespread testing. They say without it, they can't start to reopen the U.S. economy. And we end in Germany. That's where the last 24 hours, the number of coronavirus cases rising this month by the least. Since April the 1st, the number of fatalities was the lowest. This week, Germany will begin allowing smaller shops to resume regular business. Schools will gradually reopen. Global News, 24 hours a day on air. Now, Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Viviana Hurtado. This is Bloomberg. Francine, Tom.
Viviana, thanks so much. Now, for an in-depth look at what the ECB and policymakers can do, what they've done, maybe some of their shortcomings, and what they can do next, let's get straight to Wolfgang Munchau, who's your intelligence director. Wolfgang, thank you. We've been following your various comments on a lot of the press in Europe, but also in the UK. When you look at what more EU leaders, or what they must do this week to show enough solidarity, is there something that you think will make them act together as one voice, or are we going to see this kind of monetary policymakers here standing firm with a much more chaotic answer from leaders?
I would assume that the leaders will agree on something. They always agree on something. I mean, the Europeans are good at deal making. The question is, will this be enough? There is talk about a recovery fund. The French have proposed it. There are advanced discussions going on at the moment, and I assume they will inch towards progress. But the big issue is whether they will raise enough money for it. I mean, the French want €1 trillion, and the only way to raise this much money without, bankrupting the weaker governments is actually to issue a sort of a Eurobond, a mutualized asset. Now, that is being resisted by the Germans and the Dutch. That resistance has not gone away. So the only solution, unless somebody gives in, the only solution that I see is some kind of a fudge where they get debt that is not entirely shared, or some kind of a scheme where the EU leverages some credit, or where governments raise money themselves, which would obviously defeat the purpose, because the whole idea is to make sure that whatever money is spent does not make Italy, does not add a fiscal burden to Italy, because Italy is fairly much at the limit of what it can do.
What does it mean for the recovery phase? A lot of countries need bailout programs, like we saw in Greece.
Yes, absolutely. The fiscal. The capacity of a country like Italy and Spain is not sufficient that they can themselves organize the bailout. We're already seeing, if you compare the fiscal response of the industrialized nations, that Italy and Spain have the weakest fiscal response, while the United States and the UK have the strongest, and Germany too. And what needs to happen, or what in order to prevent a very serious economic downturn in Italy and Spain, or a lack of recovery, is to organize a package that allows this recovery to happen. And I think there will be something. It won't be nothing, but one has to look very carefully. Is it credit? Is it actual money? Is it just a promise of something, or is it something that will really happen? This is not the money. They will not spend the money on the immediate crisis. This is money for the reconstruction of the economies after the crisis. This is about investment. So this is a multi-annual program of investment, but it would help enormously if these countries didn't have to fund this money themselves, but if there was an EU program that would do that.
Wolfgang, on an institutional basis, how do you see this in a year or two, with this great test for the world, this great test for Europe, with all of the history from World War II? Where is Europe a year from now, 2 years from now?
There is a possibility that the EU would weaken. I don't think the EU would sort of cease to exist, or that more countries would have left by then. That's unlikely, but that if the leaders fail to measure up to the moment, this historic moment that they have to measure up to this week, or they're asked to measure up to this week. If they fail to do this, it is quite possible that Italy might decide that China is a more important strategic partner than the EU. You may find that Italy may restructure its debt. That's not on the issue right now, but if Italy come out of this crisis with weaker growth and higher debt, I've done some math on various scenarios that it could easily increase the debt to GDP ratio to 180%. And people may well conclude, investors may well conclude that this is not a sustainable position.
Order submitted.
If the ECB at that point fails to, organize a bailout, then we may at this point in a year's time talk about a restructuring of debt, which could jeopardize the whole Euro project.
Right.
So yes, there are big issues ahead for us.
Wolfgang, what does the euro signal to you? I mean, the euro for Germany is different than the euro for Italy or the euro from Spain. How is the euro and the market that makes the euro, how should they respond to all this?
Tom, you're pointing towards the absolute important issue. The euro in Germany was something the Germans agreed to reluctantly and only under some contractual condition that nobody would ever require a bailout and no debt would ever be mutualized. The euro in Italy was a project of political integration, which it was never for Germany. And that is basically the issue that we are still grappling with. That sort of the differences of the euro, the original sin of the eurozone, basically. And the euro has now, and the way it has developed and the way the crises have developed, has basically we have come to a position where either the eurozone takes the next steps of integration and develops systems that make it robust, or the eurozone will disintegrate. And there are various ways it can disintegrate. It doesn't have to break up formally, but it can break up, or it can weaken in different ways through parallel currencies, through kind of shadow systems. So I think there is a grave danger right now.
These are very, very important conversations. Wolfgang Munchau with us. Gideon Rose will join us from Foreign Affairs here in our next hour. We've got much more to talk about coming forward. Of course, we're watching oil with that $13.99 print on present West Texas Intermediate, the May future, ending on, I believe, Wednesday. Coming up today in the 10 o'clock hour, an important conversation for those of you that link the economy to the markets, and that is Edward Hyman of Evercore ISI. Please stay with us. This is Bloomberg.
Order canceled. Order canceled. Order canceled.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we're talking a little bit about that pretty damning article from the Sunday Times and the Times over what the Prime Minister, Boris Johnson, together with his government, have done or failed to do from February to March, talking about them actually sleepwalking into the disaster. This morning, 10 Downing Street issued a pretty furious rebuttal, saying a lot of the article is not founded. Well, earlier on, we spoke to the former Prime Minister, Tony Blair, about the government's response to the virus so far. Here he is.
You've got two phases to this. You've got the suppression phase, which is what we're in now, and then you want a managed or controlled revival of the economy, because the collateral damage, economic and therefore health, by the way, because it's a false dilemma between lives and livelihoods. The economic and health damage is so great that you need to be considering now what are exactly the measures that are going to allow us to get out of the lockdown and return to what will, by the way, be a new normal. It's not going to be the normal we experienced before the virus took hold. So really it's a question, for me, not so much of looking back on what the government has done, but looking forward to what it's got to do now to put the preparations in place in order to make sure that we can ease that lockdown significantly as possible, whilst not, of course, losing control of the disease. So it's that balance that we try and set out in our paper in order to stimulate a debate about it, because I think now is the right time to have that debate.
And now is the right time to have that debate. So what should people's expectations be? And if you were in government, what would you be saying right now to prepare people for the life that won't be normal, as you say, for how long into the future?
So I think that there are two things that we're saying. The first is that you've got to reposition the whole of government in order to make sure that, even though you may say with hindsight that we were somewhat behind the curve in respect of the suppression phase, we've got to get well ahead of the curve in terms of the revival of the economy. So what we suggest in this paper is that you identify the absolutely core tasks around this, things like mass testing, making sure that there's adequate and proper business consultation sector by sector, make sure that you've got the tracing in place, which is going to require not just through technology, but also through manual tracing, an enormous amount of work. How do you, for example, get international travel started again? What we suggest is you take each of these areas, and we suggest what they are in the paper, and you've got to put a proper command and control structure in place with each of these, with a senior person who may well be from outside government or bureaucracy, because many of the skills that you require from this are skills that are more appropriate in the business sector, skills of logistics and procurement and so on. So one thing that we say is you've got to reposition government to be able to do this effectively with a different structure within government. And the second thing we say is you've got to really take people with you in explaining that the normal will be new. For example, I think there will be widespread use of masks, and we may have to insist upon that. When you're doing the tracing, if you look at the countries like South Korea, where tracing has been successful through the application of technology, it's been pretty invasive. We've got to prepare people for that. We've got to be able to, for example, make sure that we're accumulating all the knowledge over what therapies globally, not just in Britain, globally have been working or not working, in order to make sure that people get a proper sense, obviously, of the severity of the disease, but also recognize we've got to get our way out of a situation where, even though only a very small proportion of the population at any one time is at risk, at the moment everything has had to be shut down in order to protect the population at large.
Well, that was the former UK Prime Minister, Tony Blair. Let's get back to Wolfgang Munchau, where he's director at Eurintelligence. Wolfgang, when you look at the model, and this seems pretty impossible, but if you look at a model, and I don't know what model you take for basis, but when do you reopen the economy compared to whether you're taking a risk of losing more life? Is there an optimum kind of way to reopen an economy? Is it slowly, or what do you do?
There is no optimal way. It will have to be based on some form of trial and error, because all models are, some models are useful and all models are wrong. What countries, what governments will in practice need to do, they will need to stage it, and that has already been, the government has already made that clear in all the countries, and they need to get some grip on this R0 infection rate. If they have a sense that this rate has fallen below 1, that is sort of the threshold, then they can gradually start to reopen and then keep a control and be ready to reverse that measure if it turns out to be a mistake. That is the best we can do. There is no model about reopening an economy. It is ultimately a trial and error procedure. And most EU countries will start to do this relatively early. The UK will be lucky in this one respect, in that the sense they can see the reaction in other European countries. The UK may be 1 or 2 weeks behind Italy or Spain, and we will see what happens in those countries. We also see what happens in Sweden, a country that never locked down. So there is some experience to go by, but ultimately this is a gut instinct decision. The mistake the UK made was not to start this process early enough. Not to take it seriously. It was interesting how Johnson and the government were very strategic about Brexit from the beginning to the end, but they were not strategic at all about this virus. They really let things slide, and then they had to panic. So there's a real contrast to the way this has developed.
What is, Wolfgang, the strategy over Brexit? So I think negotiations are restarting today. They keep on saying, the UK government, that they don't want to extend the extension. Or are we going to have a no-deal Brexit at the end of this?
That's a possibility. I don't see at the moment that the two sides will come together. The British government's plan had been to check in June, that was before the coronavirus, to check in June whether there is enough common ground so it's worthwhile having actual negotiations. What's actually happening now is not negotiation. They're just talking. They're just exchanging information, trying to understand each other's position, so that in June they can have a basis for a decision. Now, that process is ultimately not greatly impeded by COVID. Because at the moment everybody's been studying each other's documents. They've been, formulating their own policy response. My reading is that the UK's position is still not in favor of extension, but this is ultimately the decision for Boris Johnson. He will decide that. So when you ask a government official, however senior that person may be, they will just recite that position for now, and in the end they will make a new position in view of what they come up with. So I think this is open. I think he has a case to extend it. The case would be obviously the virus, and also the possibility that there might be a second phase of the virus in the winter. This is not a good time for a hard Brexit. So if I were to countenance a hard Brexit, I would probably do this in the spring or the summer, and not on this, not on December the 31st when you actually have another virus issue. These are considerations that would speak in favor. On the other hand, the big consideration that speaks in favor of December 31st is the fact that all the economic hit has already happened. You're not going to get this Brexit crisis because you already have the disruption of supply chains. You might as well then use this fact and just get on with it, and then you actually have certainty. That's an argument that's being made in government, and it weighs heavily.
Wolfgang, over the weekend, I saw countless articles that basically said, a la the heart of 9/11 and the recovery from September 11th, we're never going to be the same again. That was a real preponderant theme in the zeitgeist this weekend. Do you buy it that 2 years, 3 years, 5 years from now, we're actually going to change our societal behaviors?
That's a very good question. I would think I'm not as, I think this is possibly the first experience in our adult lives that might make a change. We've seen previous crises, where stock market crashes, 87, then in 2008, etc. I mean, all this was supposed to be big, but it wasn't in the end. They were big, but they didn't change the way we operate. This crisis might change. Some of the social distancing may stay for good. Businesses that were, many businesses will go bankrupt in this crisis. Many new businesses will be created. I think this could be sort of the first of a, Schumpeterian creative destruction type crisis since the Second World War. So, I'm moderately upbeat about the long-term economic consequences of that, but that obviously creative destruction means destruction. So there will be a hit, and it could be quite painful.
Well, Wolfgang, thank you so much. Just brilliant. Wolfgang Munchau with us with Euro Intelligence, their director there. We're going to drive forward this discussion on our international relations within a pandemic. Gideon Rose with us for a monthly visit on the new Foreign Affairs magazine. The essays they've been doing the last couple weeks, including one from Richard Haas, have been absolutely extraordinary. Gideon Rose in our next hour. This is Bloomberg.
Order canceled. Order canceled. Order canceled. Order filled. Order submitted.
This
Order
is Bloomberg
submitted.
Surveillance. I'm Vivian
Order
Arcano.
filled.
Let's get your
Order
Bloomberg
submitted.
Business Flash. We
Order
begin with
submitted.
Novartis. It'll run a U.S. study of the malaria drug hydroxychloroquine. The medicine has been hyped as a potential treatment for coronavirus. Novartis will test the drug alone and in combination with an antibiotic. Now to another blow for Boeing's grounded 737 MAX jet. A big Chinese leasing company, CDB, canceling an order for 29 of the planes. The list price, at least $2.9 billion. A growing list of customers has scaled back plans for buying the 737 MAX. And we end with Alibaba. It's boosting its bet on cloud computing. Over the next 3 years, the Chinese e-commerce giant will invest $28 billion on cloud infrastructure. It's a major effort to extend one of its fastest growing businesses to more countries. And that's your Bloomberg Business Flash. Francine.
Viviana, thank you so much. Let me look at equities, bonds, and oil futures.
Order canceled.
Really take it on
Order
the chin.
submitted.
Dow futures down
Order
243
filled.
points. The VIX comes back above 40 as well. The bond market comes in. I want you to 2-year yield, but what I'd really point out is the collapse in oil. It's just simple. OPEC Plus has failed. There's no other way to put it. We see it with the present future, the spot price, if you will, of West Texas Intermediate, down, 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 getting near that physical barrel. And even the June future, the bet out to June, the June future comes in substantially at about $23 a barrel, with West Texas at about $14 on the edge of $13 a barrel. Was that confusing enough, Francine?
It was confusing. No, it wasn't confusing, actually. It's watch out for oil because it's ever lower, but also that extra volatility because of the contract change, Tom. This is what I'm looking at in Europe. So we're holding barely to our gains, getting some gains, getting some 0.1%. A lot of the focus, of course, is on the latest evidence about the spread of the coronavirus, but also markets are trying to prepare for the earnings season. I'm also looking at euro, higher, pound and yen actually weakening, and then European bonds a little bit mixed, Tom.
Very good. Coming up, Jim Caron will join us with Morgan Stanley. This is exceptionally well timed. Talk to Mr. Caron about all that Washington's doing and what it means for fixed income. Stay with us. This is Bloomberg.
Order submitted. Order submitted. Order submitted.
This morning, more than a glimmer, less than the proverbial light at the end of the tunnel.
Order
Assembled
canceled.
medical
Order
experts
canceled.
and political
Order
non-experts, they consider how to get back to normal. It will be, well, every hospital. It looks like every nation for itself. April oil just craters. We'll give you an update on that in moments. June oil slides ever lower as OPEC and non-OPEC guesstimate when oil demand will return. You know how it works. Supply follows demand. At least that's what the textbooks say. And finally, Mr. Mnuchin and Pelosi They craft a new deal for small business and hospitals. Senate Republicans, where in Washington are the Senate Republicans? Good morning, everyone. This is Bloomberg Surveillance. I'm Tom Keene from New York. Again, another week of working out of our homes, and we really thank our technical staff for trying to make this work day after day. Francine Lacroix and her manse in West London as well. Francine, I got to go to the gossip of London. We got oil. We'll get to Jim Caron on that in a moment. Lots of other talk. Why does the Sunday Times go after the Prime Minister of the United Kingdom when he's just out of the hospital bed?
Well, Tom, that's a very good question. First of all, let's remember that the Sunday Times and the Times were huge supporters of Prime Minister Johnson. Second of all, I do think there's a feeling, certainly amongst a lot of people in London, that the fact that the Prime Minister got sick maybe gave him a free pass in how he handled the situation. And now there are two schools of thoughts, Tom.
Yeah.
The ones that saying, look, we just need to get through the crisis and need to try and work together. And those that say, actually, we need to hold our leaders accountable for what they've done because it also may change course. Just yesterday, we found out that a critical number of personal protection equipment that was needed for the NHS will not arrive in time. This, of course, after that scathing article that's basically saying, you know, Boris Johnson was pretty much thinking of other things instead of dealing with the crisis in February and March. I don't know if it changes the trajectory, but certainly as a member of the press, I think it's right to keep people onto account whether they've been sick or not.
Well, there's a little bit of light, folks. You look at the statistics, you look at the log glide paths of these diseases, and I guess there's an improvement out there on this Monday morning. We have an improvement, and that is our news. With
Order
our first
submitted.
News in
Order
New York City
submitted.
is Viviana
Order
Hurtado.
submitted.
Tom, Francine, we begin with the White House and Democratic leaders. They're close to agreeing on the next coronavirus aid bill. This measure would be for up to $500 billion. It includes more money for the small business loan program plus funding for hospitals and testing. Sticking with the Trump administration, it's trying to free up cash for businesses hit hard by the coronavirus. It will allow importers and manufacturers to delay tariff payments for 90 days. This on many overseas products, but the move doesn't stop ongoing punitive tariffs. They are the centerpiece of current U.S. trade policy. And now to the worst mass shooting in Canada's history. Authorities in Nova Scotia saying a man dressed as a police officer went on a shooting rampage. He shot people in their homes. He also set fire. 16 people were killed. The gunman is also dead. And the price of oil falling to its lowest in 21 years. Tom and Francine will have more on that. New York crude plunging 60% to around $15 a barrel. There's concern the world is running out of places to store oil. Those output cuts haven't been enough to cope with plunging demand. Global news, 24 hours a day on air. Now, quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Viviana Hurtado. This is Bloomberg. Francine, Tom.
Viviana, thanks so much. I want to get through the data quick to get to Mr. Caron of Morgan Stanley. Very simple. Futures deteriorate. The VIX goes back above 40 to a 41 level. A little bit of angst out there in the last 20 minutes. You see it with yields coming in. And oil is nothing but spectacular. On the hour mark, West Texas plunges another level, a solid 13 handle. Francine?
Yeah, Tom, as WTI futures have tumbled, it's basically opened up a discount of almost $9 a barrel to the June contract, which with most trading has now transferred. So that's what we're talking about, the futures changing. Buyers in Texas offering as little as $2 a barrel for some of the oil streams, raising the possibility again that American producers may soon have to pay customers to take crude off their hands. So that's really the story of the day. Together with that, we're trying to figure out earnings, and we saw a reversal. European stocks that were up, but now pretty much flat, slightly in the red. Tom.
Order canceled. Order canceled.
Yeah, I really
Order
can't
canceled.
say enough about the Bloomberg terminal on the cell phone. Just love, love, love this speed of use here. It's great. $13.49 on present West Texas Intermediate, and the June futures coming in as well with, I believe, a 22 handle on it right now. Usually with Jim Caron working in fixed income at Morgan Stanley, we would start with a bigger, broader view, but because of oil, I can't do that today. And I've got to go right to the Morgan Stanley view, linking debt into hydrocarbons as well. Jim, you and I, you're just old enough to remember Midland, Texas, and the collapses of the 80s, and there's been other issues on oil over the years. This time seems to really be different. How difficult will it be for the debt of oil?
Well, it's going to be very difficult, and that's what the high-yield markets are effectively reflecting. And we're seeing that, the weakness in many of the sectors within fixed income, whether it's in the high-yield markets or it's even in the investment-grade space, that this is a problem that just continues to get worse. We know the origins. Clearly it's a global demand story. Demand is falling.
Order submitted.
There was a spat between the Saudis and the Russians, and that made things worse. But this also puts into context inflation. If you look at break-evens, if you look at 10-year break-evens, for example, those have just plummeted. Last week they were up at 130 basis points. Today they're at about 102. So that means people's inflation expectations have fallen on average over the next 10 years because of this by about 0.3%. So some of that's technical, some of it's fundamental. And it's also the other technical that's out there too is that they're running out of storage. You're running out of storage to store oil. So the demand, you have what you need right now. You might have less demand for it, and that drives the prices down. But as you pointed out, Tom, this has far-reaching implications. This has far-reaching implications to fixed income. High yield is not going to do so well with this today. Investment-grade energy sectors are not going to do so well with this today. And this has been a soft spot for the past year to 18 months. So it's just going to make matters worse.
Right. One of your great charms, Jim, is not only do you look at the strategy of all this and the management of portfolios, but you also look at the supply coming on. Very few do that. How will this affect the supply of fixed income, the mix of stories that we have right now?
So it really becomes very idiosyncratic, right? Because if you look at supply of fixed income, if I just look at investment-grade supply is running, at very, very strong levels ahead of even 2019 levels. Look, after all, yields are low. There was an opportunity to issue, particularly in January and February, but even more recently right now, as the markets have started to, heal themselves a little bit, there's been plenty of need to issue. So low interest rates helps people issue. But here's the problem, Tom. You're helping all the wrong people in all the wrong places. The people that need the help are the people in the energy sectors, are the people in the more stressed sectors, not the sectors that are very healthy, like, let's say, healthcare or some industrials or maybe financials. Those sectors are fine, and they're getting the benefit of low interest rates. Clearly spreads are wide, but the money's not going where it needs to go to really support the more troubled sectors.
Order canceled.
Is it right,
Order
Jim?
canceled.
Are we going to see bankruptcies because of this? So should we support, companies and sectors that were in trouble before coronavirus? Are we going to end up with a bunch of zombie companies?
So this is a really good question, right? And I want to discuss the difference between bankruptcies and insolvencies. Will we have bankruptcies? Are there some companies that just cannot stand this at this point and are just bad operations and are just operating at way too high of a cost? Then yes, I think yes, there will be some failed companies along the lines. What's more important, though, to think about are the insolvencies. So these are still ongoing concerns that are going through a rough patch and just really need a line of credit to get through this period of time, sort of like tapping a credit line. This is where the Fed could be helpful. This is where central bank policies could be helpful. So insolvency is really just your ability not to make good on your debts for the time being. The problem is that a lot of these companies in the energy sector have already gone through their lines of credit, and where are you going to find a bank that's going to lend a lot of money there? What if those loans get impaired? So what we maybe need to start to think about are some of the better companies in the energy sector that the Fed and central bank policy might need to start to address to say, look, just like they're doing with the investment grade markets, is to say we'll give you a bridge loan to the other side, but only for the best companies, only for the companies that we think as of March 22nd, that's the line that they draw in the sand, had a rating of X or better or whatever metric they want to use. But that's the kind of thing that we need to start to think about because, look, oil's in a free fall. These companies are not profitable at these prices of oil. And the longer they stay here, the longer the pain's going to be, and that can create other financial problems.
But Jim, is there a worry that actually underinvestment or even letting some of the weaker companies go then leads to a spike of above 100 in 4 or 5 years? Are we creating the next crisis?
Oil is always a boom bust business, right? So the whole point of OPEC was to try to smooth that out. OPEC isn't working very, very well anymore. So we need to start to think about oil, and I think I like where you're going, with this, in the sense that, before OPEC, that's exactly what you had. Oil would run up to really, really high prices. A lot of people would come in, and then somebody, the major producer of oil would produce a lot, and they'd drive prices really, really down, and people would go bust. So oil has always been a bit of a boom bust type of a product when you didn't have a governor, effectively, like an OPEC, that was well respected and running very, very efficiently. Right now, it doesn't seem like we have the school monitor on duty at this point, and it's running amok. So we got to get used to then, at this point, if this continues into the future, having oil go down to $10 a barrel, having oil go up to 50, 60, 70, and then having it come back down. It's a boom bust business.
Jim, thank you so much. We'll be back with Jim Caron of Morgan Stanley Investment Manager. Now, also coming up at 3 p.m. London time, a conversation with Larry Kudlow on how to get Americans back to work. He's National Economic Council Director. That's at 10 a.m. in New York, 3 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance. Tom and Francine from London and New York. We were having a great conversation with Jim Caron of Morgan Stanley Investment Management about some of the oil companies and maybe some of the funding crunches that they'll face, what this means for banks. Jim, let me go wider now and just to ask you, in general, do we really understand once the economy is open again, once we have a handle on this health crisis, what the lasting legacy of the 2020 recession will be?
So I think one of the things that's becoming very, very clear, and we're already seeing the wheels in motion for this, is just the use of technology, working remotely. I think these are obvious, right? This is something that we're all doing currently right now, and as it turns out, people are pretty good at understanding their systems and getting things to work, and I don't think a lot of productivity is being lost. But I also do think, though, when we think from a macro perspective, there's also going to be a pretty big change in terms of supply lines. in terms of where things are produced and also wages and labor costs. Now, there's two ways to go on this. One is to say the initial impact is that we're printing a lot of money, we're doing all kinds of quantitative easing, and that creates a lot of money, and that might create a lot of inflation into the future. Others might think that, no, there's going to be a lot of demand destruction over a period of time where you're not going to really have inflation, but you're going to have disinflation or even a deflationary period before you resume. This is the battlefield, right? So we don't know from an inflation, from a bond perspective, in terms of where should the long end of the yield curve go, how much inflation should we be discounting or not. That's the big question mark in the bond market. Where I start to lean towards this, though, is as I look at not only the amount of fiscal deficit spending that's been going on, not just in the U.S. but around the world, but if I take the U.S., for example, and see what we've been spending just for the virus, add that to, don't forget, this decade is the decade that the baby boomers all become 100% become eligible for Social Security. The deficit was going to rise anyways. So not only do we have this big deficit spend, which was very unexpected, but we have another one coming in the years 2024, 2026, that's going to add even more to the debt. So the question then becomes the dollar, which in bond yields, which have been in a secular decline for 40 years, does the very high levels of deficit, and I'm talking 8, 9, 10%, maybe even a little higher, does that start to matter? Or do we start to think differently about deficits? Because other countries are going to be in the same position as well. So these are key questions that we need to wrestle with.
It seems like a theme through 2020, and we'll do that with Jim Caron and the team at Morgan Stanley. Mr. Caron, thank you so much for joining us today. For those of you working at home, particularly those of you with a Bloomberg terminal, really can't say enough about TV Go. You can pick up easily there our live broadcast, but also many of our important conversations, including with Jim Caron. Please stay with us on oil next. This is Bloomberg. Bloomberg Surveillance, good morning. Let's get right to it, folks. This is too important a conversation, particularly for those of you betting on oil higher. There is a lot of confusion. Joining us now, Senior Vice President, Hydrocarbon Confusion for Bloomberg, Julian Lee. We're thrilled that he could join us, of course, writing brilliantly on the dynamics of oil. Julian, you don't buy physical oil when you get those price quotes, particularly within ETFs. You buy a May contract, which is rolling into June. Is the price of oil Thursday $13, $14 a barrel, or is the price the June contract $22 or $23 a barrel? Where will that be Thursday or Friday?
I think Thursday or Friday we're going to see it somewhere probably between the two, but I think it's going to be closer to where the June contract is now. So that's the sort of $22, $23 a barrel level. A lot of what we're seeing in the headline price right now is because the May contract expires tomorrow, and I think that is pushing the price down, because if you're holding paper, you either have to offload it or you take delivery of the crude, and nobody wants the crude at the moment.
Right. Well, again, folks, and this is so important, we're talking about physical versus financial contracts and agreements. Julian, if I own an ETF and I've mortgaged the house because oil's $13, $14, $15 a barrel, am I going to profit mightily from the future shift?
You may well do if you've got a rollover on that contract into June. And this is part of the issue that we're seeing at the moment in some of the big time spreads that we're seeing. People who are buying oil now, and this is physical as well, buying oil now, selling the crude forward on the futures market, locking in a profit, and that is allowing them to store the crude or to move the crude if you've got physical crude, to move that around the world, locking in a profit as you go.
Okay, one final question, Julian. This is so important. Away from the dynamics of futures is just the bet on demand-supply dynamics of oil. How far out do you perceive this demand crisis of oil? Is it Mayish, is it June-ish, or is it unimaginable?
I think there is a real fear that it's unimaginable, but that may be too strong, but I think there is a real fear that it's beyond June. I wrote a column at the weekend looking at traffic congestion, and what we're seeing is even in China, where some of the restrictions are being eased, we're seeing a pickup in traffic flows during peak weekday hours, people going to and from work. But what we're still seeing is that outside of those hours, at the weekend, during off-peak weekday times, traffic flows are really, really low. So that sort of discretionary, recreational, going to the shops kind of driving isn't coming back, or at least not yet. And flying may be the same.
All right, thank you so much, Julian Lee there from our, of course, BI analysis on oil. Tom, as he was saying, it's very, very important to look at what's been going on with the futures contract and some of the conundrums there as we try and understand the oil market much more. Now, this is what WTI is doing right now. I think it's below $15 a barrel. Again, a lot of volatility today. We may have volatility tomorrow because of the change of futures contract. We're also looking at earnings. Now, this may give us better idea of what we do next in terms of equities. European stocks were gaining some 1% at the open. They're now down some 0.4%, so following Asia lower and also following your futures in the U.S., Tom.
Yeah, very, very interesting as well. And of course, a lot of the earnings are industrial, away from the bank earnings that we saw yesterday in that important interview with Mr. Gorman. Right now, we want to drive forward to what we're going to be doing here for the rest of this hour. It is Gideon Rose of Foreign Affairs magazine Their new issue is very much on climate change, maybe pushed to the side, but I'm sure Gideon Rose, through the essays that we've seen in Foreign Affairs, will have some terrific perspective on the international relations of this pandemic. Please stay with us with futures down, the VIX near 41, an historic day for oil. This is Bloomberg.
You're watching Bloomberg Surveillance. I'm Vivian Hurtado. Let's get your Bloomberg First Word News. We begin with a deal that's close on the next coronavirus aid deal. President Donald Trump has joined Democratic leaders and some members in his administration. They're working on a new package that would provide up to $500 billion. More money would go to the loan program for small businesses, plus hospitals and testing. Now to China, that nation adding stimulus. This after the economy shrank for the first time in decades. Banks cutting borrowing costs. The government promising to sell another $141 billion in bonds for infrastructure spending. And Vice President Mike Pence will discuss today testing shortages with U.S. governors. President Donald Trump says some governors are relying strictly on state laboratories. He says they should also turn to large commercial and academic labs. Governors of both parties are calling for more widespread testing. They say without it, they can't start to reopen the U.S. economy. And we end in Germany. That's where the last 24 hours, the number of coronavirus cases rising this month by the least. Since April the 1st, the number of fatalities was also the lowest. This week, Germany will begin allowing smaller shops to resume regular business, and schools will gradually reopen. Global News 24 hours a day on air and at quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Viviana Hurtado. This is Bloomberg. Francine, Tom.
Very good. Thank you so much, Viviana. Greatly appreciate that. I should point out again, oil is south.